All right, ladies and gents, welcome to the Empowered Traders Network. I'm really happy that you're here. I'm really happy that you have joined this community because I've spent significant time on building this course and fine-tuning it, because my goal with this is that I will change your perspective. I will change how you perceive the market, and I will actually give you the tools that you need in order to achieve high win rate, high risk to reward, but most importantly, trade with confidence. This is the exact same tools that every professional trader use, and this is the exact tools that most of the YouTube traders don't even know about. So this is why it's so important. So let's start with the course, because we do have a jam-packed list of items that we have to go through. This course is full of valuable stuff, and I've laid it out for you so it will be easy for you to understand and follow along. And a pro tip is actually, if you think that this is quite slow, you can just increase the speed of the videos so you can speed run the course. And once you know what parts that are valuable to you and that you want to take notes on, then you can reduce the speeds on that part. So without further ado, let's start with this free course. And I hope that finally that you will understand why trading is so hard and what kind of tools that we need in order to make it easier. So let's see. Welcome to the free trading course by the Empowered Traders Network. And this is where I want to present myself, because my name is Amir and I've been trading since winter of 2017. And fun fact, I joined the markets because of the Bitcoin bull run back then, and Bitcoin was like 17K. And I actually invested a large sum of money into Bitcoin because I saw that it went from like 1 to 3K up to 17K. And you guys that have been following along with the crypto journey, it actually went to 2021, then it plummeted down to 3K. And for me, back then, this was a lot of money. It was, let's say, 50% of my savings. And I wasn't mad, but I was curious on how I can buy low and sell high, because this is what everybody was talking about. So I thought that the gateway into this, the gateway into investing in crypto profitably, is to understand trading. Fun fact, I never traded crypto ever. I started to learn trading, but I never applied it to crypto at all. So this is my journey. It has been a few hard years because I fell for all of the traps that trading actually gives you. All of the fake mentors, all of the fake strategies, all of the decent strategies, but not, let's say, you can't make consistent profitability from it. And it's a very hard way of reading the markets and earning good profits from them. And I fell for a lot of courses that wasn't good. Maybe I even bought courses from really good traders, but they couldn't teach. They were very bad at teaching, and this was a huge thing as well. So let's go and see what we can do here. So this is where I will show you step by step, click by click, how to make money from the financial markets. And it's very important because I think you will understand by the end of this course how valuable everything that I will give here for free is to you. Because this is the tools, like everything I'm showing here, you won't see it easily on YouTube. I promise you. You will get the exact roadmap and tools I use to trade the market consistently. This is the same tools I use on my day-to-day trading, and this is the same tools I give to all of my students, and this is the same tools that change their perspective on how to view the market. So yes, this is the same roadmap that I use to help many traders how to approach the market professionally. Because the students that I have, the one that comes to me, most of the time, they are not beginners. They're somewhere around 2 to 3 years of trading. Most of them are in the ICT era, and most of them, when they come to me, they get that aha moment. Why sometimes their ICT trades worked and why sometimes it didn't work. And all of this is combined on tied into auction market theory. And this is exactly what I want to, this is exactly what I'm going to teach you further on in this course. So what is my mission? my mission is really simple. It is to provide high quality trading education. I've invested over 40,000 into professional education and coaching and mentorship. And believe me, most of this money was lost. Like most of this mentorship and coaching and stuff like that, it was straight up bullshit, or the strategy didn't work, or it was a very hard way of extracting profits from the market. And it's very important to know that most of the mentorships doesn't even work. All right. So if you are new to trading and you jump into YouTube and start searching for trading information, you think by default that the one with the most followers are the most profitable and he actually knows what he's talking about, right? And this is why retail trading are so hard. And you will see it on the next slide when we go to the whiteboard or the blackboard. Why this is like why you're all set up to fail from the beginning when you start to research about trading. And I've actually fallen for all of the scams, all of the tricks, and everything that all of these fake mentors and coaches actually throw at me. And I've, as I said, invested over 40 to 50K into trading education. And sometimes I invest them in very good traders, but they are very bad at teaching. And this is a important thing as well. So the mentorship that does actually work, you have to pay large amount of money for it. And unfortunately, much of this information is only accessible through expensive programs. And by expensive programs, it can also be expensive and hard to understand. So I remember when I invested in a mentorship program, I just got happy if the guy if it was easy to understand what he was teaching, if he didn't overcomplicate stuff, and if he had any structure to his teaching. But then came the next part. The information had to be good as well. But I remember the last course that I spent, I got so happy because I really didn't want to spend the money on it. But I was so happy when the guys actually had some structure into his teaching and that he made it easy to understand. So my goal with this is also to give you high quality information, very easy to understand. And this is actually my specialty. So let's see. I'm removing that barrier and giving it away for free so anyone, anywhere can access it. So all of this investment I made into this coaching, all of the years I spent on backtesting, and most of the things that I'm going to teach you, nobody has even taught me. I promise you. Like I've taken bits and pieces from different mentorships. And then I started to backtest and understand how to combine everything together. And this is the most important thing. Because the thing that I'm doing is it's not unique, but in a way it's unique because it's not mechanical. Like you will see later because it's very, very, very powerful. You will see it when we do the backtesting sessions. You will actually see how I combine everything, the order flow, volume profile, supply and demand, all of that, delta profile, everything to actually understand what is happening inside of the market. But the main thing here is that I have to understand the logic behind the market. This is the thing. And this is the logic that I'm going to teach you inside of this course. Okay, so why am I doing this? It is because I want to earn your trust by delivering high quality free education before offering anything beyond that. And I promise you that everything that I'm giving away here, that you can just watch the full course, take the things that I give you and start to apply it in your own way of trading. And you will finally understand why certain moves happen and why price goes from one point to another point. All right. And this is important because I'm not asking for anything else beyond that. I'm just here to provide the highest quality trading education that I can, all for free. So let's go. Before we proceed, watch each video in order. This course is intentionally structured to build your skill step by step. At this stage, this is the most important video in the course. Make sure you fully understand it before moving on. And a pro tip, like I said, watch this video on 1.5 or 1.75, or if you're a madman like me, watch it on 2x speed to speed run the course, and then you can rewatch it back and then take notes on the parts that you really, really liked. So now we have to talk. Let me explain why trading is so hard and why most traders struggle even when they are doing their best. And like, I will take you on a journey right now. All right, so let's jump into this whiteboard, or this is a blackboard, but yeah, let's jump into this because this is a very important information that I have to give you, because I've actually been through all of this journey myself. I've fallen for all of the scams, all of the pitfalls, and everything that trading has to throw at me, right? And before proceeding, I just want to tell you something. This is not pointing fingers at anyone, all right? This is not shaming any other mentors or any other educators in the trading space. This is basically my path that I've taken, and this is the most likely path of a retail trader, all right? And if I can actually give you this information and catch you from going through all of these scams and pitfalls and just straight go to the good things, like the things that you need to study to start to extract profits from the market, I will be very happy. Like, that is mission complete for me, all right? Because when I started to trade, when I was actually studying trading, reading books and watching courses and stuff like that, if someone just stopped me and told me like, hey, yo, just give me 20, 30K and I will point the finger to exactly what you need to study, where you need to go to actually get the information you need to be a professional trader, right? I would be like, in hindsight, when I look back at it right now, I would like throw the money at his face, right? And this is what I want to do with you right here. I want you like point the direction that you need to go, and you will finally understand why the financial markets are not a game, right? And it's not those, it can't be just a like MACD crosses or 200 EMA or whatever bullshit strategy that people are teaching. That isn't like a strategy that you should proceed and like continue to trade. So let's see, let's start from here. So like I said, this is the basic path of a retail trader. And this is the basic path that me myself took as a retail trader. So let's say that you're on year number 1, all right? So let's see why this is. Okay, so I fixed it. So let's say that you're on year number 1, or let's say that you are on month 1. I will be very happy that you clicked on this video, because I will actually show you exactly what is happening from the day that you start to take the decision on how, like understanding how to trade and start to study trading. So let's go. Let's see. We have it right here. So keep in mind, like I said, this is me. This is not you. All right. I've written you, but this is the path that I took. This is the path that most of the retail traders take. And this is the path that makes, like you have seen the, like everybody says like 99% of the traders fail, right? This is why, all right? It is not their fault. It is how everything is, all the odds is against you. So let's see, the basic path of a retail trader. So this is you, right? So your state of mind, you're very optimistic, you're eager, you're dream driven, and you're naive. All right. So all of these states are true when you are like researching on how to make money online. Like before I started to trade, I had an e-commerce, and this was the state of mind when I started my first e-commerce that like it totally failed. So the same thing happened when I started to search for trading. So you jump into YouTube, you search for how to make money with trading. All right. So not trader. So how to make money with trading, all right? So what YouTube gives you based on the algorithm, based on how many views a person have, based on the clicks that he has on a video, and based on how big of an influencer he is, he gives you a fake guru, all right? So this fake guru's claims, let me see if I can zoom in. His claims are simply, let me see if I can do it like this. Just want to show it to you right here. So his claims, trading is easy. So you have been heard, maybe you have heard set and forget, like bullshit, right? His claims are like, I became rich by flipping a meme coin. So look at the statistics. Maybe just ask ChatGPT. You don't even need to trust me. Look at the statistics of people that flip meme coins, how much money they lose, all right? Or maybe it is a Forex guru flaunting Lambos and lifestyle. Always, these Forex gurus, they always come back to this MT5 profits. And this is important. They never show a real broker statement from a real regulated broker. It is always these offshore brokers, and it is always a large sum of money. Keep in mind, you are naive, you're dream driven, and you're eager and optimistic. And when they show you, like in this specific scenario, it's like 529,000 pounds, right? It's a huge amount of money, all right? When they show you this and you're in this state, they got you, right? Like you are in their net. Everything they will tell you, you will do. So when they show you this profit, they show you the Bugattis, they show you the Lambos, you will say, oh shit, this guy knows something. So you go and spend 2K on his course, right? And then you spend 1 year of trading his strategy, understanding it, learning, failing, and in the end, nothing is working and you give up and you go to the next one. So if you're smart here, and this is exactly what happened to me, if you're smart here, you just skip this step because you have some critical thinking. I guess I thought I had critical thinking because when I actually failed on a lot of, let's say, ventures, like I did some e-commerce, I did a lot of things. I failed on a lot of things. So when I came into trading, I thought like I knew shit right now. So I've failed like 2-3 times with different stuff. So when I come into trading, I will give it my all. I will go 100%, but I will not spend $1 before I fully understand it. So what actually happened to me is that I went to a very famous YouTube trader, and the strategy was simple. Like it was 50 EMA. Like if the candlesticks went above 50 EMA and create an engulfing, buy for let's say 1-2 hour, and then under sell, something like this. I really don't remember that strategy. And the next strategy he gave me was, and this was his course actually, so I paid for this. Like if a 4-hour candle is higher than 2 times the ATR, then you should just short it. Something like this. I really don't remember, but I remember that I spent 8 months every single day. And I'm going to see if I can find my backtesting here for you as well. Okay, like I told you, I went crazy. Like I backtested everything super deeply, like all of these pairs. Like you can clearly see how many pairs I backtested. You can clearly see like with the NZD CHF, I backed, or let's say take this one, AUD JPY. I backtested for 1 risk to reward, 1.3, 1.4, 1.7, 1.9, and all of this, like you see 120 times, 120 times. All of the like Forex pairs, I backtested like deeply. And then I can clearly see like it keeps going. And this was the refined version. Before this, I backtested even more. So all of this to say to you that I've fallen for all of these scams. I've given it my all. And you know what happened? When I started to trade, and stupid as I am, I didn't even know that like anything about commissions, whatever. So I invested 60K and I lost 45K of those, of real money in a real CFD account on Pepperstone. I remember it vividly. So this is my journey. I've fallen for these fake trading gurus with their claims of big profits. And you know how they actually show you these big profits? It's actually 2 steps. Those that are very big, they open their own brokers. So they have the access to the MT5 server, so they can put the trades in hindsight and fake it. Or they're affiliated with the offshore broker. So if you see a mentor that trades basic strategy and is affiliated with an offshore broker, you know what the fuck is happening, right? This guy is not putting real trades. There is actually a lot of, like, you can watch this YouTube channel, like, or you search for this, how Forex gurus fake results, and you will actually see what how all of this is going on. And there's even more evidence. This is just one video. You will actually, because I started to research this when I lost that amount of money, right? How did I get tricked into this? So what I understood that, okay, these guys create a strategy, like that specific guy that I bought my strategy from, he created a strategy that was fine-tuned to past data, all right? So that EMA strategy or that ATR strategy or whatever, it was fine-tuned to a specific year on a specific pair. So in the past, it gave positive expectancy, but nothing in the future, like it shouldn't give positive expectancy. Like it was random, right? It was very random. And you will see that the market is very dynamic. So if you have a mechanical strategy, it won't hold for long. Maybe it will work in the past, but it won't work in the future. So this is the path that I took. How to make money on trading? Fake gurus, fake claims. I was naive. I was dream-driven, eager, optimistic. But I did my homework. I don't want you guys to say, okay, this guy is talking shit. He didn't do his homework and he fell and lost all of his money because he didn't put in a lot of time and effort. Believe me. You want to know what happened? After all of this backtesting, after 8 months of live trading and every week losing, I didn't, like all of the rules of that strategy, I didn't pivot from any single one. Like I lost 45K with my mindset that in my backtesting, we have periods where we have drawdown, it will flip. It was only one of my friends that said, what the fuck are you doing? Like, bro, you lost all of that money and you think that it's still gonna give you profits in the future? So that was why I actually went away from this YouTube thing. And here's the next thing. Let's see. Let's go through all of this because this is important. I just want to give you my journey. So if you're on this same path right now, so I can just direct you to another path. And this is very important. So what these fake gurus actually do, they draw some line on the charts. Maybe it's a head and shoulders pattern. All right. Maybe double bottom or whatever. They draw some lines on the charts. They follow some random patterns. And it's very important. They follow some random patterns. Or a magic combination of indicators. Like all of this, bro, I fell for it. Because I was naive and dream driven. All right. So how do they actually profit? They do have an affiliate link with the broker. They earn commission from the money you will lose. So I have a friend in marketing. He has a guy that has a free signal group. He does market for him. He has a guy with a free signal group. And that guy, the only thing that he sells is his affiliate link to the broker. And since the signals are not providing any real value or providing any real profit to the participants, people are losing money. This guy and the broker is actually sharing the profits of the losses of the people that he drives into their CFD firm. So this is how can I say it? This is how filthy this whole part of the trading industry is. It's very filthy, all right? So this is how they profit. Or they give free generic information package as a course, all right? Or they give signal rooms. This is how mainly they profit, or the most advanced one. They open their own prop firms. They open their own CFD firms. So they just cut out the middleman. And this is how they make even more money. Because remember, you are naive, dream-driven, eager, and optimistic when you start. And the guy with, let's say, 1 million of subscribers, of course, that is the guy, and not the guy with 10K of subscribers, right? So what happens here? The result of all of this is that you will become a gambling addict, all right? You will fall for more scams. You will lose money for years. and you will start feeling overwhelmed and confused. Keep in mind, this is the same journey that I went through, right? And this part right here, this is a great filter. This filters out, let's say 80% of these newer traders. This is the great filter, all right? So many people come into the market because naivety, they think everything is easy, they start to lose money, this shit doesn't work, this is where they end, right? Then we have the 20% that are left. Now they understand a little bit more about the market. I really have to find these key bindings. I have to understand them. So they go into the mechanical trading, and this is a path that you can actually take. And there's actually professional, no, not mechanic, sorry. They go into trading bots because they think that they are literally a ATM. Like if you have a trading bot, you will buy it on the MQ5 store. Same thing here, right? They are over optimized for a period of price where they actually worked previously, but nothing is guaranteed for the future. So you see that crazy result and you buy that bot for 2K and you think, yeah, okay, I put the money in a trading account and this bot will print money like an ATM for me. That is one path they will go. So maybe they go here. But this can actually be very powerful, but the way you are marketed towards it or not, because there is actually professional traders using trading bots or algorithms to trade. Because the power thing with this is that you don't have to take your own decisions. So the bot buys and sells, right? The thing is that most bots are scams and work only during certain periods of backtesting. They're over-optimized in a very dynamic market, and you will actually understand why the market is so dynamic. But again, you are naive, you tried a YouTube strategy, you jumped into a bot, and now you think that the money will work for you, right? So the problem is here that real bot trading requires you to learn code like Python, MLQ, etc. And you will need to have many different bots for different market conditions. And this is a main thing here. So if you think that the money will work for you, it won't work for you. You will have to have, let's say, 10 different bots, maybe one for a breakout strategy, one for a consolidation strategy, one for a, let's say, trend strategy, whatever. And you have to sit in the market and decide yourself what kind of a market condition we are in and enable that bot for that specific market condition. And also if you find a edge using one bot, that edge might work some periods of time because maybe the other market participant that made it work just isn't in the market, or maybe like the market is so efficient. So if a edge is working at a specific time for a specific bot, if everybody starts to doing that, then it will stop working. So as you see, trading bots, they are not ATMs. Trading bots is a real industry, but in order for you to be profitable with trading bots, you need to actually know what the fuck you're doing, basically. And it's a full-time job. It's not like the money will work for you. It's not an ATM. Then you can have a mechanical trading. So when Y and Z aligns, you execute on X. This is kind of what I did, and it is exactly the same thing. If you find an edge on a mechanical strategy when you are backtesting, most likely it just worked that period of time. Let's say you backtest, I can't make up a strategy. Let's say you take a bullish engulfing above 50 MA, exactly what I did. That strategy will maybe work 2018, all right? Maybe it will work halfway into 2019, but in the front end, like until 2025, that strategy won't work. So if you take that strategy live to the markets, you will start to bleed money. This is exactly what I did. So in my example right here, so if you watch this, so what gave me that aha moment that this strategy is not working, and this is where I started to, like, when I was deep in drawdown, I paid a guy in Kazakhstan, I think, to create a script for me with the rules of this strategy. And then I tested it for, let's say, not one specific time, but 10 years, 5 years, for a longer time horizon. And I saw, okay, shit, this is actually giving me profits. Like with the 1R, it's giving me 1.2, 1.1, 1.1. Like it is giving me a little bit of profit. So I thought, okay, I can compound this, and then this will give me a lot of profits. But what I didn't understand back then, that you have commission, you have slippage, you're not awake 24/7 of the like 24/7. So this is why in the end I lost money instead of making money, even though in backtesting it gave like 1.2 or a little bit of profit factor and so on. So this is exactly why most mechanical strategies only work certain periods of time, and the other times they actually fail in the future. So let's see. And what I did right here, me personally, I went through all of this bullshit. I lost 45K. What I did is jump directly into ICT. All right, because this started to sound a little bit more logical. This was a little bit more discretionary, and this is maybe where most of you guys are actually right now, because this started to make a little bit more sense. I saw a sweep of liquidity, taking out HSI, confirming, blah, 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 and draw of liquidity here and there. And this is actually where I started to get some few payouts, but it was a very freaking hard way of earning money. It was so hard. It was so hard compared to what I'm doing right now. All right. So I hope that, let's say you are here, maybe you're tired of this, like waiting to, what I did back then is what I was like waiting 1 week, 2 weeks for a trade, and it was a loss. And then it was a good loss. Then I waited 2 more weeks. Then it was a headache. Like I kept adding rules and rules to a strategy, like so many rules to the strategy. It was so crazy, so freaking crazy. So I'm very happy that I went out of this route, because I know that there is ICT traders that are actually earning money from the markets. But when I watch their videos and talk about like how they earn money from the markets, it's a headache. It's like, if you click with it, go with it. If you're that type of person that this makes sense, go with it. But just know, this guy, ICT, he's created a cult, okay? This guy has failed the Robbins Cup 3 or 4, 5 times, all right? This guy says that he created an algorithm that controls the market, and God gave him the code. So if you believe this route, go with it, all right? Because I know, because I have gone through it and I actually earned some money and earned some profit. I was mixing market structure with ICT and stuff like that. So yeah, go with it if you want. But if you can, just wait for the good shit. It is like, why does it start to sound logical? And here's the main thing here, because this guy is a super good marketer. This ICT guy, he actually knows auction market theory, and he built his strategy based on auction market theory. But the thing that he is leaving out is that he is using auction market theory based on candlestick patterns. All right? Session highs and lows. Sometimes they work, sometimes they don't. If you truly understand auction market theory, if you truly have Bookmap where you can see where real liquidity are resting, or where real liquidity comes in, or let's say you understand order flow and actually can see that, let's say, a buyer is getting absorbed and that there is a iceberg order, whatever, above London high, whatever, then you can, then that is the time the ICT strategy works. But let's say market just goes higher and you're waiting for a sweep of Asian low, market goes higher. What is the cause? Like, isn't there are a lot of stop losses below Asian low and we should take that before going up? Like, the thing that this ICT guy is teaching you, it is built on auction market theory. So sometimes it works, sometimes it doesn't work. But when you don't have the full picture, when you don't understand auction market theory and just go with the ICT explanation and watch the candlesticks, this is why you get confused sometimes, because the strategy seems to work, but sometimes it doesn't. So what I used to say, or what that mentorship I was in used to say, is that the market does what the market wants to do. So that was the reason why it sometimes worked and sometimes it didn't work. So the thing here is that it's hard to stay consistent, profitable. A lot of rules are added to your strategy day by day. And this is exactly what happened to me. A lot of rules. And you're waiting a long time before executing trades. Here's the thing though. Lucky for both of us, you have joined a community where you will learn to trade like a professional, or you will actually start to read the market like a professional from a buyer and seller perspective, from a dynamic buyer and seller perspective. It is not only one buyer and not one seller, and it's not like 𝗧𝗛𝗚𝗘𝗢 says one algo trading controlling the full market. All right. I will wake you up on how trading actually works. If you're tired of all of the bullshit and want to cut to the real stuff, I can comfortably, what the fuck, my English is so bad, comfortably say that you have come to the right place. But I just want to set your expectation, because finance is no fucking game. People study for decades and have PhDs for this. Keep that in mind. Finance is no fucking game. Look at this. This is not what you should be focusing on. This is not real. Do you think like a hedge fund manager, like a real prop trader in New York, trades on MT5 on an offshore broker? If you don't, why would you trust a guy that does so? Do you think if you go to a prop firm or a hedge fund in New York and talk about sweep of liquidity, draw of liquidity, ICT stuff, that people will say, oh yeah, you are right? No. Finance is no fucking game. It's very hard. This is about becoming emotional neutral, learning to read where banks and smart money deploy capital, and developing the ability to follow that flow consistently and execute like a Navy SEAL sniper. And this is exactly why we use the volume profile and order flow to execute like a Navy SEAL sniper. And I can even show you my trades from the past, so you see that I'm not just talking bullshit. I will show you all of my trades if you want. I will even give you a lot of backtesting sessions so you can see how we execute with like a sniper. 3 points, 4 points, 5 points at the max stop loss. All right. So there is nothing quick and easy about it. It's a skill that takes serious time to build, usually years to finally master. But with proper guidance, you will speed up this process by a lot. I'll show you how to read the tape like a professional using order flow, how to spot where institutions conduct their business and are likely to do so again when price returns, how to develop context using auction market theory, what tools reveals true strong buyers and sellers in the market, and a step-by-step guide to setting up the software you need to read the data, all for free. Very important. But let's see, what is trading? What professional trading really is the most advanced and at the same time the most accessible glitch in the matrix. It is basically it. It is not a business in the traditional sense. You're not producing or selling anything. To properly understand trading, especially for those who want to develop it as a serious skill, we must distinguish retail trading from professional trading. So we started here with all of this bullshit, and now we are setting expectation, and we are going into the more professional space. So a professional trader is defined as someone who can consistently extract profits from the financial markets by executing a predetermined risk-adjusted strategy with a measurable statistical edge. All right? Choosing this path is not about quick wins. It's about developing discipline, patience, and emotional neutrality. This skill must be continuously refined, just like the craft of a grandmaster chess player, a professional fighter, or elite sniper. It requires that you work both hard and smart. And when you do so, you can start to milk the cow. You can start to milk money from the markets, because this is exactly what professional traders are doing. They're sitting behind a computer, thinking them against themselves, pushing a button and milking money from the market, or like how I like to say it, we have a whale inside of the market. We're just following the footsteps of the whales. So we are just catching a ride from a, let's say, 30-point candle, like 30-point range, and we're just catching that small ride with the big whale. All right. So this is why I say we have to milk money from the market, and it's very important because this is exactly what we are doing. We are just sitting at home, pressing a button and milking money. And this is that naivety. You think that this is the world's best job when you are here, but you have to go through all of this bullshit, go all of these routes, test everything because you want this end result, right? And this is like why I never gave up. What I did, I forget to tell you, what I did when I lost 45K, I started to study this ICT strategy. First month when I was studying this, I was like, oh shit, this thing actually makes sense. At that time, I had a very high paying job as a workshop manager, over 300 buses and like 20 mechanics. What I did, I went to my boss and quit my job because I was like, okay, trading is what I want. This ICT shit makes sense. I don't know how to do it, but if there is a will, there is a way. So I went all into this. I lost like 1 year into this and I had to start over again with auction market theory. And yeah, it was a very hard time. But all of that time, I was thinking that I want to come here. All right. I want to start milking money from the markets. And I specifically chose that word because we're literally doing that. So only in trading can you scale to 6, 7, even 9 figures without a team, without building brands or website, and without dealing with marketing, fulfillment, customer support, sales, or managing people. And this last part, this is exactly what I chose trading, because all of my professional career as when I was working, I was always managing people. And I don't want to say it, but I started to hate people after that. It was headache, a lot of headache. And this was like most appealing thing. And also how I can scale this further and further. I just literally need to understand one skill, do it over and over again, just increase the capital and have location freedom. And yeah, it's like, it's the best job, right? But when you come into trading, all of this great filter right here, this takes out 80%. This takes out, let's say, 10 more percent. And when you come here, this is only 10% left. And out of this 10% that is here, only 5% maybe will become profitable. But let's say like this, out of 10% that actually come to the real senses and understand how to read the market and stuff like that, out of those 10, I think like many of those people actually succeed in trading. I would say like this instead. Because when you finally understand how the market works, you will not give up on this shit. This is so goddamn powerful. And you will see it in our backtesting session, how powerful it is. All right. So at the surface level, you're simply buying and selling a financial asset and getting paid. But you're not guessing entries. When I say push a button, I mean executing a predefined risk-adjusted strategy with a statistical valid edge. All right? This is not a slot machine. Your job is to develop and apply an edge before you ever place a trade. That edge is what keeps you afloat in a chaotic market. This is what I will teach you by the end of this course, how to develop and apply a real trading edge. Okay, so you can go 2 different routes, and with everything that I show you, you can even do swing trading if you don't have a lot of time, or you can do intraday or scalping. This is what I do because I am a full-time trader. I trade every day. I trade both the London session and the New York session. Most of the time, mostly on the New York session though, but I stay 2 hours into the London because I'm home by that time. And most of the time, many of the days, I actually catch a trade. Yes, it doesn't mean that it's always a winning trade, but many of the days I even have 1 or 2 trades. All right, so what is the pros and cons of swing and intra? Let's see. The swing trading, it's good when you are working, right? when you have a day job and you need to have income from other places. But when you're intraday or scalping, let's say that you can finish your work for the New York session to open, then I would actually suggest this. I do some swing trading. I have a specific playbook for swing trading. A specific, like how I do it, it's a very... it is a very good approach as well, but I really love this shit, man. Like intraday and scalping. Like when I enter a trade and I see my trade going to profits in 5 minutes or maybe 20 minutes or maybe 1 hour, this is the thing that I'm most passionate about. I really want the action. Also, I really hate going to sleep with an open trade. This, I get the results immediately. All right. So when I enter a trade, either I take a losing trade most of the time in, let's say, 1 minute, or I take a winning trade, let's say in 20 minutes to 1 hour. I really love this thing here, intraday trading. When I enter London trades, this can maybe take up to 5 hours even. I've seen trades take. So it's not just scalping in and out quick, like one tick, and so on. I go for a slightly longer swing on an intraday basis. So these are the pros and cons. So I want to tell you why the market is dynamic and a hard environment to thriving. And this is information that people don't tell you. And believe me, just stick with me here. By the end of all of this, you will understand why it's so hard to trade. You will understand why, like, everything is... When you start with trading, mentors are against you. Everyone wants to profit against you. Then you go to CFD firms. They will earn commissions on you. Then you will fall for all of the pitfalls. You will start to buy bots. You will... all of that. And then you come to the real market, and this is the behemoth of a beast that you are trying to earn profits from. So let's go. Just stick around because this is important, because I want to set your expectations correctly. All right, let's look at all of the market participants, most of them, and see why the market is such a hard environment to thrive in. And also this will give you a little bit of context on who your competition is inside of the market and what entities are actually participating inside of these vast financial markets. So to start off, we do have the policy and non-profit driven participants. These are the ones that they can influence markets, but they are not trading for profits. So just think of it, right? Like central banks are not trading for profit. Governments are not trading for profit. Treasury departments, they are not trading for profit. These players don't trade to make money. They change the environment. They change the interest rate. They change the liquidity and currency strength. And these are the ones that can create big, slow, unavoidable flows in the market, unavoidable moves in the market. And after that, we do have the hedgers. These are the commercial participants. They use the market to reduce risk, not to speculate. Sometimes they can, or they accidentally gain on their speculation. I will explain how so very soon. These are the corporations. These are the energy producers. These are the airlines. These are the import exporters, and it's bank hedging exposure. So they are forced to transact. They don't care about perfect entries. Okay, so why are they forced to transact? Let me explain like this. So let's say that you are an airline company. All right, you have your macro analysis that jet fuel is going to rise in price, right? Or oil is going to rise in price, whatever. Like most likely oil, right? So based on that, based on what is happening on the, like, let's say USA and Iran is going to have a war, or Israel is attacking Iran, something like that. They want to know that they don't want increased cost of operations because of this policy or this war or whatever that is coming out, right? So maybe they lock in oil at $90 barrel, or let's say $50 barrel, because I don't remember what the oil price is currently, but I think it's around 50-60 USD per barrel. So they buy the future contracts. So what is a future contract? A future contract, it is self-explanatory. So you buy one future contract of oil. So you keep that contract instead of buying a lot of oil, right? You buy the future contract. So in the future, if price goes up, you can sell it for profit. If price goes down, you take a loss. So basically, they secure, like they have the operational cost, right? If they want to make profits, oil has to be at this price. And now they're seeing something boiling up in the world, and they don't want to take on risk and not secure their largest, let's say, asset or the thing that they consume the most. So that's why they buy oil futures for 60 USD. And then if in the future price goes up, all right, maybe they sell it, have some profits. If it goes down, it doesn't matter because they calculated that $60 was the thing that was safest for them. So these are the ones that they don't wait for confirmation. I hope it makes sense. I don't want to go extremely deep because this is I want to make it simplified. Just know that different participants use the market for different outcomes. Okay, this is very important. So these are the ones they don't wait for confirmation. All right, so they have to act right because they want to hedge themselves against something. They transact even at bad prices if necessary. So let's take an example. A company must convert euro to US dollar to pay salaries. The exact tick of them entering the market or converting that currency doesn't matter so much. After these hedgers, we do have the large investors and asset owner. They allocate and rebalance massive amount of capital. These are the pension funds, sovereign wealth funds, insurance companies, and endowments. They move slowly, but when they move, they move. And this is why size matters. These are the ones that can create longer term directional pressure. All right. And if you're using order flow, like when these guys come in, I can maybe show it to you in the backtesting session. You will actually see it on the big trades, like an area of prices popping a lot of big trades. But let's say like this, you come down to an area and then market stalls like this. But inside of this price action, the big trades is popping a lot. Then you know that this area is an area where big banks or investors or someone is doing a lot of transaction. Let's say market goes down, goes up. So what did we actually create? An area of demand, right? So market pulls back to this area and you have the big trades confirming that. Here you look at the order flow, take the market long. Very, very simple. Much easier than other strategies with 1,000 rules. So next up, we have the active traders and funds. These are the alpha seekers. So what are alpha seekers? Nothing fancy, right? These are the traders inside of the market seeking profits. We are like one of them, but these are the guys with more capital, all right? They try to outperform the markets. These are the hedge funds, CTAs, macro funds, quant funds, and active asset managers. These are professional risk takers with rules, models, and risk limits. They create trend, rotations, and momentum. These are the guys like, yeah, these guys move enough money to influence price. All right. And now we have large investors, which are the asset owner. Let's say Warren Buffett. They make sure they can always buy or sell. But we also have in this category, we have market makers, dealer desk, option market makers, electronic liquidity provider. I don't know why I wrote large investors. Anyways, I think I misspelled this right here because this is a whole another category. Anyways, it's not important. Let's go. They're not betting on direction, but they are managing inventory. So there are like Citibank, Citigroup, or whatever they are called. They are the market makers, right? They are there to provide liquidity. So when you see on the order book, I don't want to get too deep, but let's say this is the order book. This is $99. And the next, let's say this is a bid, a buy limit order. The next offer, which is a sell limit order, is at 101. So the thing in between, everybody knows what this is. It's called a spread. And the spread and the commission inside, like, don't need to overcomplicate this, but they earn money on providing liquidity and earning on the spreads. let's make it easy. Let's not overcomplicate stuff, right? So there we go. Then we have the proprietary trading firms. They trade the firm capital using defined strategies. So on discretionary prop traders, and I have a challenge for you. After this video, go to YouTube, search for a prop trader or professional trading firm in the US or somewhere in the world, and look at their screens. You will at least, I'm gonna bet like every trader there, you will see the volume profile at least. All right. And this is why the volume profile is like the sharpest tool in the market, like the most lethal tool in the market to use. All right. So we then have the quant prop firms, statistical arbitrage firms, HFT firms. Then these HFT firms, these are like super bots, like they transact on maybe ticks value and stuff like that. So they trade speed, execution, structure, and not opinions. So there is few companies like HFT companies. They do have their own internet line from their office into the CME, because that one ping difference, that 1 millisecond, this is like their edge in the market, right? So as you see, like many different entities using the market for different reasons. So these guys make money because of 1 millisecond. And these guys make money, the market makers make money because of the spread. Then we have this, then we have this. So like you see, it's a lot of different entities, and that is why the market is not straightforward. You can't go with a mechanical strategy. Everything is always changing. Imagine like you are trading a mechanical strategy. If Y and Z happens, do X or whatever. Let's use these guys. These guys step into the market. They start to buy Euro USD. Euro USD goes up. In that period, your mechanical strategy or your bot actually works perfectly. But when they are done buying, when they are done offloading or whatever they are doing inside of the market, then the environment change. And therefore, that mechanical strategy, that edge that was valid under that specific certain period, changes. Or scenario 2, like we talked on before, if there is a visible edge inside of the market, the more people that use it, it's something called the efficient market theory, right? So when more people use it, that edge will disappear, because remember, someone has to lose in order for you to win. All right. Then we go to, just give me 1 second, guys. Okay, there we go. Then we go to the retail traders. These are the small, fragmented, and usually reactive. Okay, these are the individual traders like me and you. These are the social trading communities. Retail traders don't move market, but they provide liquidity. So retail traders often appears at very poor location. So let me explain this. So now I'm gonna make up a EMA strategy. I really don't know shit about EMA, but let's say this is the 20 EMA, right? And you have a strategy based on if 50 is above 20, whatever, if you get a large green candle or a momentum or whatever, you will buy here, right? Stop below this low. So imagine this, all of these entities are transacting. Price was at this low right here. And then we had the volume profile. And we saw that we had a huge amount of volume here, okay? And then we have something that is called a shelf. Price came to this low. Me personally bought here by using order flow, and then market started to rally even more. Let's say here, all right? And now this EMA, since it's lagging, it is crossing and it's giving you a signal to buy. But since the market rallied so much, now people think that it's worth to offload or sell asset, because let's say like this was $90 and this is $100. So EMA crosses at $100. So of course, people want to buy at worse than worse prices all the time. Someone will say, okay, it's worth to sell now. So when they sell, this is the pullback that starts. So you're buying too late because your indicator is lagging. And when the pullback starts, instead of you start to sell here, you just buy here. And this is why everybody's like, it's common sense, like indicators are super lagging. You have to be very sharp to see exactly where there is like a supply of like supply inside of the market, and the demand inside of the market, knowing where the sellers are inside of the market, knowing where the buyers are inside of the market, and actually confirming this by using order flow. So when we say that retail traders often appear at very bad places inside of the market, it is because they are using indicators. They are entering the market exactly when the sellers are coming in. They are starting to buy, right? Also, one other thing, let's say that you are going to take a breakout trade. I'm not talking shit. Let's say that this is the previous daily high. Price goes above this and starts to break out. Yes, if you watch candlestick patterns, it can work. But you know why, or you know how it can work even better? It is by using order flow and actually seeing that the buyers are buying here, that they are getting follow through, and that they are getting rewarded for all of their effort. All right. So therefore, like everything will become much better with order flow because you can actually see what is happening. You don't need to rely on the speed of a candle going up and down, right? So you can actually see the interactions. So when they say retail traders appear at very bad places, so at a daily high, right? ICT traders would short this with the confirmation because in their head there is a lot of stop losses here. Breakout traders will long this, right? But order flow traders will wait and see what happens, which side is the strongest, what the order flow is telling them to do. Like it's a stark difference. Sometimes I buy, sometimes I sell. So that is why it's so important. So tell me this, because when I was trading ICT strategies, this was the daily high. Let's say I took a trade and this was my target. But when the market started going higher, I did like, of course, I was happy because taking profit here. But would it be much better to understand when and how and why? If there was a way to understand if market would go higher to the next liquidity point, like you can add order flow if you're even trading ICT, right? It can even make your strategy even much, much, much better. Now, let's see. Markets move because different participants are forced to act for different reasons at different times. And I hope it's very clear to you right now. So contrary to what this ICD guy says, it is not one single algo that is controlling the market, and it's not him that built it. It is all of these entities. It makes sense, right? If the market is vast, like it is always shifting, sometimes it's consolidating, sometimes it's trending, sometimes it's waiting for news to happen, sometimes it's waiting for the CPI, FOMC, whatever. So why, if there was an algorithm, why is algorithm also waiting? Is it not after everybody's stop losses and making money depending on, like, doesn't matter what happens? So that is why, to be honest, I really don't know this full ICT narrative. And this is only, don't quote me on this because this is only the only thing that I've heard from other people and other podcasts and so on, because I never even watched one single ICT video of him. Either way. So how does this tie perfectly with order flow and auction market theory? And now comes the thing that you have been waiting for, because we are not trying to outsmart the market or outsmart anyone. Very, very important. I'm not here to predict. I'm here to sit, look at the market, and react. We simply observed where different participants are transacting and base our decision on actual market data, not patterns or indicators. Very, very, very important. The market leaves footprints, and that's why it's called a footprint chart. We learn how to read them. Order flow shows us who is in control right now. Indicators describes the past. Order flow shows the present. Patterns don't move market, participants do. Auction market theory helps us understand where price makes sense and where it doesn't. Volume profile shows where the business was done. There's actually other tools to that as well, but volume profile mostly. We don't outsmart the market. We align with it. Very, very important. So you may be asking, how does this tie perfectly with order flow? Because like I told you, every transaction that happens inside of the market is clearly visible to everyone. So when someone buys, a buyer and a seller transact, they shake hands, one guy buys one contract of a seller, right? This will create one volume. And this one volume, you can clearly see this transaction on order flow, this one volume at, let's say, 1900, you get one volume at 1900. But of course, there is a lot of volume inside of the market. So in the end, you can clearly see 3K of transaction at 1900. So that is why when you use the volume profile, you can be so sharp with your levels, because you can actually see where inside of the price we got the most transaction. It doesn't mean let's say this is the point of control. Point of control is basically, let's say we have a high volume node, and we will talk about this extensively. This is the exact price point where the most volume was transacted inside of this high volume node. It doesn't mean that market should tap this perfectly and go everywhere, every time. So just know that. But we will talk extensively about this in the auction market theory module. And now I'm going to finish off very soon, but we have something that is very important, because I was thinking to myself, we have this new thing coming into our world that is called the AI. And I've seen, if you are a copywriter, you're losing your jobs. If you're an editor, they're taking over. If you're creating songs, I don't know if you guys have heard AI music, it's super good. AI is replacing a lot of jobs. And if you think of it, trading is perfect job for AI. So I was thinking, if I use order flow and volume profile, will my edge deteriorate with time? So I asked this from ChatGPT, Claude, and Gemini. So let me read what the answer was. Order flow and volume profile remains effective even if AI dominates trading, because they don't rely on predictions or patterns. So if you are basing your trade, which I was previously, on a liquidity sweep of the previous daily high, and you get the formation of a QM that I was trading before, if everybody is doing this, the AI will actually understand this pattern and start to use it until it isn't even more profitable to use a pattern, right? This is the things that AI looks at. But we use order flow, and we can see when this AI start to execute because of a pattern that someone else uses, and the AI is trying to take advantage of a pattern that has an edge, right? So this is why order flow is the freshest information. This is why order flow, volume profile, read the actual transaction happening in real time. AI, algos, and human all have an execution order the same way, through the same market. What does that mean? So if our AI is going to execute, it's going to show on the footprint, order flow, on the tape. If I'm going to execute, it's going to show, and it's very visible to everyone. That execution leaves footprint in the volume and order flow, and that cannot be hidden. Very, very important. So this is why, even if AI comes into the market, it can't hide its footprint. So indicators and pattern-based strategies try to forecast what price might do. Order flow and volume profile observes what participants are actually doing. As long as the market exists, buyers and sellers must transact, and that activity will always show up in volume. In a market increasingly driven by AI, reacting to real participation is more robust than trying to outguess increasing. Oh my God, but English is so freaking bad. Increasingly intelligent systems. You can't hide execution. Order flow and volume profile read what actually happens, not what we hope will happen. And as a extra statement to this, something that I think it was ChatGPT was explaining, if AI comes into the market and it starts to execute, AI doesn't execute based on emotions or fear or stuff like that, right? AI execute based on logic. So the flow of the market, the orders that are coming in might even be like better, like more fluent, like more soft, because when you're having a huge sell-off, people are panicking and selling, but AI won't panic. It will only sell if it makes sense to sell, right? So it might get better for us in the future as well, since you're going to complete this course, understand how to use the volume profile and order flow, and I'm 100% sure when you fully understand it, that you won't go back to anything else. So that head and shoulders pattern that you were trading before, this is gone when AI comes in, right? So now you see like how hard it is. Like, this is not the full picture yet, right? You have to still learn a strategy. You have to still learn order flow, volume profile. You have to still apply it. You have to still take a lot of losses. You have to pay your respect to the market, like I say. And then after a few months or maybe even years, you will start to come up and you will start milking the market. So this is why when someone tells you, when you're beginner and when you're naive, that trading is easy and show you huge amount of profits, and let's say if I had a trade for 500K, I wouldn't be outside showing you my cell phone, right? That would be the most stupidest shit ever, because I know at any point these entities can change the flow of the market. It's very important. So I hope that I've opened your eyes a little bit about how hard it is to actually succeed in trading, because you have the great filter and you have all of the sharks inside of this price action, and not the price action, inside of this moment, this phase of beginner trading. And then this great filter takes out everyone. And then you still have another more advanced great filter. But then when you come into your senses, you will actually start to read the market from a true buyer and seller perspective, which is exactly how auction market theory is actually based and framed on. So next time you see that someone says set and forget and shows you MT5 profits right here, do not trust them. All right. And I really hope that I caught you on level 1. Right? This is level 1. I hope I caught you right here, because if I catch you right here and I make you skip all of this bullshit, all of this phase, that is a huge win for me. That is a huge win for me. So if you go skip this phase, you will come maybe to the ICT route. Maybe the ICT route work for you. Maybe that is the thing that clicks for you, right? Auction market theory and order flow doesn't need to be the thing. But just know, if you are waiting 2 weeks for a trade and you have 100 different rules and you're getting confused, that there is other routes in trading as well that is much better. And take it from someone that has been through all of this bullshit. So don't let the great filter take you out. Don't let ICT, if you go through that route, don't let ICT strategies cancel you either. If you're very smart, if you have critical thinking, if you can see past all of this bullshit, continue with this course. All right. Watch me backtest. I'm not going to backtest hindsight stuff. I'm going to go back and take all of my trades and backtest them. So you can actually see that I'm showing you trades that I actually took, and I can explain them perfectly to you. And it will actually finally make sense. So when you see that, I don't ever think that you will go back to this era, right? And if I caught you on level number 1, or even if you're in this ICT route and I can direct you all the way to auction market theory, my job is complete. And I'm very happy if I can do so. If someone else did this for me when I was starting trading, maybe I would not listen to him. But if I would have done so, I would be forever grateful when I started to become profitable in the future. All right. So with that said, I think this is going to be a lengthy first video, but I hope that you finally understand why the market is super dynamic, why we do have so many entities trading at different times, and why we have to have sharp tools to see what is happening exactly right now, and not based on a pattern that forms after 5 M15 candle closes or M5 candle closes. Very important. All right. All right, guys. If you made it this far in the video, I already know a few things about you. You're serious about improving as a trader. You're willing to put in the work every single day. and you're here because you want to make real money from the markets. Now, to show me that you're truly dedicated, after every lesson, there's going to be an assignment. This is how I see who is actually taking action and who is really involved in the community. I actively reward the members that engage the most in this community with different prizes, and this is not random. Studies consistently show that people who engage the most, ask questions, and participate are the ones with the highest chance of succeeding, not just in trading, but anything they pursue. So I am gamifying this process in a way that will both give value to you and value to others. At the end of every video, you'll get an assignment, and I strongly encourage you to do it. I'll be active in the community, answering questions, liking posts, and commenting on your work as well. So with that said, the prize for today's assignment is that I will personally review 2 of your trades. So I'm looking to help someone level up in their execution this month or week. I will be doing a deep dive video audit of 2 trades for 1 person in the community. And this is how you enter. Create a new post in the community feed titled My Big Aha Moment from the first lesson. So this is the title of your first post, right? Share the number 1 takeaway you got from today's lesson and exactly how it changes your perspective on trading. You must like and comment on at least 2 other aha posts from fellow traders. This is how we drive engagement. This is how we gamify the process. This is how you can see that if you're struggling with an area in trading, that other people might struggle from the same thing as well. And when you guys start to comment on each other's post, you might find your next trading partner. And I highly encourage you that you do this, because you never know who you're going to meet. You never know who is on the other side of the screen. You never know who your next trading partner is. So this community is going to be built for real traders that want to improve. So by liking, interacting, and commenting and writing your own post, this will drive high engagement in this community. And I don't want this community to be let's say a dead community that everybody just takes without giving. So help other traders understand that you're struggling with certain aspects of trading as well. We are all human and we are all on different stages in this trading journey. But most importantly, we are all here to help each other. So let me show you how to actually post in the community section of school. So after you have finished the first video or any given video in the course, you can just scroll down and here you will see your action for today. So this is create a new post in the community feed titled My Big Aha Moment from the first lesson. You just copy this. So remember that you have to give 1 takeaway from today's lesson and exactly how it changed your perspective on trading. You must like and comment at least 2 other aha posts from your fellow traders. So you can just simply search for this My Big Aha Moment title in the search bar and you will see your fellow traders posts. So here you can also ask your questions about the first lesson. But with that said, go to the community page. Here you can write something. Go right here, post this title, and here you can write, now I understand how powerful order flow is. And then you select your category. So post it in the main hangout so everybody can see it and just send. Easy as that. You can even create a poll. You can put a GIF, you can put the image, whatever you want. But here, this will be posted here. And I will be highly active. I will answer as many of these posts as I can, and I will like as many of these posts as I can. And if you have other questions regarding the lessons, you can just use the pinned, if you go to the classroom right here. So currently I'm building up this course right now, but every single page has a comment section right here. So if you press this and then you can write your comment, and here I will be very active in answering all of your questions. So I hope it's clear, and I hope that you are willing to put in those 5 minutes just to show me that you're serious about trading. Just remember, closed mouth don't get fed. So reach out, communicate, and you never know who you're going to meet on the other side of the screen. So I hope that this was informative. I hope I opened your eyes and In the next one, I'm going to teach you how to set up TradingView. I'm going to teach you how to set up 𝗧𝗛𝗏 and how to acquire 𝗧𝗏. So until then, see you in the next. All right, ladies and gents, welcome to the second video of this course. And this is actually the fun part. We're going to work on setting up TradingView. I'm going to show you exactly what type of indicators you need to slap on to your charts, what type of volume profile indicators that you need. And I'm going to show you even one step more advanced way of doing so, because I don't want to give you just surface level information. As I told you, I will go pretty deep into this, and I will show you actually the perfect volume profile that I use and how you can use it to get a more precise way of reading the volume of the market. And it's very important because the surface level information on YouTube is that you can slap on daily profile, weekly profile, and monthly profiles, but that's not the full picture. Everybody can see those profiles. So if you have a little bit of critical thinking, a little bit of, I will actually show you how to do it further on in this course, but I will start with showing you how to set up the daily, weekly, session, overnight session, volume profile, because those are quite good as well, because you can get a little bit more of a contextual confluence by using those. So why are we doing this on TradingView? Because TradingView is very intuitive, right? I've tried a lot of order flow softwares, and the order flow software that I use is 𝗧𝗏, and that is the most intuitive order flow software, but it doesn't mean that it's intuitive enough, right? TradingView is a very light, how can I say it? Is very lightly built for Windows, at least, I guess for Mac as well. And it's very intuitive. I can switch the time frames very quickly. And the volume profile on the TradingView, like how I use the volume here, it's good enough. Maybe if I want to go super deeply inside of an area of price and look for the volume exactly on the tick, no, it's not good enough. But if I want to get a general picture, if I want to use the volume for context, it is actually very good. With that being said, there is also drawbacks to TradingView, because TradingView, the volume TradingView displays, is based on how many ticks a candle goes up, how many ticks a candle goes down. So with that being said, TradingView cannot be connected to real CME data, real level 2 data like Rhythmic, DXFeed, and so on. I've seen that TradingView offers real data, but to my knowledge, the data is still not real, because TradingView doesn't read volume based on, like if you remember the last example, if you have a buyer here, when he transacts with a seller, this equals one volume. So this is how real order flow data counts volume, but TradingView counts volume if the candles goes up one tick or down one tick. So not completely right, but if you were gonna slap a percentage on it, it is about 90%. Yeah, I think 90% complete, like 90% as good as it can get, right? So it is not the best, but very good for reading context, very good for using a software that is very intuitive, and very good. Let's say that you go through all of this course, but you want to only apply the volume profile into your trading because you want to have better zones to take trades from. You don't want to use order flow. You want to just use the volume profile to apply your own confirmation model, so to say. Then TradingView is very good. But once I show you 𝗧𝗏 and once I show you order flow, I'm very sure that you don't want to be without it, right? So with that being said, let's see what kind of a subscription you need to have. And for our way of analyzing volume, you only need the essential one. Here's where you get the volume profile. And this is the only thing that we need. So we don't need anything else. TradingView has footprint charts as well. But these footprint charts, I don't know why they even have it, because the information inside of the footprint chart is completely flawed. It's not usable, all right? Because as I said, TradingView doesn't show you the real transactions. It shows you based on ticks up and down. So what we want to use the footprint for is to see the actual transaction between a buyer and a seller. And TradingView can't do that. They do have volume candles. So if you want to upgrade to an even more expensive program, they do have the volume candles, which is quite good if you're using supply and demand. This is actually pretty good, but I don't use it. So these are the volume candles, and I haven't even changed the colors of it to align with my black background. So as you see inside of this candle, inside of this red, or in this case black candle, there is a lot of volume, right? So if there is a lot of volume but market goes up, it means that there is a buy limit order absorbing all of this selling pressure. So what does it mean? A strong buyer inside of this area, right? So if we just look at the left to this area, so next time price revisit this area, since this, by the look of this candle, it looks like there was a lot of volume, price bounce from here. So you can use this as to make your supply and demand zones, like supply and demand based on candlestick patterns, a little bit more stronger. But just know that this is also based on tick volume. It's not the best kind of data that you can rely on by using, like, yes, if you want to analyze volume and order flow. So with that being said, let's go and see what kind of tools. Like the essential one is, yeah, it is enough. Like start with this, try it for free for 30 days. And by the end of this video, I hope that you will understand how powerful volume profile is. Of course, we're not going to do a deeper backtesting session. This is just on how to set up TradingView, but I might even show you a few, like we can just take the few past days. Currently, it is Christmas time, it is New Year time, so the liquidity in the market has dried up. We don't have a lot of good zones, but still during a bad period of price action, volume profile can be very good. And I can actually show it to you with a few examples here as well. But with that being said, what can we do? So everything that I will explain to you is based on Swedish Stockholm time, right? So what you can do right now, every time I tell you a time, you can either go and set the charts to Stockholm time and set up everything, or you can use this website that is called the time zone converter, and we'll actually post a link of this below the description of this video. You can actually use this website to convert Swedish time to your to wherever you are located. You can convert it to your own time, right? But I'm pretty sure if you're in this course, you know what time London session opens. You know what time CME opens. You know what time the day opens, when the overnight session is, and so on, where the Asian session is. Also, one other thing that is very important, when you're going to use TradingView to analyze volume, you have to be on the future feeds, right? Okay, so you have to be on the future feeds. And also, another thing, use the back adjusted charts. This is a very good thing because my order flow software doesn't have this. So I rely a lot when there is contract changes. So, okay, what is back adjusted? So when there is contract changes, it adjusts the prices so it matches the past contract. Easy explanation. My order flow software doesn't do this perfectly. So TradingView is very good by doing so. So I can, let's say, like we had a contract shift this day. So on my order flow software, the previous high volume node here is here. But since this is back adjusting perfectly, the high volume node might be here. So not to get you confused, it's not something that you, how can I say it? It's not that something that will affect your day-to-day trading. But if you're gonna use order flow, you're gonna use TradingView to analyze context, use the back adjusted charts, and it's very important. I've seen traders not use it, and they don't understand why price bounce from an area because their chart is not showing anything to them. So, all right, time zones, convert it to your own time. Now that we are going to set up the daily, weekly, and session and all of those volume profiles, that's just surface level information that you can find on YouTube. And I told you I won't stop there. I will give you better information than that. So we can actually set those up. They're very good to use. They're good to look at. But the way I'm going to show you in the end of this video how to use the fixed range volume profile. The fixed range volume profile is actually up here. So I've set it to the favorites. But if you go to the left side, here you can find a fixed range volume profile. This is a much better way of reading volume. Because here I can see, but it requires some kind of a discretionary view on the market. You have to actually understand what you're looking at. So, but I will explain it a little bit more here, and I will dive more deeper into it in the future in this course. But yeah, I can actually show it a little bit here as well. So let's start by setting up the daily, weekly, and monthly volume profile. Very important that you're on the CME futures. Okay, very important. Like, choose one pair to trade. Me, I only trade ES 99.5% of the time. Stick to one thing, backtest it, understand it, and then if you want to add more pairs or futures or whatever you want to, or indices, do so. Just know, let's say that you're trading the Euro USD. We will actually talk about it in a future video as well, what the difference between the future contracts and the CFD contracts is. But just know that if you're trading the Euro USD, you can take the 6E futures. All right. But for every example going forward, I will use the ES futures because this is the only thing I trade. And believe me, it is enough. When you have order flow and volume profile, you can find maybe 2 to 6 trades per day on only one pair, or like in this case, ES alone. Also, when you use order flow, if you're just trading the ES, you will get used to how much a large transaction is. Like if I see a 500 lots buy order, I know that, okay, it's quite large. It's like, it's very good size for ES. But if I go and start to trade NQ today, like 500 lots for NQ is like enormous. Like I don't even think that you will see it because, okay, I haven't traded NQ, so I don't know the lot sizes, but I guess like 500 is very, very large. So with that being said, stick to one thing, master it. And once you will master it, I don't think that you would want to watch several pairs, right? Because when I was trading ICT strategies, believe me, let's see if I have it here. No, I don't have it. I had like 12 pairs I was watching. Every 15 minutes, I have an alarm on my cell phone. Every 15 minutes, I was watching 12 pairs to see if I get a confirmation or get an entry. And this is the beauty of understanding how the market works, because you only need one instrument, 3 or 4 tools that you combine and create your own strategy. So based on this, stick to ES, and every example from now on is going to be on ES. So let's start by setting up the daily volume profile. So if you go up to this indicator tab up here, the best thing to set up right now is the session volume profile. You take the HD one. All right. So you can slap on actually 3 of these. I'm going to tell you why 3 of these. So let's remove 2 of them, or let's disable them. Let's go to the first one. So the first one for me on Swedish time, I know that the electronic trading hours, which is like if you're coming for ICT terms, which is the start of the Asian session, starts at this time. And CME closes at this time, Swedish time. You can clearly see that it is set to Europe, Stockholm. And you can just, if I just flip this, you can just copy my settings. You can, of course, you can adjust the colors to what you want. So my style is right here. Width of the box is 100%. A lot of times, I even don't use the value area high and low. All right. But we're going to talk about it more in the auction market theory part of the course. But a lot of time, I even don't use this, but how I like to set it up is this way. So you can just copy this. And as you see right here, let's see. Let's go deeper. So what I like to do, if I want to use the value area high and low feature on this, like the value area high, and we're going to talk about what the value area high is in the future, in the upcoming videos, but it's slightly less highlighted, right? So I see like here is the value area low, it's slightly less highlighted, and this is slightly less highlighted. This is how I like to use it, but you can slap on these lines and you will see the lines here as well. But I just think that it looks quite messy by doing so. And this doesn't give me enough edge, right? Because it is good to use the value area high and low, but what I like to use in the market is zones that will give me very sharp reactions. If you're using value area high, market will around this area maybe reverse, and I don't like that. So let's remove this. So what we have set up currently is the full days volume profile. So we just set up a full days of volume profile. And this is pretty good because you can see in the past day where the most volume was transacted. Like you see right here, a lot of volume was transacted here, market put back to this and dropped. But when I show you how to use the fixed range volume profile, it will even get more clearer. Remove this for now. So now we have set up the full days volume profile. Let's go to the next one. And the next one I'm going to actually set up from the Asian session until, or let's do it like this. Let's set it up from London session. So London sessions starts at 9 o'clock in the morning, Swedish time. And we're going to set it up to 15:29. And this is London Open until the minute on CME Open. And why is this good? Because of course, London doesn't have a lot of, and also this price action is not something good to look at because this was a New Year price action, and we don't have a lot of liquidity back then. But if you just go back a few more days backwards, we can clearly see that the volume profile is building a little bit more. So why is this good? Because if you look at this, all right, you can find actually where there's strong buyers and sellers inside of the overnight or the London session actually is. All right, as you see right here, let me find a good example. Okay, we do have something right here. So you see that during the London session, and keep in mind, the CME opened here. So this is just the London's profile. So once price went out of it, retested this area and went higher. So it retested the area where the London traders were active. Okay, but this is not the best profile to use. I wouldn't bet my life on it. Like this is not something that I use a lot of times, the London profile, but I just want to look at it, right? Because sometimes actually, like look at this. This is the London profile, market went higher, pulled back to this area, right into the point of control and went higher. And if you remember what the point of control is, it is the area inside of the volume profile where the most volume was transacted, or yes, where the most volume was transacted. So we have set up the session volume profile HT for the London session. So Swedish time, just convert it to your own time, set this to your own time zone and use these settings. And the settings for this thing is the same. Change the color if you want, right? And this is the value area high and low. So I've just dampened it a little bit more. And then we go to the session volume profile HT, and this is the best thing. Like we're going to use it for the session. So for the session is 15:30 Swedish time until 23. Okay. And this is going to display all of the volume that was transacted during the New York session open or the CME open. And this is the most accurate volume profile to use for the US indices. Let's say if you're trading the YM, which is the, how was the CFD name? YM US 30, and ES, which is the S&P 500, and Q, which is the NAS 100. So this session volume profile is the best because the most amount of volume is conducted during the session open, right? Because it is a US indice. So this one is very good, session volume profile. So if you just stick to this, if you don't want to apply anything else, the session volume profile is very good. One other thing that I want to tell you, when you are using the session volume profile HD, the lower the time frame that you can go to, the better data it will show you. So if I go on the 6 hour right now, look how messy it is. It like, it's not showing good things. But if I go to like, look at this, like it's not even showing a volume profile up here. But if I go to the M1, see how much clearer it becomes? All the mountain and peaks are clearly visible. So use the lowest time frame possible. I never analyze anything on M1. I always stick to M5. So M5 is good enough as well. And as I told you, this will only show you tick volume, but tick volume is good enough. Look at this. Like you have a high volume node right here. So if you just mark out this area, you don't even need to know where the real supply and demand is, like candlestick patterns of it. Mark out this. Look at the reaction from here. Created a pullback on the higher time frame. Since we were bearish, tapped our area of high volume up here and dropped lower. But I'm going to show you very soon how to mark out this zone even better. Not just surface level information, guys. So then we will use the PVP. So indicators, PVP. Slap on 2 of these. Remove one, go into the settings. So you would want one for 1 week. This is very good to see 1 week of volume profile. So you can just take my settings right here. You can pause the video and take the settings. So of course, all of these is going to be a tick per row volume profile. Everything right here. Nothing like, I haven't done anything special. The only thing I changed, I think this was 30. I changed it to 100 because I want to see this way. This is just how things look. If you don't like the look of it, go with what you like. You can just play around with this a little bit. It's just important that you have the full weekly volume profile. And this is what the full weekly volume profile actually looks like. So when you set PVP up, you have this as well. And this is should set to monthly. So now we have a full month of volume profile. One thing that is very important, the row size should be as small as possible. It is very important because then the TradingView will count every 1 tick. So if you increase the row size, it won't be as accurate as this. So I'm just, for me, I'm just going to remove all of this because I already have what I need right here. I have a full day's volume profile, how I use it. I have the weekly and I have the monthly. But as I told you, most of the time I even don't use this. I have my own way of reading the volume profile. This is like trading with, you know, when you are like cycling, when you're small, you do have those stabilizers on your tricycle. This is like trading with this. And also think of it, right? If you're going to win inside of the market, if you're going to take a winning trade, someone has to lose in order for you to win, right? So if everyone can use the same tools, like it's very easy, just go up here, slap on the tools, and you will see exactly where the volume and everything is. If everybody can see the same information, then of course, not always it's going to be the best tool that you can use, right? So therefore, we have to put in a little bit more effort into our way of, how can I say, analyze the market. You have to be a little bit smarter and adjust the tools to what we want to see. So what do I mean by that? And don't get too overwhelmed right now, since we are going to have deep backtesting sessions in the future of this course. You're going to actually understand what I'm doing. But let's just take this price action, this past few days of price action. So, okay, so let's remove it right here. And keep in mind, this is 29th of December. We don't have anyone trading at that time, but we can still use this. Doesn't matter. So what I like to do is I like to use the fixed range volume profile. So go here, put it on your favorite. I have the fixed range volume profile. So let me just draw it, go into the settings. So you can copy my settings. So tick per row size 1, style, whatever you want to do. I go with the Swedish flags color. It just looks very good. So what I like, when we go to the auction market theory part of this course, you will actually understand why I do it this way. So the way I do it, I just look at my chart like this. I want to see what area we have spent a lot of time and candles inside. So if I look at the charts this way, I see that a seller, I hope that you can see it. Let me just see if I can zoom this in, because the problem is with my screen that I do have a very large white screen, and when I upload this video, it's going to be a slightly smaller screen like cinematic view. But let me see if I can zoom this in. So I can clearly see here that this area tapped the area of supply. And we can actually go and later on look what area of supply. Market gap down and someone was selling these highs. So a strong seller came into the market. Market came down, seller sold. Price tapped the area to the left. We can actually check what area it was. It went higher. So I know inside of this area, there should be an area of high volume. There is a lot of different entities transacting inside of this area. An easy way you can do it, this is how I tell all of my students to do it until they get used to it. Always mark the leg in to the leg out. Okay, so what is the leg in? So you take this fixed range volume profile. You see, this is the leg inside of this. Okay, so mark the leg in. Where's the leg out? Market came all the way here. This is here. So where is this leg out? I guess it's here somewhere, right? So market is all the way up here. So now, instead of using the daily, weekly, and all of those volume profile, let's actually slap this on. Let's see how this looks. This one actually starts a little bit too late. It is not as accurate. Let's see the monthly. So it depends, right? So let's say, okay, let me explain it this way. If the leg in right here, the leg in I want to see, because I see that inside of this area of price, think of it as price points, like from 6,920 to 6,771. There was a lot of transaction, a lot of buyings and selling that went on, and in the end, market went higher. So it means that if market went higher, we do have areas of demand here, right? So the leg in on this was on a Friday, but the weekly volume profile actually started on a Monday. So therefore, maybe you don't get the full Friday's picture if you don't take the anchored volume profile. So let's take the anchored volume profile. Perfect. We have two areas. Let me remove the habit from here. This is good. So what are the areas that are interesting to me? And we will talk about it deeper when we go deep into the volume profile. This is just on how to set up TradingView, but I just want to show how perfectly everything lines up. So we have this area that is called the shelf. It is the outermost edge of this volume. And then if we zoom in like this, where do we have? We have this high volume node. So let's see how price reacts to this. So we have two areas, right? We are not even applying any other supply and demand strategies. So we have these two areas. What more is interesting? So another way to do this as well, since we measured where we have the largest amount of candles or transaction, or where, in which area of price where we have the most volume transacting. Another way to do it, which is very, very, very good, and this is also another thing that I teach my students, is to measure from the lowest point to the highest point. Why is this good? Now, in this case, it will show the similar price action. And as I said, this is New Year's price action, so the volume is not the best thing to read because the liquidity in the market is not high enough, but still we can use it. Why is this good? Like an easy way to explain it, let's say we had a lot of sellers going on here. So let me remove all of this volume profile so I can actually show it to you. let's say we had a lot of sellers inside of this market. We were extremely bearish. Something happened, a catalyst happened. Let's say market came to an area where everyone decided that, okay, it's not even worth selling anymore. The prices of this asset is cheap right now. So now it's worth start to buy. Okay, so if these buyers are stepping into the market and lifting the auction higher and higher, buying in higher and higher prices, maybe the sellers that sold here, they are keep selling. Look at this. We come to this area, poof, quick move down. Then the buyer still think it's cheap to buy. They keep buying, they keep buying, they keep buying. In the end, sellers give up, buyers take the market higher. And therefore, the buyers that broke out of this whole range are very, very strong. You can actually see that they overpowered the sellers. So the buyers are strong. And where are the buyers present? Of course, in the leg, from the leg low to the leg high, where we broke out of, right? So you can just measure this area as well. So you can mark few areas based on this. So a few areas based on this. I don't know how valid this volume profile is going to be because this high volume node was on Christmas Eve, I guess. But let's mark it. It looks like someone on the closing of the session dumped a lot of contracts. I don't think that this is going to be a very good, but I don't want to overcomplicate this. We have this area. We have this area, two high volume nodes, right? Then we have this, and I'm going to mark with this. Then we have this high volume node. So just to circle back a little bit, we're going to dive more deeper into this, a lot more deeper. But if you measure this way from the leg in to the leg out, you see the full picture. If you measure from the low to the high, you can actually see where the strongest buyer inside of this leg of price is. And it's very important because these are the buyers that lifted the market or the auction higher. Very important. So we have few areas here. So let's see. So what I'm expecting right now, if I do it like this, and all of this is going to be explained to you step by step. I'm just want to show you how to use the tools, a little bit of a preview right now, but all of this is going to be explained to you step by step. So don't feel overwhelmed right now. So let's see how the markets reacts from these areas. Coming to the first level of interest. Let's see if we get a reaction. So I might even clip this so you don't have to wait. Okay, so we are approaching this first area that we marked out. So let's see how and if we get a reaction from this. Okay, small reaction, and this is during the Asian session. And this is basically the 31st of December. It's like the day of the New Year. So I don't think like we do have banks and institutions trading this day, but still, I told you like the volume profile doesn't care about time. We don't need to come up with a lot of excuses. The volume profile never lies. But we have to put a little bit more logic to it. So let's see if we get a reaction. And if we don't get a reaction, I know why. I'm going to explain it then. So we get a small reaction during the Asian session, right? So where can we actually react into? Let's measure it. And how can we actually measure this? Measure from the high to low. See where the most volume was transacted. This whole area, it's quite a huge area. But what it looks like to me is that just because of it is the end of the year, every institution and bank and whatever are rebalancing their books and closing their books, right? So they are just offloading and closing everything for the new year to come. So yeah, I think this is not a good area as well, because look at this. This is basically the end of the session, end of the CME session. This is the Asian session. It's the end of the CME session, and inside of this price action, they were also closing the books. It's like 2 days before Christmas Eve, but still, let's see. We do have the areas mark, and if we don't get a confirmation, we don't trade. So I don't think I would have traded this because this is when I was sleeping. Let's see. what happens? No, doesn't go there. So it looks like the sellers are strong because they are breaking below areas of very good demand. So this is a way to understand that we are bearish as well. Breaking below, let's see, next area that we come into. Okay, let's remove this. Where should we go into? Since we have new data, let's take this, but there won't be a lot of liquidity or volume during Asia, but let's measure it this way. So if we are coming from a high volume node right here, let's actually, you can actually measure it again so you can clearly see. Let's measure from the leg low to the leg high. Exactly what we are doing. We are measuring the high to the low right there. And here we are measuring from the low to the high. We are seeing that we have a volume peak right here. So taking this full volume peak, we are seeing that we have something that is called a shelf. You can even mark the full volume peak, but based on my experience, it will react to where the most volume was transacted into this right here, or the outermost edge, which is the shelf. This one, since we don't have a lot of volume, like it's not poking out right this, I think we will react from, yeah, maybe even here. But let's see. And then we have this one. I don't know if this is, we don't need to mark out everything. I just want to show you how to mark volume profiles on this. We're going to go extremely deep during the backtesting sessions, and I'm going to dive deeper into these concepts. I just want to see how you can spot real supply and demand zones inside of the market quickly. So measure high to low, low to high, to see where the real demand zones inside of this leg is, to see where the real supply zones inside of this leg of price is. So if you are reacting from an area of demand, you can take a buy trade here. I would probably trade it to this area. Yeah, this is the safest area to trade. So let's say that you take a trade from here based on a confirmation. And of course, I'm not using order flow, and so I don't know. My confirmation model during London session is usually 3.75 pips of, not pips, ticks of stop loss. So this would, let's say 4, just to be conservative. Something like this. So this is a 3.75 R trade for me. If I would have taken this, I don't know if there was a confirmation, none of that, but we are just assuming. If I'm taking a buy trade here, my target is here, where the next area of high volume starts, a shelf. All right, because look at this, a lot of volume transacted here. Same thing here, a lot of volume transacted here. So I'm guessing the buyers inside of this zone are very strong, and I'm guessing the sellers inside of this zone is very strong. Of course, we can always go deep into the volume profile, but the areas that we should react to, and we will talk about it deeply in the volume profile session. Let me zoom in. The areas that we can react to is the shelf on the lower side. It is the shelf on the upper side, and it is where we have the most amount of volume, which is this. So I can even keep this marked out to see where we react to. But the safest target, if I'm taking a buy trade, I don't know if we're going to go here. I don't know if we're going to go here. I know the safest target is here. Or since I know order flow, I can watch the order flow and see what happens when we come here. Do we have more? Are the buyers willing to accept higher and higher prices and keep bidding the auction higher? Or is this the end? So this is the benefit of using order flow as well. You can actually know how to exit. So let's say we take a buy trade from here. It is coming from this high volume node. It's very clear and visible. Look at how big this high volume node is. This one wouldn't give a, like, it's very unusual that we see such a large peak at the end of the session. So it looks like a rebalancing area. Even with this very large peak, I think it's because of it is the end of the new year. This one didn't even give like this high volume node. Like, look at this. It is exactly the same. End of the session, huge amount of volume. When we come to it, no reaction the next time. Same thing here. But this one looks unnatural. This is the wording that I want to say. This looks unnatural. These look quite natural. This one especially, I think this is a very good one. This, of course, this also. So let's see. This looks on the brink of unnatural as well. It looks like there is a lot of volume. And why do we have this? As I explained several times, this is the end of the year and people are most likely rebalancing their books. So let's see, if I would have taken this trade right here, 3.75R, let's see if we get a profit on this. Okay, going higher. Let's see where we go. Oh, snap. Look at this. This is why it's so good to watch the order flow right here when you're approaching your target. But me personally, especially if it's London, I would have said take profit there and walked away. That is what I would have personally done. Okay, coming higher to the point of control of this high volume. So let's see if we get a reaction. All right. So this would have been an A+ setup for me to short if I was trading this. I wasn't actually trading this because I was actually building this course. I wasn't trading all of this price action. So basically, this is not even hindsight stuff for me because on the 18th, I stopped trading. On this day, I stopped trading. So all of this is new price action to me as well. So I'm just drawing the volume profile and showing you live, so to say. So, okay, coming to this area of supply, sellers stepped in, sellers are strong. Let's see if we break this area, then it means that we are extremely bearish. Okay, coming lower. So do you see inside of this area's price, there is an area of low volume. No one or nothing is transacting inside of this. The only problem is that we have a gap and we can get a sharp reaction from the gap. But looking at the volume profile, this is how you know, like if you take a sell here and you clear this high volume node, there is nothing in between this area. This is what I call, I have a playbook for this called a path of least resistance. So if I would have taken a short right here, maybe I would even take a short from this area. Yes, from this area. The target is clear. It can't get clearer. So as you see, we're entering based on the volume profile confluence, based on the point of control, based on how this profile looks on the left. If we clear this area, we know that nothing can stop price until where the next volume starts to peak. We can even mark it, include the peak as well. So let's see where we go. Maybe I will pause it if it takes long as well. Okay, to this peak. Okay. It was also the end of the day. What day is it? Is it 2nd of January? Okay, so somewhere here, I think. Yes, it looks like it. Because when you start to trade the volume profile, in the end, you will see where the strong buyers and sellers are. Now I see that we might turn around here. Why? Look at how much volume there was inside of this area. Look at all of this. Look at all of this. Look at this. Strong selling going on. So I think inside of this area, we will have, okay, maybe not. Okay. Inside of this general area, you see a lot of candles conducted here. So higher amount of volume. Yeah. It's not showing perfect data. Yeah. We have a low volume node right here. Okay, good. Let's go. Where can we drop to? Came to this one. So this one is already tested. I'm not saying that it can't give a reaction, another reaction, but it is tested currently. So the next untested one is this buyer or this. So let's mark this out as well. Why am I missing this tool? This area is good. I would mark this whole thing. Of course, I do have other tools to refine these zones even more, but just for the sake of this video, I will just show you how the volume profile looks and how it works. So let's see. Let's zoom in. Okay, we're building a lot of volume here as well. Building a lot of volume here as well. Let's see if we react to this. Okay. There is a supply here. It says we are bearish. Okay. Okay, it looks good. It looks good. So based on this, we reacted to this high volume node as well. Like, you don't need to look at this. If you take a trade from here, let's say with a 5-point stop loss. 5-point is, it's like, it's not huge, it's not small either. Let's say you target this high. That's a 5.1 hour trade. So I don't need to guess if you are going to go to this side, but let's actually see. Let's see where we should go to. Let's measure still leg up to leg down this area of high volume. So I would have, doesn't look clean, like it looks messy. Like you want high volume nodes that are very sharp like this. But let's say I would have targeted, yeah, I can't even formulate I would say here, exactly where we went into right now. Look at this. This is where the high volume peak starts. This is where we went into. So if I would have taken this trade and I would have wanted a safe target, maybe I would have targeted here. But yeah, I'm not holding trades for so long. Either way, to sum everything up, I just showed you how you can use the volume profile. Instead of using the daily, weekly, monthly, and so on, let's say if we would have used the full days session volume profile, yes, in this case, it gave a reaction right here. But the next reaction, this one, like look at this one right here, this reaction right here, you wouldn't see it on the daily. How, like there is nothing that is indicating that we have an area of high volume right here. But if you draw the volume profile from the low to the high, now you will see a high volume node right here. And this is why we tapped into that and started to go higher. Of course, since we are bearish, this is slightly a pullback on the higher time frames, and we should go lower until we see that the buyer starts to break higher, and then we know that we went bullish on the higher time frame. Either way, this was again a lengthy video on how to set up TradingView. It was also a snippet on how to use the volume profile. What I wanted to highlight the most, I didn't want to just give you like, okay, take the leg low to the leg high, and this is the zones. I wanted to show you how it actually works, how good of a reactions that we can actually get. And we're going to dive even more deeply into the volume profile session. I'm going to show you what the low volume nodes are, what the high volume nodes are, where the point of controls are, where the shelves are, and what areas of the volume profile that you have to use as confluence, right? Because we are not just marking everything. We're just marking specific areas in this volume profile. The thing that is very important to you, use the daily, weekly, and so on, but just know like inside of this price action, let's say I was trading right here, inside of this price action, what I want is to know where the sellers stepped in and where the buyers are stepping. Let's say I'm taking this. Look at this. I'm taking this area. Let's remove some candles. Let's remove from here. So okay, let's say market is here. I'm looking for this area. So where is the levels of interest inside of this? I see that we're not transacting a lot below this. So this will be an area that is a shelf. Okay, so we're not transacting much here. Market goes lower, quickly gets bought up. So it means that there is a strong buyer present here, right? So if it gets quickly bought up and there is a shelf here, the likelihood of us dropping here, let's see if we actually do so, is very high, and we should go higher, at least to this high volume node. So we can, let's do the same thing. Next area. So why the volume is tapering off like this is because we do have strong buyers buying up the lows quickly. So we don't spend a lot of time nor volume at that low. And now we have a high volume node right here, and then we have a shelf right here as well. So let's see. So as you see, instead of using the daily and weekly profile, I drew from the high to the low all the way to this area. Let me draw this again so you can see how I did. So I drew from the high, incorporated the low all the way to current price action. Now I can actually see on the volume profile where the levels of interest are. I can also see that we do have a low volume node right here, an area where price traveled to quickly. I can mark that out. So based on this, I have 4 levels. Let's see how market reacts. So I'm just giving you a preview. This is a setting up TradingView, but I can't show you one thing without the other. If I don't show you how good volume profile looks, maybe you won't go and watch the next videos, right? So let's see. Do we see anything else? No. This looks quite messy, a lot of volume. This looks very good, a sharp area where we are dropping off. A lot of volume right here, a sharp area where we're dropping off. What did I do? And we have a low volume area that is also very good. So let's mark this out. And now let's play and see. Buy. Okay, giving a reaction. Not buyers are strong, coming down. And this is also another thing. Very good that it happened right now. If the buyers manage to break out of this area, this is your resistance now becomes support. Look at this. Once was a resistance. You can clearly see it was a resistance. We get a reaction from it. But when the buyers broke above it, look at the pullback. Do you see that? This low? Right here. So this is resistance now becomes support. So, okay, coming to this low volume node, reaction to the same area again. Low volume node, let's see where we go. Coming lower. Yeah, let's not backtest fully. We're gonna do a deep backtesting session, taking all of this into account, showing you everything, combining everything in the end of the course. But just know, like you saw it right here, right? Reaction 1, reaction 2. The sellers weren't strong, market went higher, pulled back to it, went higher. Low volume node came down to this area. So you see that these levels that you're going to mark out using the volume profile, especially the anchored one, is going to give you very good reactions most of the times. Nothing in the market is 100% certain, but with experience, you will actually start to see. Okay, let's see here. Measure. I can clearly see that this area is very good because it is the CME open. Let me explain this. So based on the candlesticks, I can see that this area is very good. This is something that I call a B shape as well, but I won't teach it in this course, not to confuse you. But I see that this area is very good. CME open, a lot of transactions between buyers and sellers. In the end, buyers lifted the auction higher. It took the market higher. So if I'm going to mark out this low to, let's say, up here to this high. So we have this peak right here. So I would mark let's see. Yes, that is exactly where we went into that, started to go higher. See how perfectly this works? One other thing that, like, this is a very good example not to use TradingView. It looks very messy because I'm measuring a specific area of price. And another pro tip, if the London session, you see this white box is the CME open. It is the first hour. It is the initial balance of the CME. More on that later. But if the London session overlaps with this, the volume profile on TradingView will get quite messy. All right, because we get a lot of movement on the session open, and pre-session open, there isn't a lot of movement. But yeah, right here, that was that zone. And you can do it like this as well. Measure from this low to this high. And now you can clearly see it a little bit more clearer, okay? So you can even do stuff like this. So we have, this was even more clearer. Look at this. I told you, shelf where the volume is tapering off. Mark this where the volume is tapering off. Look at this reaction on the tick, right? It went higher. I think there was a trade. Yes, I was in this trade. Yes, I remember this. I was in this buy trade. I actually closed it a little bit early. Was in this buy trade for a 3R. Yes, I remember now. So look at this. Volume is tapering off right here. Market, boom, went higher. And why? Let's use the daily volume profile. So I just want to see how different it is to use the things that, like in this case, based on this, is it as clear? I guess like in this scenario, it would be. Look at this, where the volume is tapering off. It is the same thing. But let's say that we overlapped somehow and the day started at a very bad time. So this wasn't clearly visible. So this is the benefit of drawing your own profile from the low to the high, and it will become much, much clearer. So the thing that I see that most of the order flow and volume profile traders do, they do have a lot of indicators, and in the end, the charts looks something like this. Like it's gonna get super messy. And this is without them understanding the logic of what they are using. They're just slapping on indicators and saying, okay, yes, we should react to here. Of course, we can react to there, but let's see if we did so. No, we never came there. So yeah, you see it looks very, very messy. But if you actually can see what areas in price that we conducted business in, let's see if we can, like, let's see if we can find something. No, it's too far back. Let's do like this. We will go deeply into this subject in the backtesting sessions. I didn't want to make this lesson too complicated. I just wanted to set up TradingView correctly. But with that being said, if I just show you to set up TradingView without showing you why you need to set it up, maybe you would have not watched the next video. So now that you see how perfectly the volume profile is giving reactions, now that you can finally see how sharp of a reactions that we can get, now you will watch the next videos, right? So in the next one, we're gonna set up 𝗧𝗛𝗓. And 𝗧𝗓𝗓 is the professional order flow software, and there the volume profile is much, much better. Much better. But use TradingView as part of your context analysis. Use TradingView to get a very good bird's eye view on how the charts look. Use TradingView because it's the back adjusted contract changes. Bottom is very good. Very pro feature. Use TradingView to get a general picture of what is happening. So with that being said, let's see right here. Look at this, high volume node, market tapped into it, went higher. So yeah, you will see a lot of these examples. So I think it's going to be quite fun for you when you end this video and you will go and see, okay, where did this tap into? Okay, let me measure this. High, low, okay. High volume node, tap, drop. So you will see like many of these examples actually in the chart. So now go out and play a little bit, or stick around until the end of this course, and I will do deep backtesting sessions and explain everything in detail, and you will understand it even better before going to start practice it yourself. All right, guys, it is that time again. We have to do today's action, and this one is going to be a very fun one to do. This is going to show me that you understood this lesson correctly, and it will give me a chance to actually correct your assignment so we can be on the same playing field moving on with the course. So what do we have for today? I will personally correct your assignment. So what you have to do is to create a new post in the community feed titled My Anchored Volume Profile. So exactly like I shown previously, just go to the community feed, create a new post with the title My Anchored Volume Profile. This way, when I search for this keyframe or when I search for this keyword, I can actually find all of the posts that you guys are posting. With that being said, next you have to mark two different volume profiles using the anchored one. One is from the leg in to the leg out, exactly like I showed in this video. You don't need to mark any zones in this, just mark the volume profile. All right, we will take this in steps. And then for the next volume profile, so you will have to attach two different images. So one from the leg in, leg out, and the next one from the swing low to the swing high, which means from the lowest point to the highest point of a leg of price. With this one as well, you don't need to mark any zones. So this is actually leg in, leg out. As you see, I've marked it from this leg in all the way to this leg out, all the way up here. So this is the volume profile that it gave me. And then for the next one, swing low to swing high from the lowest point to the highest point of the chart. And this is the volume profile that it gave me. So this is your assignment, and take this chance, please, because now I will actually kind of mentor you, give you guidance on what you're doing correctly and what you're not doing correctly. So take this chance to actually post something in the group, and you will see how valuable this is when other people is starting to also help you mark and use the tools better. Not only me, but other people that have more experience with this as well will also chip in and comment on your assignment, and that way we can actually increase the speed on the journey to your profitability. So with this guidance, I'm setting you up for the best possible roadmap towards you becoming a very good volume profile trader. So take this chance, do the assignment, and just post in the main community, in the main hangout, and I will actually correct it myself. So that is it for this video's assignment yourself. So until the next video, talk to you then. There we go. It is time to set up 𝗧𝗛𝗓, which is the professional order flow tool that I use. And I've tried multiple tools like Sierra Chart, Motive Wave, Quant Tower, Deep Charts. Yeah, all of them. But basically, 𝗧𝗓𝗓 is the best one. And it is the one that I like the most. It is the one that is the most intuitive, and it is the one that has the best big trades indicator possible. And I'm going to show you why the big trades indicator is such a cheat code in the market. So with that being said, there will be an affiliate link below this description of this video, but you don't have to use it. If you do, I appreciate that. You will support the cause, but it's not even necessary. Just if you don't like me, don't use it. Who cares? Either way, these are the tariffs, and this is how much it costs to have a professional order flow software. So keep in mind, you don't need TradingView, but the way I use TradingView is for context analysis and nothing else. So it's up to you. If you want to go with only 𝗧𝗓𝗓, it's enough. You don't need TradingView. Like, you don't need multiple softwares. If you're gonna choose one, choose 𝗧𝗓𝗓. So you can absolutely try it out for free right here with the starter plan. And here you will get real-time access to the crypto exchanges, but the futures data does have a 15-minute delay, and this is not something that we can work around with. Like, you can't have 15-minute delay, right? You can't even have like 1 second delay almost. The Plus program has also a 15-minute delay, so what you have to buy is the Pro version or the Ultra version. I personally have the Ultra version, and the reason for that is simply, if we scroll down right here, for the Pro version, soon, not currently, but soon they will release 30 days of history, okay? And this indicator, I will show you the power of it once we go into 𝗧𝗓𝗓. It is super powerful. So why I went with the Ultra version is that soon they will support 90 days of trade history. Of course, there is a workaround for this as well, but it is like, if you have the 90 days, it's gonna be super good. But keep in mind, currently it is only 7 days. So currently they don't, like, if they don't change this to 30 day or 90 day very soon, then the Pro version, like, it's enough. You don't need all of the fancy indicators. You don't need to slap on 100 different things. Like, the way we trade is simple. Volume profile, order flow, let's go. Like, not a lot of 100 different, we don't need to plot 100 different indicators. So with that being said, try out the Pro version or the Ultra. If I were you, I would go with the Pro version, especially for 1 year or even 1 month. It doesn't matter. Try it out. This is going to be a very good order flow software. But what you can't do is go with the Start or the Plus. If you're trading crypto, of course you can do that. But if you're going to trade futures, then you can't do that because the data will be delayed 15 minutes. So with that being said, use the affiliate link if you like. If you don't use it, simply. Okay, so once you have purchased 𝗧𝗛𝗧, you would want a level 2 data feed as well. So with all order flow software, you purchase the software and then you purchase the data feed separately. And then you connect both. So what is a level 2 data feed? So this data feed enables you to connect to the exchange of the future contract that you're going to trade. So if I trade the E-mini futures, I will connect to the CME exchange, okay? And this level 2 data will show me every buy and sell transaction in real time. So this information is available to everyone. So this, I hope that you're going to see how powerful it is to see every transaction in real time. This is a very powerful tool to use. So with that being said, there is few different routes that you can purchase this data feed. And by far the easiest and the quickest way is that you open a prop firm account, let's say with TopStep or let's say with my funded futures. And I've personally not checked every prop firm if they offer level 2 data, but I know that TopStep and my funded futures actually do. So these both prop firms are very good future prop firms. So with that being said, you would want to start to trade this, right? Once you learn the full strategy, you will want to execute in the live markets. So my recommendation is to open a prop firm with TopStep. And this is by far, to me, the best prop firm that there is right now for futures. So you open a 50K account, take very small risk, risk $100 to $200 per trade, and try to understand the strategy fully until you go all in. You can buy multiple accounts in the end. This is what I do. I buy multiple accounts. Maybe I buy 5 50K accounts and I copy trade all of the trades in between them. So if I risk like $200, $250 on one 50K account, it's going to get multiplied by 5. This is how you're going to scale your profits into the market. But to start with, buy one and practice. And also purchase the data feed from TopStep. And once you have done so, you have to go into 𝗧𝗛𝗧 and connect it. I will show you how to do that momentarily. With that being said, me personally, I have my level 2 data, which is from Rhythmic. And this is another thing, TopStep and my funded futures, I think they have DX feed. It's not gonna matter a lot for you, but me personally, I have Rhythmic and I do have a personal account with AMP Futures, but I used to also have one with 𝗙𝗓𝗄. So in my Discord community, I do have a tab called Software Resources with a lot of information. And inside of this, I have an instruction on how you can create a personal account on a future broker. So with that being said, let me just zoom this in so you can actually see what this so you can actually read it. So I've taken a print screen. Now we zoom this and here you can take a print screen of the screen and read the instruction on how you can open a brokerage account, deposit money and go with that. So I know that many of you people will like to trade don't like prop firms and will want to trade personal capital as well. So this is the route and this is for 𝗙𝗓𝗄, but me personally, I've moved on to AMP Futures. So with that being said, there might be even one more possible way to get the data feed. For you guys that trade Bookmap or have the Bookmap application, I know that you can buy the data feed from them as well. But what I don't know is if you can connect it to both Bookmap and 𝗧𝗛𝗧. So with the Rhythmic data feed that I have, I can connect it to both Bookmap and 𝗧𝗛𝗧. And keep in mind, you don't need Bookmap. You will have the big trades, and I'm going to show you exactly how you can use the big trades to skip Bookmap completely. But me personally, I have it, and I'm not going to teach exactly in this course how to use it. It's in the full academy, but I have it. Either way, with that being said, let's jump into 𝗧𝗧𝗧 and see how we can set this beautiful software up, and you will see how game-changing this is actually. All right, so now that you have the software open, most likely it will look like this. So how do you actually set it up? So let me show you just some basic stuff. If you go to home up top and then you press charts, you can just go to all instruments, search for ES. So now you will get all of the E-mini contracts. So the easiest and the best one is the continuous one. So it will continuously update the contracts. But for whatever reason you want to go back one contract, here is all of the contracts from the past and the future. So just take the continuous one and put it in your favorite. If you want NQ, just write NQ. So easy as that. If you want gold, GC. There is also a table in the course on how you can convert the CFD names to futures. So look at that if you are confused. Either way, this is the software. So what we want, charts, we want to open one ES chart. So now we have one chart open. Now we can take this and drag this like this, and you will see a table right here. We can place it in the middle to make this bigger, or we can just take it out again. Let's say I want to place it on the left side. Now it's not going to work. I'm going to place it in the middle again. Then I'm going to open one more chart. So I'm going to open one more ES. And then I will take this one, place it on the right side. So on the right side of the table, now I have two charts. Now I can open one more chart again. And I can place it. Oh, not this one. Getting ahead of myself. I can place it below this. So now I have two charts here, one chart here. So now I can have this at M5, I can have this as M30, and let's say I want this at H4. Okay, so these are my charts. So this is how I can do it. Pretty basic, pretty easy. But with that being said, the easiest way that you can go with this, instead of spending a lot of time and adjusting all of this, just import my template that is provided free in this course with one little small catch. That small catch is that you have to be active in the school community, okay? And if you have been doing any of the assignments by now, you should already be level number 1 in the school community. I think it requires you to post like 1 or 2 posts or like or comment 1 or 2 times, and then you will unlock that level 1. So with that being said, download, comment a little bit, be a little bit of, start to engage a little bit in the community. And then proceed by downloading the template, save it on somewhere in your computer that is safe. And then let me show you how you can import that template. All right, so you would want to go to Settings, Workspaces, and now you will get this Workspaces window right here. And then here you will go to Import, and then you will go to the folder that you have saved the template, and then you will import my template. And once this is imported, I won't do it now because I already have this template. Once this is imported, you will get a question about if you want to save this current workspace. If you do want to save this, because this is your beginner workspace, go ahead. But if you don't do that. So let's load my template and I will get the same question right now. Proxies FX load. Okay. So I'm loading it. So in the current workspace of Active, do you want to save blah, blah, blah? Yes. So I'm going to come back when it's finished loading. All right, so now it has finished loading, and this is how it looks. This is my main window. On the right here, we do have the footprint chart, and I have different footprints at these lows, okay? So this is how I set up my footprint. I haven't copied anyone else, and this is the information that is valuable to me to have in order to trade a footprint. So I won't go deeply into the footprint chart in this course, but just know that this is the footprint chart. You can just either close this window completely or just move this to the side. Okay, so now you will get the full screen right here. So with that being said, I will have it like this, or let's say I will have it like this, it doesn't matter. So now I have the full screen. Also, when loading up my template, you will get multiple windows. So here is the depth of market, Smart DOM. It is called on ATAS Smart Tape. And here we have, this is, yes, is it called Smart Tape? Either way, I don't care what it's called in ATAS. This is the depth of market, the DOM, okay? And here we have the Smart Tape. What is the Smart Tape? Here we can see all of the orders coming in at this current moment inside of the market. Currently, we are in the London session, so it's a very low volatility. So you're seeing that 3 buy orders came in here, okay? And 2 buyer orders came in here, 6 seller came in here. So you will see that this is also ticking faster with the orders that are coming in. So when the New York session opens, this will tick a lot, like a lot of orders will come in. And yeah, and here you can see the speed of the tape. And this is one pro feature of Atlas as well. I haven't seen this in any other order flow software. With that being said, I mean that this blue ticking line, I haven't seen this on any other order flow software. So if you want to see if the volatility in the market is high, like if I would have taken a trade right now, I know that, okay, like no one is trading, right? If I take a trade right now, if I'm 100% sure of my analysis, and keep in mind, I do trade a London session, I know that this is like, I take this trade and go and eat breakfast. I don't need to look at the charts because it will take forever. Like yesterday, I took a trade during London. It was a waiting game. So it took several, like 2-3 hours before that went into profit. I will actually show you that trade because we can actually see how the big trades are popping there. Either way, very good, smart tape. This is every single order coming in. But what I have in my template right here, this other one, this just shows if an order over 200 lots come in at the one time. So why do I have this? Because I want to see the biggest fish in the market stepping in. All right. And then if you start to hear sounds like alerts, those alerts is if, let's say, an order over 250 lots come into the market. Then I have a setting that will sound an alert. All right. So if you hear alerts, some big fish have stepped into the market. Okay. So that is those alerts. Of course, during the London session, most likely we won't have those big orders. So that is why this is empty right now. Also, depth of market. Me personally, I set it up while I was setting up Atlas. It's a good thing to have. But me personally, I don't use it. I know that a lot of scalpers can use it. Like you can even enter on this tool, which is good. You can, like you're seeing the sell limit order, buy limits order. No, these are the sell limit order. These are the buy limit orders. Here, the buy limit orders, sell limit orders. And these are the finished transactions. Okay, so I'm seeing currently prices at 7,650, and there is right like 3 ticks below it, we have 87 lots of buy limit orders resting. So it's good, but what's even better is if you have Bookmap, because there you will see the liquidity resting is much more visually pleasing, so to say. It's much easier to see than reading the DOM. So with that being said, close this window. It won't give you any other edge with the way we trade. We simplify stuff. You don't need to learn all of this number. This is going to make the process harder. But if you're that type of guy that want to learn this and start to trade this, go ahead. Up to you. In this course, we make it easy. I have it because, I don't know even, it looks cool. It just, on the right side, it just goes up and down. Yeah, it looks cool. Either way, no edge in this for me. But a lot of pro traders use this, especially if you're a scalper. Like very small, like super quick scalper. So now let's close this window. Let's see what other windows we have. Let's go with the main window because down at the lows, I have an M30 chart. Okay. This M30 chart, I use it to draw different volume profiles. So now I see that we are inside of this range. So on the left side, I have something that is called the fixed market profile and TPO. So no, not this one. Sorry, I'm lying to you. I have something that is called the market profile and TPO. So I can take this, I can take it from here to here, and I can see where the most volume was transacted. And I mark my zones. If you have watched the TradingView setup video, you know how to mark the zones. And yesterday, I actually took the trade right here at these lows. Okay, so I will show you that trade as well. Let me just show you that on my Discord channel. So this was that trade. Let's look here. From the lows, 3-point stop loss. And I was targeting above this volume high, exited on the tick and market retraced a little bit before it skyrocketed up to all-time highs. Right here, using TradingView to show the analysis. And then I'm going to teach you why I took this trade yesterday and why big trades and why you need to have this software because of the big trades, because that is the biggest cheat code in the market. And looking back at it, I could have entered with two 2 ticks of stop loss at this low and taking the trade higher instead of having 3 points. And here is the reason why I took it, and here is it how it looks, and we're gonna look into this right now as well. So the M30 chart is for my higher time frame analysis. Up here you can change all of the time frames, and here you can remove the candles. You can have it like candles, transparent candles, and you can have it as hidden. The hidden one is pretty nice because then I get a very good picture on how the volume profile looks, and then I can mark my levels. Okay, here we have a shelf combining with the VPOC. It's going to be a very good level to look at in the future, and so on and so forth. For this, let's have the candles. Okay, here right next to it we have a pen. I don't know if you're able to see it because the symbol is so small, but here you have all of your drawing tools, but here you have the magnet sensitivity. This is a very good thing to use, especially for me that use supply and demand, and my supply and demand needs to be super sharp. They have to react super sharply to it. So this is why I want, when I draw a box, that it should hug the candle high and candle low. So this will be a very strong demand for me to look for a trade in the future, because it is also aligning with the shelf. So we have 2 confluences in one zone and also one other confluence, but yeah, we don't need to go deeply into that. Either way, increase the magnet if you like, the more, less, whatever you like. That is just a personal preference. Then we have the indicators. Okay. Now it's not coming up. Or you can just right click, and here you have the indicators as well. So why is not this indicator coming up? Oh, it's coming right now. It was just loading. Here's the indicator tab. What do we have more? We have some pointer stuff, and here are the different templates. Okay, these different templates, let's say that I do something on this chart. Okay, since this is my higher time frame context analysis chart, I only have, let's say, different volume profiles. I have it right here. Don't like, this looks like a lot, but skip this. You don't need to know all of this. I have different volume profiles, right? And then I can go and save this template to settings. Go to the settings, and I save this, let's say, M30 context analysis template. So if I ever lose the settings right here, I just go load this template for this specific chart. Same goes with the M5. So for the M5, I have different indicators. Okay, but since you're importing this, you will get all of the settings directly. And for the M5, I have this, and for the footprint, I have this, and for the M1, I have another template, so on and so forth. So this is how you can set up a chart and save the settings of a chart as a template for in the future. If the software loads without your settings, here they are. And I highly encourage you that if you have your M1 chart with your specific indicators and settings, save it after each time, because I have seen that when you don't close the software perfectly, it can actually mess up this. It can mess up loading your settings. So every time you change something on a specific chart, let's say ES M1 chart, go and save it up here. Take ES M1 chart. Okay, save it as ES M1 chart. Either way, so what do I have? I have the M30 chart. This is for my volume profile analysis on the higher time frames. All right. There is different tools that you can play around with, but the easiest one to take your volume profile analysis is just this market profile and TPO. Okay, and then you anchor it like exactly like I showed you in TradingView. But since you now have the data feed and you have a professional volume analysis and order flow software, this volume is 100% correct. It's not 90, it is 100% correct. And this is how you can find sniper zones in the charts. Okay. So with that being said, let's see, what do we have more that we need to go through? Nothing on the M30 chart. Here I have the different profiles. Okay, I'm going to walk you through very soon how to set up these different profiles. Here for me, I have the VWAP. I don't use the VWAP a lot. I have different initial balances. I don't use it. You won't be able to see it on the M30 chart either. I have the big trace, biggest cheat code in the market. You need to have this. And then I have a TPO chart. TPO, I won't teach this in this course, but I have a TPO chart. You can just remove it if you don't like, but if you are planning on coming into the academy, just keep these settings. On the M5 chart, this is also when I do some, I hate to say it, but some contextual analysis. And here I have different settings as well. Okay, so let's go through all of these settings. And keep in mind, we want to walk through the footprint today. The footprint, like in the academy, I have like 50 backtesting sessions with the footprint showing different execution models and all of that. And the footprint is a very, very powerful tool to use, especially if you combine it with M1 and big trades. In this course, I will make it as easy as possible. I will show you the M1 with the big trades, and believe me, this will put you by far in the top 1% of the traders. So with that being said, so it feels like I'm hyping it up a lot, but you will see in the backtesting session why. I already recorded 2 backtesting sessions, and you will see how powerful those M1 big trades is. And I will actually show it to you right here as well. Okay, coming up from the top to the lower side. The first one, let me actually show you how you can put the indicator yourself. This is important as well. If you right click or go up in here and take the indicators, but if you right click, press the indicators, here is a full list of indicators, and Atlas truly have a lot of good indicators. Let's say we want this absorption indicator. Double click on it, and now you will see all of the absorptions. Okay. So why I took this trade yesterday from this low, look at the absorption coming right here. So instead of when you're a beginner, when you want to have spare wheels trading order flow and you don't know how to spot absorption, place this indicator, make your life easier. Now you will see absorption, and now you will see why I took the trade from here, but I'm going to jump into this very soon as well. So absorption, this is just showing all of the absorption, and yeah, lo and behold, I caught this trade as well, and I will break it down in the backtesting session. This day, also the session low of the day. This day, the daily low of the day. So how can I do it? Because I understand order flow and volume profile. So absorption indicator, very good. I personally don't need it because I've been trading order flow for a long time, so I know what absorption is. And by the end of this course, you will know what absorption is as well. Keep that in mind. What more indicators do we have? We have a lot of indicators. You can just play around with this. And one pro tip is that Atlas has a very good YouTube channel showing all of the indicators. Or let's say that you are going to the big trades. You can press the about right here, more details about this indicator, and it will take you to a FAQ on Atlas website and explain the indicator deeply to you. So play around with the indicators, and these indicators mostly gather their data based on the real transaction in the market, so they are less lagging. So of course, if you're going to take the EMA here, of course the EMA is lagging, but if you're going to use the VWAP, which is the volume weighted average price, it is going to show you a much more, or not much more, it is going to show you the true like VWAP of the market. Not like TradingView, base the VWAP on tick volume. Either way, what you need right now, since you're using volume profile, you can't simply search for volume profile here, because I was a little bit confused when I was and the first time I had Atlas as well. The indicator is called market profile in Atlas, market profile and TPO. So you add one market profile and TPO. Since I already have different ones, I don't want to add one more, but if you're gonna set it up from the ground up, you add it. And for every different volume profile, you need to add one indicator, exactly like TradingView. So let's start from the top one that I have. If I enable this, you will see that my volume profile and volume profile actually have a market profile on the left as well. So if you press to the settings right here, keep in mind, you don't need to be overwhelmed by this stuff. I've simplified it a lot by showing you the anchored volume profile. You don't need to slap on all of the volume profile for all of the sessions, and yeah, it will just confuse you, especially if you're a beginner. And also, the way I do it has a higher edge, and I promise you that. Either way, up here, you have a mode. You can change it to profile. Now you will only see the volume profile. You can change it to TPO. Now you will see the market profile. So the market profile is called a TPO as well, for time, price, opportunity. This shows how much time the market has spent in a specific area, but we won't focus on this in this course. Market profile TPO, you will get both like I have. So let's keep it at that. Also with this, let's go to the settings again. Also with this, you will see the external period. So if I want to just measure the New York session open to the close, I have it set to 15:30 to 23, like 11 o'clock in the night. And you can just convert this time to your own time using the same time zone converter that I showed you in the last video. I will actually post the link of that below this video as well, if you haven't been watching the TradingView setup video. But just convert this time to your time and input it right here. That's a very easy thing to do. So you will get my times when you import the template. Take this time, set that time zone converter to Swedish time, insert those times, and then convert it to your times. Okay, so this is it for the session volume profile. What do we have more? The next volume profile that we have is, if you go to the settings, volume profile number 2 is the day beginning. Okay, it is all the way from the day beginning, like the electronic trading hour open, until 1 second before the New York session open or the CME open. Okay, so convert this to your time. And I think like if you are inside of this course, you know what all of these time zones are in your specific time. But if you don't, comment down below and I will 100% reply to your comment and show you. And then we have the third one, market profile and TPO. This is set to the complete days. Okay, so this is the full daily. So all of these are color coded differently. The blue one is the session. The gray one is electronic trading hour open, or in other words, for ICT trader, Asian session open until 1 second before the New York session open. Third one, what was the third one? Got that. I think it's the London. No, it's the full days one. So this is the full days profile. So as you see, they are color coded differently, so you know what you're looking at. Fourth one, weekly. Fifth one, monthly. Okay. So in the settings, you can change to monthly, weekly, daily, hourly, H4, stuff like that. Up to you, whatever profiles that you want. But with our way of trading, we don't need to rely on a specific time frame for a volume profile. I can clearly see a lot of businesses being transacted here. So I just draw the profile myself. So maybe this starts on a Wednesday and this ends on a Tuesday. So of course, if I'm going to use the daily profile, it's not going to give me an edge. But when I draw the profile, because here I see that the banks are transacting. So I draw the profile inside of the range that I want to see the volume. So don't need this. And I personally don't use this a lot. I use the market profile sometimes and take different aspects of it. But for other stuff, no. With that being said, what do we have? We have the initial balance right here. So what the initial balance is highlighting the Asian session. And quite frankly, me personally, I only have it because I was trading ICT before. And I was always waiting for Asia's high to be swept. But I got so used to having it on my chart. So when I didn't have it, it felt naked. And also this highlights to me that this is the end of the day. And this highlights to me that this is a very low volatile, low volume area in the chart as well. Then we have the initial balance of London. And for you that wonder what the initial balance is, it is basically the first hour of the session open. So here we have the initial balance on London. And then here we have the initial balance on New York. And I actually have a very good playbook called the initial balance play based on these initial balances. Okay, more on that in the academy. Okay, so if you don't like this, remove it. Then we have bar timer. So this bar timer just shows down here at the lows when the M5 candle is going to close. I can even remove this. I don't need this. Then we have volume on the chart. This is volume by time. At these lows, you're seeing volume coming up. So you can clearly see when the volume is coming into ES. Of course, on ES every day, the highest volume is when the New York session open, and the most highest volume is when the session closes, because everybody is closing and their books for the day. If you're going to trade the Euro USD, you're going to trade the GC. This is good because you can clearly see where the volatility of the market comes in. Look at the times when the most volatility comes in for the past, let's say, 50 days, and take your average of that, and you will know, okay, what time does momentum kick in on GC, what time does it end? So that's your trading window. Also, we have the biggest cheat code in the market and the best selling point for this software. We have the big trades. Look at this. Okay, let's start right here. Yesterday, I told my students when I was doing the pre-market analysis, like, we have a very high chance of opening and just rallying higher. So let me show you that as well. Okay, the likelihood of us opening and going high is very high. And well, it happened, right? And how can I, with such high certainty, say that? So let me walk you through that analysis super quickly. This is not a technical analysis video, but if I draw the volume profile, okay, and we have the shelf right here. So price went out of it, accepted higher prices, pulled back. Inside of that pullback, this big trade was telling me that passive buyers, meaning buy limit orders, are inside of the market. And quite frankly, I was looking for a very small pullback and take the market long. This big trade was showing me right here, someone is market executing 500 lots of sell orders, but market is going higher. So what is this guy getting? Absorbed. So it meant that huge buy limit orders were inside of the market. And here we just saw some aggressive buyer coming in, but this buy limit order, every time we pull back to him, he held. Pull back, hold, pull back, hold. Market opened, straight move to the upside without any pullbacks. So for me, there was 0 trades actually yesterday on the session, but I caught the low right here again with the big trades. So let me show you that trade as well. Or I think I just showed you like 10 minutes ago. So let me not show that trade. Either way, let me just bring out the pen so I can annotate. Okay, so what we have here is that we have a lot of selling going on, but market goes higher. Same goes here. A lot of selling going on, market goes higher. Once I saw this, I entered here, stop loss here. Okay, so my entry was here, my stop loss was here. The market rallied. Of course, it is the London session, so it's very slow. But for everything, for every trade, you need context, location, confirmation. This is the confirmation. What was the location? Okay, for this specific trade, if I anchor the volume profile, where was the, okay, this was the low. So if I anchor the volume profile prior to us going to that low, what do we see? Let's measure it this way. Okay, what do we see at that low? If I just mark out this shelf, and if you watch the TradingView video, you should have a slight idea what the shelf is. If I just mark this shelf, price pulled back to that, confirmed, took the rally higher. Since it is the London session, I took it conservatively to this other side of the volume. So we traveled through the whole volume. And since we were bullish, I had a, if we are bullish, the likelihood of us going higher is much higher, right? So since we are trending bullish, we should go and take out this high. But of course, I'm not going to take a long trade from here and set and forget, then just go away from the chart and target this high. That would be like, we can even see if I entered here with a 3.5 stop loss, that would be an 18-hour trade. So I'm not shooting for the moon every time. I was targeting the closest target, which made sense for a 2.5 hour. So it's not that sexy, but you will see. This is why you have to watch the backtesting session to show me, for me to show you exactly how the big trades work and how I use it to confirm my trades, and how you are going to use it to confirm your trades, most importantly. Because the order flow I'm going to teach in this course is all based on the big trades. And as I said, this will put you ahead of 99% of the order flow traders. And I don't know if you watched the first or one of these videos that I made prior to this. The World Scalping Championship, the World Scalping Champion also uses the big trades on M1 exactly like me. So when I saw that, I got really happy. So that means I should start to go into the tryout for the world champions, right? So let's see. With that being said, we have the big trades right here. But the difference is on the big trades on M5, if you go to the settings, on the settings, I have the minimum volume to 250. So I want to see every big trade above 250 that comes in on my M5 chart, okay? This is because I want to filter out those lower volumes. I don't want to see anything less than that. But on my M1 chart, since I'm using this as bookmap, as seeing every small transaction that comes in, here I can see, okay, we are getting absorption and then we are getting aggression. Exactly like this. In this example, we get absorption, then we see that the buyer starts to come in. Here we see that the buyer starts to come in. On this one, the big trade is set to 70, I think. Yes, 70. Since we were talking about the world champion in scalping, he only trades NQ, and his settings for big trades on NQ is 30, or he even said that he maybe uses 40 sometimes as well, depending on the market conditions. I personally don't trade NQ. I personally haven't tried out those settings, but for ES, M1 chart, 70, super good. M5 chart, 250 and above. If you are trading GC, something that I don't trade, and I don't have a clue about how much a big order is on that specific pair or indice or commodity or whatever you trade, the big trades actually have something that is called the auto filter. So it will actually calculate how much a big trade was in the past, like in the past, let's say 5 to 10 days. I don't exactly know how many days it will calculate. You can go to the about page and read about it here, but it's pretty accurate. So it will just show you, let's say that market is in a very low volatile period. Not many trades are coming in. So it will actually recalculate itself to that period. But when the market starts to get volatile again, it won't start to show small amount of trades again. So it's a very good feature to use, but since I have been trading ES for such a long time and I know how much a big trade is and what kind of number I want to see, these are the perfect settings for that. And then we have the delta, we have the volume, and we have the session volume. Don't need to care about this. We won't use this in the free course. We have the delta bars as well. Don't use this in the free course. You don't need this right now. And of course, the footprint chart. And I don't know if I said it, I have multiple windows. I have 1, 2, 3, 4, 5 different screens. So I can have multiple windows on each separate screen. But what you can do is just place them depending on or based on how many screens you have. Maybe you have only one screen. Then you take out this, like here, and place it to the left side. Okay, I have this one. So let me show you the other windows that will pop up when you load my template, because these are, how can I say it? You don't need them, but this is like, I'm gonna walk you through them for you to see if you need them or not. Okay. So the first one was the smart DOM. You can just close this, but keep these two. These are very good because here I do see the big orders that are coming in, and I do see the time they are being transacted at. And then I have another M30 chart. This is on the screen above me. So I see the volume profile on a higher time frame. So I have the M30 here, and I have the here as well, because most of the time I'm looking at the M1 for confirmation and the M30 on another screen to see where we are based on the volume profile. And also I do have a M5 chart on the screen on the right of me. It is because I'm mostly in M1 in footprint on the main screen. So do as you like. You can just, let's say that you want to have the M5 chart. Let's go like this. I'm in the M1, right? But I don't just want to look at the M1. So what you want to do, bring up the M5 chart and just place it in the table below. And now you have these two. Okay, so you see both M1 and 5 right here. Okay, up to you how you want to set up the windows based on your own screen real estate. Let me just look at one thing. Okay, and now finally, how you can connect Rhythmic is by, or the data feed that you just purchased is going to here, down left, right here. I don't know if you see it in the recording. It's very small. The icon is very small. It is like a setting button. Go in here, add connections and connect. If you have, like, if you need guidance on this, as I said, 𝗧𝗛𝗓 have a very good YouTube channel showing you how you can connect the data feed, all of that. Okay, so just search for this information on Google, or oh no, I wouldn't recommend ChatGPT because it's often giving the wrong answers and you will get confused. Searching Google, YouTube, sorry, searching Google and YouTube. So that is how you connect the data feed, and then you will get real-time data. Like I can currently see right here, like, okay, here at this exact tick, we have 104 more buyers than sellers at this exact tick. So very valuable if you are going to trade sniper levels of zones as well. So let me see if I missed anything that was essential right now, because in the backtesting session, you will see me use all of these stuff and combine them into a very, I would say, easy strategy, but also a very good strategy that you have, how can I say it, like a lot of clarity with. Compared to if you're just watching the candlesticks. And also one of the biggest selling point when I was getting 𝗧𝗛𝗓, and this was when I pressed the buy button. Now I have removed this for this chart. Let me see. Okay, I have it for the footprint chart. And you can also enable it and disable it. So I have disabled it because I don't look at M5 footprint chart. I look at different ranges based on the current market situation. This is the range chart. More on that in the academy. I don't want to upsell, but more like I can't go through a 40 video course in a free course, right? Either way, what is so powerful with this software is that you can just zoom in like this and the candles will transform to a footprint chart. So here you can clearly see that 805 sellers came into the market, 427 sellers came into the market, and it dropped. Okay, of course, this was the session ending. Okay. And I will teach you how to use order flow in this course as well. So you will actually understand what all of this means. But like you see in this low, in the footprint, 851 lots of selling came in. Okay, if you even zoom in even more, zoom in a lot. 851 of selling, 0 of buying. Okay, so this seller got like, I don't want to say he got hugely trapped. He got screwed. Okay. He sold so much, but market went against him. And then when the market pulled back again, we got 638 of sellers again, plus 266, but market went up. And this is why I bought right here in the London session for that trade. So this is how you can transform any candle and see what is happening inside of the candle. And this was the hugest selling point when I was trading this. So if this is the M5 chart, matter of fact, let me just enable that setting so you can see how it looks on the M5. So if you right click on that chart and go to the settings, you have something that is called the auto transform candles to clusters. If you enable that, it will actually show you. So why is this good? If you see a large wick inside of the market, how wouldn't it be, let's say you have a trading model based on wicks on M5 or whatever, you want to see what happened during a wick. Wouldn't it be super powerful? Let's go to M10. Let's go to M15. Wouldn't it be super powerful to see, like, this candle has a huge wick, right? If I remove the big okay, we can even have the big trades. Would it be super powerful to see what happened in that week, if that was really a week where buyers step in or sellers get absorbed or not? Maybe you have a week, but the market revisits that area again. This way, like you can clearly see every week has order flow, like huge order flow data inside of them, huge order flow. So this way, you can just zoom in and see what happens. So if I remove the big trades right here, I zoom in and see inside of this week, a lot of buyers came in. Okay. So just if you go from trading candlesticks to use an order flow software, if you just zoom in and see what happened inside of a week, that in itself already gave you a lot more edge than any ICT traders that measure a candle with the Fibonacci and said that we need to come to 50% of it will give you. This is telling me this is exactly where the buyers stepped in. So if we pull back to that specific area, look at this. Let me show you this. So I'm not bullshitting you. I'm showing you everything. I'm backing up everything that I'm telling you. If this is telling me that we have 851 of sellers coming in, but the result of this is that the candle went higher, and keep in mind in the order flow course you will 100% understand what I mean by this. But just to keep it simple, there is a buy limit order at this exact specific price point. So at 6,950 on ES, there was a buy limit order, not letting the sellers lift or push the auction lower. Like this would be a candle, right? So if you pull back to the exact point and this buy limit order is still here and you see buying coming in, that is your confirmation to go long, right? So instead of you guessing, measuring a candle wick with a Fibonacci, or I don't know how ICT traders use it, but I saw ICT once measuring a wick with Fibonacci and said it should come to discounted in this week. Like how does he know? Like how do you know if you don't have true order flow data? So I'm going into a rant right here, but let's take this. So let me show you. Do I even have the Fibonacci tool? Yes. So if I use this, according to ICT, I measured it wrongly. I don't even use the Fibonacci because there is zero edge with the Fibonacci. And I will get a lot of hate because I know that a lot of time price comes to these areas. I know, but it is not like price is not coming there because of the Fibonacci. It is because other stuff. Okay. Once you start to trade with me, you will understand what other stuff. This is just something that tends to be correct. Okay. So if price came to the 50%, this is not where the buyers were in. If you zoom in by using order flow, you will know, oh, they were active around the 90% of the candle of the Fibonacci. Okay. So very powerful. So of course he will say place a limit order. I don't know I see this strategy, but he will say place a limit order at a 50%, then you are buying at a very discounted price. But this way you can exactly know where those buyers were in. And this is how I caught the session low this day as well. And I will walk you through that in the backtesting session. So with that being said, have the software, use the big trades, use the volume profile, disregard anything else that I'm like all the footprints and all of those stuff, because this course is about simplicity. I just want to know what all of these stuff are. But if you are not in the academy, you don't need this stuff. If you are, this will be walked through. Like I spent a lot of time and energy, a lot of backtesting videos, a lot of effort. Like my students, once they are done with the course, they have zero doubts about anything. So I spent a lot of energy into that. So for this free course, you only need the big trades. And quite frankly, this is one of the most powerful ways of reading order flow. And in the order flow lesson, I will show you how you can use it. So with that being said, this is 𝗧𝗛𝗓. This is how you set it up. If you have other questions, if you don't find answer to your questions, so please do your own research first. I'm not a tech support guy. I won't sit here and it might sound harsh, but I'm not sitting here as a tech support, but I will 100% help if you have a difficult question that you can't find an easy answer by searching yourself. So step number one, search yourself. YouTube, Google, even use Gemini. Gemini is better than ChatGPT. If you can't find the answer, since I have been using this software for such a long while and I've been playing around with it and I know how it works, ask in the comment section below and I will make sure to reply. I'm not gonna leave you hanging, right? But that reply might take a few hours. I'm not sitting behind the computer as a tech support. Either way, a long rant, but a beautiful software. Use this in your advantage. Use if you want to support me, use the affiliate link. Not necessary. I make my money trading. And let's take it from there. You will see in the backtesting sessions how you use this software to exactly know where the market is going, where it's heading, where it's coming from, what the intention of buyers and sellers are, everything. Like, you will be so surprised by this. Also, what I want you to do for today's assignment is to set Atas up, take a print screen on how you set it up, and post it in the community feed or in the comment section below. If you're in school, post it in the community feed. If you're coming from YouTube, post it in the comment section below. And tell me what you think about the experience, about the software as of now. Of course, you may not know how to use all of the tools, but tell me what you think about the order flow software as of now. And keep in mind, this is the most intuitive order flow software that I used, but it's maybe not as capable as Sierra Chart. But trust me, we don't need that capability and we don't need that complexity into our way of trading. We just simplify auction market theory, use order flow, and become profitable that way. Either way, ranting a little bit here in the end. I hope you enjoyed this guide, and talk to you in the next one. Welcome back, everyone. Today we are moving into Futures 101. In this session, we're going to strip back the layers and look how these contracts actually work. Before we dive into the technicals, we need to clear up some common points of confusion. We have to understand the difference between asset classes and derivative contracts. You will often hear that traders said, oh, I trade Forex or I trade futures. So the thing is that these are not even the same thing. It's not even in the same category, right? I even saw a mentor posting a print screen of 𝗧𝗛𝗃 and saying like, and this guy had like 40K of following, and I know that he's selling a lot of mentorships. So this guy was posting and saying that, oh, my levels works perfectly in futures. First off, he didn't understand that 𝗧𝗛𝗃 is a CFD derivative, all right, of the NQ futures. So not to get you confused, we will dive deeply into this in this lesson. Second, he didn't understand that 𝗧𝗛𝗃 is an indice and not a future. So to clear up all of this confusion, we have to dive deeply into this subject so you actually understand what you are trading and what the differences are and what the pros and cons of futures versus CFD are. And this is actually very important because you can actually make or save a lot of money on this. So, all right, what are derivative contracts? What is a contract compared to an asset class? Forex is an asset class. It is the what, right? Futures is a type of contract. It is the how. So someone may ask, do you trade futures or Forex? Well, I can trade Forex futures. The underlying asset can be Forex, which is currencies, commodities, bonds, stocks, or crypto. Think of the underlying asset as the foundation. This includes markets like currencies, which is the Forex one, and commodities, which can be gold, oil, whatever, bonds, stocks, and crypto. Of course, you can buy crypto physically, like not physically, but you can buy crypto. You don't need to buy the crypto futures because crypto is easy to buy. You can buy stocks, right? You can even buy bonds, but you don't go out and buy a barrel of oil, right? You don't go out and buy physical gold, right? If you want to trade it. On the other hand, derivative contracts are the instruments that we use to trade those assets. as a speculator, like we traders, we are speculators. We aren't usually hauling barrels of oil into our garages, right? We are not like buying physical gold and putting it under our bed. Maybe we used to do so back in the days, like our grandmother used to do so, but we, as a speculator, we don't do that. What we do instead is that we trade the contracts that derive their value from those underlying assets. These includes like CFDs, options, futures, swaps, and others. And today our focus is mainly on futures. So we have an example here, right? To make it practical, just let's look on how some assets are packaged differently. So if you are trading euro against the USD or euro USD, you can either trade the futures, which is the 6E, or you can trade the CFD, which is euro USD, right? And if you are trading gold, it can be GC on the futures. On CFD, it is simply XRU USD. So a difference. And another example, like if you're trading the S&P 500, on the CFD is usually US 500. And the future is usually ES, which is the E-mini. So let's discuss on how futures works, like expiring and hedging. So how futures work, it is a binding obligation. Unlike stocks, a future contract is a legal agreement to buy or sell an asset at a fixed price on a specific future date, regardless of the current market price. So what makes futures unique? Essentially, a future contract gives the buyer the obligation to buy the asset at a specific price on a set date. And next up, we have the finite lifespan and rollover. Futures have a set expiration, usually monthly or quarterly. To keep the trades open, you must settle the contract or roll it over to the next available expiration period. Because they have an expiration date, like monthly or quarterly, you can't hold them forever like stocks. You have to either settle the contracts or roll it over to the next available month or the next expiration. And this is not something that we need to think of, but we have to be aware that we have rollovers, and this is why that back adjusted chart that I was showing you on TradingView is a very good feature. So next up, we have hedging and smart money. Futures was originally built for risk management, like the airline locking in fuel prices from our first lesson. And the future market is overseen by the CFTC, which releases the COT report to reveal where major institutions and smart money are positioned. And how the CFTC can release the COT report, it is because the futures market is centralized and all the information is available to everyone. So smart money do not use CFD contracts. So historically, futures contracts weren't built for speculators. They were built for hedging, like the previous example of the airline wanting to hedge against higher oil prices. This is why the CFTC, the regulators, this is why they exist and why the COT report, Commitment of Traders, is so valuable. It tracks what the big players are doing. This is based on trading activity on the future contracts, not the CFD contracts. And this is why it is the best thing to trade, because it is so open. Everybody can see what everyone is doing. So let's look at it from a different point of view. Imagine that you are running a large construction firm, right? You know you need a massive amount of lumber in 6 months. If you're worried prices will skyrocket, you can buy a lumber future today at a fixed price. So this is how you can do your macro analysis and understand lumber might increase in price in futures. So I will buy the future contracts today at a fixed price. So if price goes up, it doesn't even matter. Your prices are actually locked in. And this is the beautiful thing about futures if you are a big company. And this is how they successfully hedge their risk, right? So by holding this contract, you can buy lumber at a locked price later on, even if the market price have skyrocketed. And this is like one of the greatest hack of commercial companies. So we traders use future contracts for speculation, and hedge fund traders may use it as a speculation as a speculation vehicle to put their money, speculate if prices going up and down. But major companies are using this as a risk management strategy. So this is the foundation that makes the market so robust. So, okay, why trade futures and what are the key features? So why do professional traders choose futures over CFDs? It simply comes down to three simple things, right? So everything is transparent and regulated, unlike CFDs that are very untransparent. They are very low grade and they are very low quality. They're not even traded the same way across exchanges. Exchanges literally make up their own price. Not fully, but that last 5 to 10% are a little bit different. There are a lot of brokers that display slightly different prices. And if you ever compare the different feeds in TradingView, you know that they can actually differ a lot. Maybe a 4-hour candle opens at 12 o'clock on Oanda, and on, let's say, Forex.com, a 4-hour candle opens on 11 o'clock. Maybe you get wicked out, your stop loss got wicked out on Oanda, but on FXCM, it wasn't a wick. So this stuff doesn't happen in futures. Everything is regulated. Everyone see the same data. Everything is centralized. Next up, we have direct market access and zero markups. And there is no hidden markups when you trade futures, right? In Forex CFDs, like broker adds a markup to the spread to make more money. So in futures, you get a raw market spread. The only thing you pay is a commission, and that's it. So let's take an example, right? I think we all have seen it. Let's say that you have a fake guru and he has a signal group on Telegram that you joined. And in his signal group, he's like pushing a specific offshore CFD broker. What they don't tell you is that the broker has a markup of the spread. You might be paying like a 3 pip spread on the Euro USD. So a pair that should practically have zero pips or zero spread in the original professional market. On that CFD broker, you have the marked off of 3 pip. And if you're trading in the Euro USD, mostly those offshore brokers have the best markup of spreads. If you trade like an exotic pair, or let's say NZD, whatever, I don't know a lot of Forex pairs, but if you trade something that not most of the people trade, the spreads can even be like 5, 6, or even 10 pips. And this is something that I didn't understand when I was trading the CFD, when I was on a beginner as well. So this is why I lost so much money. But just know that the markup isn't a mistake. It is how the brokers, and often the guru, make extra money of every single trade that you take. In the future market, that hidden tax is simply doesn't exist, right? Because tell me how many times like price came to your take profit, but the MT5 didn't actually take profit. So that is a very bad thing, right? Also, tell me how many times the market didn't take out your stop loss, but came very close to it, but you got taken out. And that's not a very good thing, right? You're just stacking the odds against you to succeed in this market. So that is why you have to move away from CFDs. Of course, you can use CFD prop firms, because they are normally easier to succeed in than future prop firms. But just know that they add a markup, they add the spreads. So that is why it's so hard. Just think about it. Think about it this way. If you're scalping for 10 pips, and if your broker is taking 3 pips just for the entry fee, all right, you already lost 30% of the profit before the trade even moves. You're fighting like an uphill battle. So why would you, trading is hard enough. So why would you fight this uphill battle and lose 30% before you enter the trade even? So by switching to futures, you remove the middleman and you remove that markup, right? You pay a small transparent commission and you get the same prices as the big banks in the world. So you guys have the same playing field. Just this small change, just this very small change, if you change your feed from Euro USD to 6E and trade the 6E, that's little small change can greatly reduce, like increase the outcomes, like the positive outcomes of your trades. Okay, so let's see. True order flow data, and this is a big one. So we do have real-time data because it's one centralized exchange. We see the actual order flow. Very powerful tool and very important to have. You can simply just pay for the data feed, and that data feed shows you every single buy and sell order that is happening in real time. Imagine how much of an edge that is. Like, you can clearly see where everybody is buying and selling. So if you have a support or you have a resistance line, you can clearly see what is happening exactly at that point, how everybody, not just let's say the traders that trade on that CFD firm that you're trading, but everybody, all the banks, all the institutions, all the smart money. So you can't do this on CFD, right? But on futures, you basically download all the trading exchange data through something that is called a real-time data feed. So if you pull up the chart for Euro USD CFD on a broker, let's say like Oanda, and compare it side by side with the 6E future contracts, you will easily notice discrepancies, right? So because CFD is decentralized, your broker might just change the price levels, or let's change the wicks, or let's change the wick behavior, and those wicks they don't actually exist in the regulated market. So that is why if I'm trading the Euro USD, right, maybe I get wicked out on the Euro USD feed, but when I switch back to the 6E feed, that wick wasn't even present. So that is the filthy part of trading as well. So just this information alone will set you up a lot in towards profitability, right? Because you're just trading the real asset itself, like you're trading a centralized way of trading the asset itself. And it's very important that when you're placing your order on CFD, you aren't always trading at true market price. You're trading at your broker's version of it, right? So the bottom line is that analyzing the wrong data leads to wrong decision. Just this small change in what feed you will analyze can change the outcomes of many of your trades. So with that said, we have to go over to today's action, today's assignment. So this one as well, I will personally correct your assignment. So let's see what we have. We have to understand these hidden tags on trading the CFD. So we have to do a case study, right? The goal is, let me just bring it this way. The goal is to realize how much money we are losing to this CFD markup. So how much money are we losing if the CFD broker is putting on 5 pips if you're trading the NZD USD? So how much money is that over a period amount of trades? So the task is to check the current spread on your CFD, Euro USD CFD account during the New York session. And keep in mind, Euro USD on the CFD brokers have often the best spreads possible. So as I said, if you go to the exotics pairs, like if you trade, just go and watch oil. I beg you, like go and watch oil. Like if I place a limit order, price goes into my limit order, it goes like 6 pips into my limit order, but still it hasn't triggered my limit order. So how can I trade that, right? And if I place a take profit, it goes to my take profit. And the way I trade, like you guys have seen it, right? The way I trade is, it is a very sniper level of a zone. It is a very specific area in the chart. So if I have a limit there, market goes to that specific area and it doesn't tag me and go to take profit, I just lost a 5-hour trade because of this bullshittery. So that is why switching to futures is much better. And I want you to do the math, right? If the spread is 2 pips, calculate how much of a cost over 100 trades, let's say one lot size, how much of a money you are losing. We're not even gonna count your failed take profits, your failed limit orders. your failed stop losses. We're not even going to count those, right? We're just going to count how much 2 pips multiplied by $10 is at 200 trades. Like you can clearly see, like if your spread on the thing that you're trading, let's say that you're trading 𝗧𝗛𝗓𝗓𝗓𝗓, which is gold. If it's 5 pips, multiply it and see how much you are losing. So if it's hard for you, just use ChatGPT. Just write like, okay, I'm trading the 𝗧𝗛𝗓. My spread is 2 pips. How much money am I leaving on the table by not trading futures? So that is a very easy way to do it as well. Then what I want you to do is to go and post this in the community post, right? Share your broker's tax number. So this is how they tax you, right? So post this. I just realized that I'm paying this dollar amount of money in a hidden spread markout per 100 trades. If I switch to the futures 60 with 0 spreads, that money stays in my pocket. Who else is getting robbed by their broker? So tying up everything with the first lesson, right? So these are the small changes that you have to do in your trading to actually set the stepping stone into the direction of profitability. So I hope that this lesson was very informative for you, and that small change is something that you can do even tomorrow. Do this example. Please post in the community feed. Remember, I really want a engaging community. People will help each other. And let's say that you do the 6E example. Let's say someone else is trading crypto, or let's say crypto is very, like, if you see the spreads there, it's almost impossible. But let's say that you're trading oil, right? Do that for your asset that you're trading and post it in the community so other people can see how much this broker taxes actually is. And as always, be very active in the community, and I will personally reward everyone that are very active in the community, and I will make it worth your time. So until the next lesson, have a good day, everyone. Welcome back, everybody. Today we are going to talk about auction market theory. Today we are stripping back all of the noise of traditional technical analysis to look at the market from an auction perspective to actually understand how the market functions. And as always, I've simplified this a lot for you, so you only get the information that you need and nothing else that will only confuse you. So today we're going to master the why behind price movements. So we are moving beyond lagging indicators and market structure. We are focusing on high probability liquidity zones. So instead of relying on lagging indicators that tells us what happened in the past, we're going to master auction market theory. This is the fundamental framework that is used by institutional traders to understand where price has been and where it's going. And this is how you find high probability liquidity zones inside of the market as well. So now let's move to this blackboard and let's start by looking at the market from an auction perspective. So at its core, the stock market is just a massive auction, right? Its only goal is to facilitate trades between buyers and sellers. When price is moving, it is searching for fair value, a level where both sides agree to transact. So where both sides, the buyers and sellers, are happy to transact, and that is the fair value. If the market can't find balance, it will move higher or lower until it finds a level to attract the opposite side. So in order for us to understand the participants, to understand the stock market, think of a high-end art auction. The auctioneer is the middleman. It is the person facilitating the trades. It's this guy, right? The painting is the supply. It is the item being sold. The bidders is the demand, people competing to buy the painting. So these people right here, they want something, right? And this is a good that someone is selling, and the auctioneer is the middleman. He's the one facilitating the trades. How price moves: if a painting starts at 1 million and someone bids 1.1 million, that becomes a new price, right? Price rises because someone is always willing to pay a spread a slightly higher price to outbid the previous person. So how can we transition this to the financial markets? The exchange acts as the auctioneer, the exchange acts as the middleman, and the exchange match the buyers with the sellers. So the middleman right here. So in auction, this is the middleman. In the financial market, the exchange, like New York Stock Exchange, is the middleman. Let's say that you're buying a house, the real estate broker is the middleman, right? So buying a house, you can also bid up the house higher until no one else is bidding anymore, right? And then you will win that auction. And in trading terms, it's called a finished auction. In the stock market, we don't trade paintings, right? We trade buy and sell orders. And the buy and sell orders, we will see them on the depth of market, also called the DOM or DOM. This shows the resting limit orders at each price. So we see sell limit orders, which is also called offers or ask. We see buy limit orders, which is called the bids. So on the lower side, these blue ones are the bids, and these are the sell limit orders. So this is why we call them passive orders. This is also referred to as resting liquidity, just as a painting being sold at the auction waiting to be bought or sold. Very important. These are the paintings, right? These are offered at a specific price. Now they are waiting for someone to buy them. Now, if you're an order flow trader, the correct term when you accept the offer is lifting the offer. Okay, you don't need to know this, but when someone says lifting the offer, now you know what it is. So someone is accepting that sell limit order. They are offering to sell at a specific price. So sell limits are offering to sell at a specific price. Here, the sell limit is offering to sell at 100 for, let's say, US dollars. These orders participate in the auction. They wait for aggressive buyers to step in. They wait for aggressive buyers to accept their price. And we will talk about what aggressive buyers is next. And now, buy limit orders or bids. When aggressive orders accept that bid, we call it hitting the bid. So the bids, the blue one right here, these are the buy limit orders. They are passive buy orders. They represent the buy side of the auction. Execution only happens when aggressive sellers hit them. Market use our order book, market depth. So this kid has a lot of name: market depth, depth of market, DOM, passive side. Yeah, a lot of names, right? But just know what you're seeing on the depth of market is the passive orders. So the depth of market displays passive liquidity. The ask, which is the offer, these are the passive sellers waiting at higher prices. They are offering to sell and waiting for someone to accept their prices. So these guys are just waiting right here, passively with a sell limit order, waiting for someone to accept their prices. So switch this to when you are trading yourself, right? If you're trading, let's say from MT5 or another broker, whatever platform you use to trade, you can either place a limit order or a buy market order. So when you place a limit order, let's say you place a limit order at $104. Okay. So now based on how big your size is, this white box here will increase because you added to that limit, to that passive orders at $104. Okay. So your limit orders are passive orders because you're not doing anything. You're placing a line on your chart, an order, waiting for an aggressive participant to hit or lift that order. And the bid, these are the passive buyers waiting at lower prices. They are offering to buy and waiting for a seller to come to them. The spread, it is the gap between the best highest bid and the best lowest ask. Okay, so let's say someone comes into the market, some aggressive buyer comes into the market, and he says, okay, I want to buy everything that is offered here. So this will be removed, right? And then he says, okay, I'm going to accept this as well. So now we don't have anything from 99 to 102. So these 100 and 101 is the spread. It is the space in between. But when you are trading, like let's say ES or the financial markets, this is going to be populated super quickly. And this is how liquidity providers actually earn money as well. Okay then, so who are the aggressive market participants? Supply, a collection of aggressive sellers at higher prices. Demand, a collection of aggressive buyers at lower prices. And these guys is also known as, like, if you convert it to how you used to trade, or how you trade actually, is the market order execution. So when you want into the market right now quickly, you are a market taker. They just want to jump into the market right now. So that is you, right? If you see a setup appear and you want to jump into the market, you just hit market buy. And now how your order is being transacted is that you are buying the first available offer, which is a sell limit order. So let me explain that again. Maybe it gets a little bit, it can get a little bit confusing, but it's super easy when we move into the order flow. I've simplified this a lot. I'm just giving you the theory behind everything, and then we're going to simplify it even more. So you have a sell limit order right here. We also have more resting orders in the book. So let's say we have 4 here. Okay. So now we have 2 sell limit orders here, 4 sell limit orders here, and we can give them a price point as well. Let's say 100 and 101. And you as a trader, you want to come into the market directly, and you want to buy 3 contracts. So first off, market will match you with these 2 guys, and then it will match you with one of these 4. So this guy is reduced to 3 now. Okay, so when you execute with the market order, you will get matched with the best available offer or sell limit order possible at the closest price. So of course, in the financial markets, me and you are not able to move the market so much. So our small little order won't even nudge the market. Okay. But this becomes a huge problem for large institutions, because if Warren Buffett would have pressed market buy, if he want to buy a share, he alone would eat the whole order book, and price would have a boner up to the sky. It will skyrocket higher. So therefore, large institutions they want a fair value. They want to fraction in their orders. They don't want to show the true size. They want to come in little by little into the market. So they don't want to eat the whole order book and eat up all of the liquidity, all of the passive liquidity resting at one single go. All right. So price is stationary until aggressive buyer and sellers enter the scene. So keep in mind, if you have a sell limit order and a buy limit order, you 2 guys can never transact. So how candlesticks move up and down, it is because someone is aggressively buying or selling. So we're going to take this example right here. So market takers, these are the traders that cannot wait. They hit the market to guarantee an immediate fill. So how do they get matched? So let's take this example. When an aggressive buyer buys 2 contracts from a passive seller at $100, a trade occurs, right? This becomes the new price and the candlestick ticks up. So when you see the candlestick tick up, right, this is because someone is buying. Someone is lifting the offer. And how the wick gets confirmed is if an aggressive seller then hits the bid at a lower price, the candle ticks down, leaving a wick where price used to be. So this is how a wick is getting formed in the market. So as you're getting it more and more, every interaction in the market is just buying and selling. So why does a price explode? So let's take this example. So the breakthrough catalyst. So imagine a biotech firm just announced that they have received FDA approval for a revolutionary cure. This creates an immediate shift in the auction. So the perceived value of the asset immediately shifted. The sellers retreat. Existing shareholders see the news and stop selling. Either they move the sell offer, they sell limit higher, much higher, or take them off the board entirely. Okay. So if more aggressive market participants come into the market and no one is selling, so this is why you can clearly see a huge red candle. And of course, if you flip it to the opposite side, bearish news catalysts come to the market. This is why the market melts a lot. So this is when we get the FOMO wave. Aggressive, like when we get this news, like a very positive news for this biotech firm, aggressive buyers realize the value has shifted. They can't wait for a good deal or a dip. They need to own the stock immediately. So we are using a stock example. This is also true for all markets, even for housing, for cars, for paintings, for indices, for whatever. Imagine when it was Corona, right? Everybody was hauling toilet paper. So what the market could have done was to increase the prices of toilet paper. No one was selling, everybody was buying. So the demand for buying was higher than the supply. So what happens is when we get this FOMO wave is that all of these aggressive buyers that come into the market, they are eating the liquidity. These aggressive buyers start hitting the buy market bottom. They consume every single sell order available at current price. And then they move to the next, they move to the next, they move to the next. So let's look at this DOM. The depth of market. So aggressive market order comes in. So even one guy can just eat up all of these orders. Okay. So now the market or the exchange have to match his market order with much higher and higher prices. And this is why candlesticks or a candlestick goes green and move higher and higher. It is to find where the next seller is present. So when we get this FOMO wave, it is when the ceiling breaks because the buyers are willing to pay almost anything to get in. The price smashes through the ceiling, creating a massive tall candle on the charts. This move doesn't happen because there are more buyers than sellers. Every trade still requires some match. It happens because buyers are so desperate that they are willing to accept worse and worse prices just to ensure that they are getting filled. So now back to, let's say, if you are waiting for, let's say, H1, H4, daily time frame, all of that to align, keep in mind that if a news catalyst comes into the market, we order flow traders, we see it down at this low. We want to buy immediately. Let me just change this to white so you can clearly see it a little bit better. Okay, let's zoom in. So we order flow traders, we know that, okay, this news catalyst happened here. We can clearly see on the order flow, we will buy from this low. Okay, market goes higher. And now buyers are buying. This is the FOMO wave. But at some point, buyers are not willing to accept worse and worse prices. And at some point, sellers are, like if we have sellers, like a lot of sellers up here, at some point, sellers are willing to start to take profit or to offload or... So this dynamic actually shifts. And this is when we get the pullback. Like if you are trading market structure, you simply know how this actually works. So the market doesn't go straight to the upside, right? It pullbacks, it goes higher in a trending market and vice versa. But market structure is not something that we're going to trade. Instead, it's going to look like this. We're going to have our consolidation period, a period where we have fair value. So this is fair value. Let's say this is right before the news. The news catalyst comes up, price rallies. Okay, all the way up here, buyers are willing to buy and buy at worse and worse prices. And now we come to the next area where we previously had a consolidation period where sellers are active. And now we see, okay, buyers are not willing to pay much more for this asset. Sellers are happy to offload. Then market drops down. And since the buyers bought at these lows before, they're willing to transact again. And this is how we get trending markets. And we're going to take a very good chart example in the end of this lesson as well to tie up everything together. So you will see it how it looks on the chart. So not just theory. Okay, let's go through all of this. And this is basically what I just explained, but in a more professional way. So we have two phases in the auction. So we have balance and imbalance. We have a constant battle between buyers and sellers. Price move to find where the most volume can be transacted. And this is why we use the volume profile. All right. Balance is a fair value. Buyers and sellers agree on price. There is no aggressive push from either side. Trading stays within a range. Imbalance is also known as price discovery. So when you get a large candle out or a large red candle, large candle up and a large red candle down, this is what's also called as price discovery. This is when news or shift in the perception occurs. So the perceived value of the asset shifts. Price moves aggressively to find a new fair valuation where sellers are interested again. So in our bullish example, if price goes higher, it will find a new valuation where sellers are interested and price comes lower. So that is the pullback. So basically, you only need this. It's very simple. Auction market theory. Markets behave like a continuous auction. It is just there to facilitate trades between buyers and sellers, right? Buyers and sellers interact to discover buyers and sellers interact to discover fair value. Price move due to imbalances between buying and selling pressure. And this buying and selling pressure, this is exactly what I used to create how I read the context. I read the context based on the pressure of buyers and sellers. And this is very unique to me. And yeah, I hope you get to see that very soon. More buying pressure moves price higher. More selling pressure moves price lower. The key idea is that the market is always searching for balance and acceptance. If balance is lost, which is that imbalance period, price moves quickly to discover a new balance area or to return to prior balance, aiming for, like, this is the efficiency market theory, right? Market always wants to be efficient. It don't like to be in imbalance phases. It really likes to, like, all the institutions, like when market is spiking up or down, that is the worst time for institutions to buy and sell. They are waiting for an area of balance to occur or price to reach back to an area of balance. And you will actually see this in the backtesting sessions where I will backtest and explain all of this deeply. So important note, auction market theory is a framework and a philosophy, not a specific strategy. It helps you to visualize market activity. Also, you can 100% use it as a main contextual tool. Also, you can 100% understand where the zones that you're going to mark out is going to be. So we have this rotation, right? We have fair value, balance, supply equal to demand. So everybody's happy. Then we get that imbalance, buyers stronger or sellers stronger. Then market goes and find balance. And after a while, it will go to discovery and find balance, go to discovery, and so on. So how it looks is like this. So this is a balance phase. Market is consolidating. And then we get a catalyst. We can create that imbalance. Then the market finds balance once again. And now let's say that the sellers here are stronger than the buyers. Market comes down to the next area where buyers were present again. So the whole model of market structure won't work in an auction. Okay. So I'm not here to, because I myself was trading market structure with the ICT concept. I'm not here to talk shit about market structure. Basically, market structure is a very powerful tool that a lot of people use. But how we are going to look at the market is from this perspective: balance, imbalance, balance, imbalance, balance, imbalance, balance, imbalance, balance, imbalance. All right. And we're going to use volume profile to see where the most balance and imbalance has actually happened. So market structure is actually a byproduct of the auction. Okay. So now when we go to the chart examples and I show you what I see, you will stop to look at the market from a market structure perspective. So you could say that it's not possible to say it, but market structure is kind of like looking at the market from an indicator perspective, because you're not reading the market from the truest perspective. You are reading it from one step up, although market structure can be very good. So we will see on the live chart examples very soon. All right, so now let's discuss failed auctions. Now here we have an imbalance period. Market comes up, find our area of balance. So at the lows, we have buyers. At the highs, we have sellers. Market tries to push higher, but sellers become even more aggressive at these expensive prices. So if sellers are happy to transact here, of course, they're going to be even more happy to transact if price starts to go higher. Same goes with the buyers. buyers might find lower prices so cheap that they flood the market, driving the price back into the previous range. So when we create a consolidation range like this, you will see often wicks to the downside and upside, and I will show it to you in the chart as well. These failures often happens right before the market breaks out or returns to balance. I will show this as well in the chart example. This is why we use volume as a map. We are just following the smart money. We use volume to identify where the most trading activity occurred. High volume areas, these represent balance. This is where market has spent the most time because both sides agree on price. This is where the big money trades. So I hope you are getting it right, how powerful this freaking tool is. And the low volume areas, these represent imbalance. Price moves through this area so fast that very little trading actually happened. So a playbook actually is this. If we have a large imbalance in the market, price moved very quickly during a very short time of period that someone just swept all of the order book, of course that will be a very strong market participant, right? So if a seller comes into the market, there should be a very strong seller here. So a very high quality playbook is that we pull back to that low volume node where that strong seller is, because that seller just swept the whole order book, and we look for an entry when we revisit this area and we take a continuation lower. So that is also a playbook in my playbooks. So low volume nodes, high volume nodes, very good area in the volume profile. And we will dive deeper into the volume profile in the next lesson. So instead of looking at swing highs and swing lows, we focus on ranges. Okay, so we don't look at market structure. We look at where we have balance, imbalance, balance. Market move from imbalance to balance. You will notice the volume profile often forms a high volume node as it searches for liquidity and find new value. Okay, so let's go and look at one chart example, because this will all become much clearer when we look at a chart example. But just to summarize everything, now you understand why it's called auction market theory. Market is there to facilitate trades between buyers and sellers. We have advertised prices like the painting or the house or the car that someone wants to buy. And then we have aggressive buyers or sellers coming into the market and saying, okay, I accept that offer, or I accept that bid. And this is how market moves up and down. So when you start to look at the market from this perspective, instead of patterns or indicators or market structure or liquidity sweeps on candlesticks pattern, like this becomes much more powerful. So let's look at the chart example, because I think we're going to tie up everything in that chart example and you will actually see what is happening when I walk you through it step by step. All right, let's look at this. Market rallied higher. We can even backtest the full day, but let's look at this example first. Market had an imbalance period, although it's not a large imbalance. Market rallied higher. All right. And then sellers and buyers agreed to transact in this price action. Why exactly here? Because if you look to the left, we had an area where sellers and buyers were happy to transact as well. Can use our favorite tool, volume profile. And this is why I always say mark the leg in to the leg out, because you're marking the imbalance in, high volume node, imbalance out. So you can clearly see market went up. Find the area where sellers and buyers previously agreed to fair prices and started to transact, okay? And then when market went higher, first off, when market went higher, sellers actually thought, okay, I'm willing to sell. This is even better prices to sell than up here, right? Or down here, right? So market came lower. Then market dipped out of balance again. And buyers said, oh, this is a very good area to buy again. Look at this large wick of this candle. And this was right before when we got this imbalance to the next phase. So with that being said, let's just simply backtest the whole day. And let me show you what I see on the charts instead of market structure. First off, we have imbalance. Then we find balance. Okay. When you see a lot of candles, it is also a lot of volume. Then we get a very small imbalance. Market comes here, consolidates right here. And this is also called a fair value balance phase. But of course, it has to be at the area where price previously agreed on fair valuation, right? So therefore, we have to look to the left. So if we look to the left, I can even place a blue line right here so we can go to the left and see. So if market is dropping here, it means that this is the area, these are the price points on the chart that previously market accepted, like it was a fair valuation of this asset. So if you go to the left, here you will see the volume profile, okay? If I even remove this, you can clearly see that we had an area that market consolidated in, found fair value, and therefore, once we reach there once again, we are at a fair value area in the market. And now I hope that you're starting to see it. Why volume profile is so good? Because if you mark the imbalance in to the imbalance out, that blue line was the low of that day, right? It was during the Asian session. If you use the volume profile, you can actually see where inside of this profile where the most activity occurred, right? So the most activity occurred actually right here. And then the next activity, you can even say all the way up here, right here. So if you just go to the right, this is where the market tapped into. First, we had an imbalance out. The market accepted this range. Then we didn't get a large imbalance out, but market accepted this range. So now let's follow price to the upside. Market came to an area to the left where we accepted it was a fair price when buyers stepped in again. Buyers think that is cheap right now. I want to start buying again because we come to an area where we previously agreed on it was cheap. And now I want to start buying because much better to buy down here than up here, right? So now market goes higher. The pressure of the market is shifting. So where does the market actually go? First off, it goes up to the previous area where we had balance. We had balance here, right? Market goes up. Imbalance up. Creates a little bit of balance. Okay, clearly see, creates a volume. Then buyers are stronger than sellers and they create a large imbalance up. Okay? But of course, above this, they can't go a lot because the next imbalance in the market is right here. You can clearly see the volume profile. Next imbalance in the market is here. So they try to transact and buyers are strong, goes higher. Transact, buyers are strong, goes higher. And then what happens now? We get a large leg up. And what is this? Why do we get a large leg up? Why? Because the next area of balance is here. Okay? And the way we mark volume profile by looking at the higher time frame picture, we know that, okay, of course, the next area of balance is here because we are seeing a consolidation period. And if we mark the volume profile and if we mark this high volume node and go to the left or right, sorry, we'll see a large reaction from it. Okay, we know that. That is what we know. But the way I mark volume profile as well is that I look at the higher time frame picture and look where the leg in or the imbalancing actually happened and mark that whole area. So let's see how I can mark this. Maybe TradingView won't show the perfect data. Okay, actually it actually did. Look at this. You have 3 peaks here. So let's mark out these 3 peaks. These are the areas where we had balance before. These are the accepted or fair prices in the market. So let's mark it. This one we actually went slightly above, but this, right? And then this high volume node. This one we actually went slightly above, but it is because we have to include this as well. So if we include that, This is why we tap that area. But I don't want to clutter the charts. I don't want to mark 100 zone, but I just want to, like you're seeing on the volume profile, right? Where we had previously balanced. We have 4 peaks here. Peak number 1, peak number 2, 3, 4. Okay. These are the areas market accepted. These are the fair value areas of the market previously. So let's look at this, right? Market went higher, imbalance in the market, tapped the area of balance, came down lower. Still, the perceived value of the asset was higher. Market went higher, created a small balance, next imbalance. Okay. When we get this next leg of imbalance, where does it have to go? To the next area where we find the balance, right? Or fair value. So if this was the first area, then this is the next area. Okay. So if the perceived value of the asset is still high, market will go higher. But here it looks like buyers are not willing to transact at higher and higher prices. Now it's becoming expensive for them to transact. So what will market do? Drop to where? Where previously buyers were willing to buy. So, okay, let's see. Where do we drop? Did we drop exactly to this consolidation period that started this whole run? Right into it? Can even mark this high volume node. Didn't we drop to that, to the tick? Okay. So when you see a larger consolidation like this, now we have a strong buyer and a strong seller. And they're going to transact like this. We're going to create a wedge until we get the perceived value of the asset changes and we get a catalyst out. So when do we get a catalyst out? We get the catalyst out here. So where does market have to go? To the next area where we previously had the balance, like right here or here. You can clearly see market went here, stopped here. And this is why it was so hard for buyers to push the auction higher and higher this day, because we had 2 massive areas where sellers were willing to sell. Okay, but since the perceived value of this asset was going higher, like the fundamental analysis of this asset was positive, we went higher. So by understanding auction market theory, where we have balance or imbalance, and where this imbalance will go to the next balance where the strongest buyer and seller are, and look at the pressure that they are building inside of the market, this is how you can truly navigate the auction, that is the marketplace of every forex pair, every indice, every stock, whatever you trade. If you understand this logic, your trading will become much, much better. Like using market structure is just a byproduct of what happens with auction market theory. All right, so I hope it's clear. I hope it's very, very clear. So let's see if we can find a very large imbalance. Okay, so here we find a very large imbalance in the market. Okay, market skyrocket, but there has to be something to the left that stopped price, right? So let's go to the left. Here we see a large imbalance, balance, imbalance. So therefore we know that there is something here, a strong seller here, and this is why we mark from the leg in to the leg out, where previously buyers and sellers agreed to transact. Okay, so if I mark the highest volume peak, let's see if we get a reaction. This is the area where buyers and sellers agreed the most to transact. Okay, up there, drop, because sellers are still present here. Market comes lower. To which area? Where we had balance prior and then created imbalance. Look at this. If I draw this, we had the balance here. Sell, strong buy, drop into buy, goes up. And all of this is based on trends. If you're trending higher, you should, like every supply or every strong seller should only create a small pullback, right? And this is how you can, this is basically how you can see, like if you view the market from this perspective, you can clearly see that the market didn't pull back a lot. And this tells you that the buyer that are bidding the auction higher are not done. They are really, like, this can be a contextual bid as well. Like in this day, like you're seeing the pullback was very shallow. instead of you drawing the Fibonacci, unfortunately what I used to do, instead of you drawing this and say, okay, I don't want to buy at these high prices, I want to pull back to this equilibrium zone or a discounted price to buy. Instead of you like saying that, you can clearly see that the pullback was very shallow and the buyers stepped in and are willing to buy at higher and higher prices. So this can be a contextual hint that we should get a large imbalance as soon as the main session opened. And this is the New York session that opened. Market goes higher. So all of this, strong seller, market drops to where we had balance prior. So we had balance here. We had balance here, and now you may say, how did we have balance there? The most amount of volume was transacted here. Market dropped to this area. In the end, sellers were stronger, and we started to drop. Of course, all of these drops to the left is the areas where we had balance. And once we go to the backtesting, you will see me use this a lot and show you live execution, or not live, but yeah, like replay execution of trades that I've taken in the past. And yeah, this is going to be a game changer if you truly understand. This is how auction market theory actually works. And I think we're going to stop there. So all of the questions that you have, ask them below. I hope everything was logical. It made sense, because now that you understand this concept, you can't view the market from another perspective. It has to be from an auction perspective. I'm not saying that market structure cannot be a very powerful, not very powerful, I'm not going to lie. It cannot be a good tool to use, but looking at the market from auction market theory perspective will give you, like, what you're trying to do right now is to find an edge inside of the market, right? And looking at the auction market perspective on the market will give you that slight bump towards incredible good edge. And like, you can use this skill that you're learning right now, you can use it for the rest of your life to make money. You need to only learn it once and you will make money from it from the rest of your life. So this is why it's so worth putting in the hours and learn this shit. Market structure, I would say that this is a B. Auction market theory is a A+. Okay? Indicators is a Z. You don't even need to think about this. So if you're trading market structure, you are actually way better than just watching random patterns. I used to trade market structure as well. And when I was trading it prior, using it as a higher time frame context analysis tool, it was actually decent. But as I previously said, it was a very hard way of earning money. Now when I view the market this way, I actually trade much better. So with that being said, this video is going to be a long one again. So I hope you enjoyed this, and I hope that you understand now what auction market theory is. It is a philosophy. It is how and why market react from different prices. So let's see. Okay, high volume node right here. Yes, I think we took this example, right? There we go. Boom. Market had balance, balance, balance. Sellers push down, buyers step in, took the auction higher. And you will see me, I actually started to trade on Friday. Today is Saturday. Actually, sniper scalped the session low this day. And you will see it me breaking down in the backtesting trades as well. Why I took the buy trade from here using order flow, volume profile, and auction market theory. I literally entered on the lowest point of the session and market went higher. And this is not the first time I've done so. All right, it is time for today's assignment. And this is going to be a super fun one for you to do, because we have gone over all of the theory and now you have to put that information into a practical framework. So I will personally correct your assignment today. So take this golden opportunity to show me what you have learned and how you can actually mark out different areas in the chart. One of the most powerful parts of this lesson is the failed auction. A failed auction is when the market tries to break out, but the opposite side steps in even more aggressively. So the task for today is that you have to find a wick, or it can be even several candles went outside of the balance, but immediately got rejected and closed back inside. And of course, we're going to we are going to see some chart examples here next. For the analysis, try to explain the market tried to auction higher, but at these prices, the buyers vanished and the sellers became aggressive middlemen. And the question is, are we seeing acceptance back inside of the old range, or is this just a retest before a new imbalance starts? So let's look at some chart examples. So in this example, we see that the buyers pushed the auction higher right there. So we had an imbalance up, and then we started to consolidate. Then sellers pushed the market down, but here buyers thought it was cheap to buy, so they start buying, and sellers weren't able to sell at these low prices. But then buyers took the auction higher and now broke out of this whole consolidation range area. Here, the buyers weren't willing to accept higher and higher prices, and the sellers actually thought this was a very cheap price to sell. So they sold, price came down all the way down here. So market didn't find any buyers inside of this range, but where the market found buyers was at the previous area where the buyers stepped in again. So this was also a failed auction of the sellers lower. And then this was the last failed auction before the imbalance up in the market. So just to walk you through that again, this is a failed auction by the sellers. Sellers are pushing, but buyers are buying. Failed auction by the buyers. Buyers tried to break out, but the sellers immediately sold again. So price went inside of this balance. Here it looks like the sellers were succeeding. It pushed out of the balance, but at the previous area where buyers aggressively stepped in, they stepped in once again, and this time slightly higher. And now buyers totally took control and sellers gave up, and we got the next imbalance up in the market. So just to, if you can't see this directly, if you can't mark this white box directly, you can simply just take the volume profile, because this is what we are doing in our day-to-day trading. We take the volume profile from the leg in to the leg out, and then we see where the most volume happened. So where the most volume happened right here, this is your balance range. So anything above, it is a very good price for sellers to step in aggressively. Anything below, it is a very good price for buyers to step in aggressively. So think in terms of premium and discount. So most of the times, not always, but most of the times, we will have a failed auction right before the imbalance up. So here we had a failed auction by the sellers, and then we got that huge imbalance up. So this is today's assignment, trying to mark the box and just post the box. If you want, slap on the volume profile as well, like I've done here, and I will correct your assignment for you. So with that being said, I hope you guys enjoyed this video, and I hope to see you in the next one. Alright guys, it is time to talk about the volume profile, and I have prepared some infographics on the charts on the whiteboard or blackboard, so we can just quickly walk through them, because this thing is not complicated at all. It's super easy to use, super easy to understand, but how you draw the volume profile, what kind of profile you use, that is the most important part. And we're gonna jump into the charts after this, so I can show you how to draw it perfectly and why we draw it that way and not rely on a time frame volume profile. All right, so let's read through all of this. It isn't harder than this. So the volume profile, what is the volume profile? The volume profile is a tool that shows how much volume was traded at each price level over a certain period of time. And the more experience you get, you will understand what that certain period of time is. But I'm gonna show you what I see on the chart, and I'm gonna give you guidelines, but it requires that you do your own backtesting and you draw the profiles and see where markets is reacting from, And after 1 or 2 weeks, you will get the hang of it. So instead of showing volume over time like standard volume bars, it shows volume by price. The volume profile appears as a horizontal histogram on the charts. So this is the horizontal histogram that we see. If you do have the normal volume candles on TradingView, you will see volumes from the lows poking up, and that is different to this. That is volume by time. This is volume by price. So why do we use it? This is how we know where the most trading happened, where we have high interest, where we have the point of control. So the point of control right here, this is where on the volume profile, on that specific profile that you just drew, was the highest amount of transactions. All right, so this is a very significant area. So let's say that the point of control is at $100. You know that if price is approaching it from the upside, that people are extremely willing to transact at $100. And the likelihood of us touching the point of control and going higher is very high, depending on your contextual analysis. Low volume areas, which is also called LVN, low volume node, are zones where price moved very quickly. So super fast, someone swept the whole order book, some huge buyer or seller came into the market and left the area of low volume. So this would be a best low volume area. Like this is a textbook example of a zone that I would mark in the market based on other confluences as well, and look for a order flow confirmation to short from if we were approaching it from the downside. But we can also say that these areas is kind of a low volume areas, but I wouldn't base trades on it. How I want my low volume areas to be, I want them to be really low. Then it shows that price didn't spend a lot of time because someone was sweeping the whole order book. So volume profile plus auction market theory. In auction market theory, the market is viewed as an ongoing auction where buyers and sellers continuously interact to find fair prices. The market creates balance around prices where buyers and sellers agree, forming high volume bell curve like distributions. And this bell curve, we're going to discuss it here next. At fair prices, many participants want to buy or sell, which cause the high volume to be traded at those prices. So at this exact area, a lot of participants are willing to transact, both buyers and sellers. In the end, at some point, either buyers rise up or sellers rise up, or a catalyst comes into the market and drives the price higher or lower. This is how basically the auction works, right? When price moves away from fair value, which is the imbalance, and by now you should understand the imbalance perfectly, especially if you have done the assignment. Imbalance is created as the market searches for a new value, often moving through low volume areas that act as rejection or breakout zones. So high volume nodes are these, is acceptance areas, it is fair values, and it is balanced prices. Low volume nodes, it is rejection or breakout areas, unfair prices. Okay, we're gonna look at some chart examples with this. All right, so the bell curve, and this is not something that it is good for you to know, but we won't use it a lot here, right? Since this is a volume profile course, this is volume profile 101. You have to understand this, but we won't use this type of trading a lot. Like, it is good to understand, but we won't use it at very sharp zones. So I'm gonna leave it there. But yeah, I'm gonna leave it there. So a bell curve distribution, also known as a normal distribution, shows where the majority of data points are concentrated. So with data points, it is the buyers and sellers. So most value are normally around the medium, right? Around the point of control. This is representing the fair value or balance. The probabilities of an outcome decreases significantly as data moves further away from the centers towards the extremes. So if this is your fair value, think of it this way. If you start to move outside, then maybe it is cheap to sell. So people will sell and come into fair value again. But if sellers moves out to where buyers are present, then buyers think, yo, it is very good to buy right now. So they move price into fair value. So when you have an area where there is fair value, this is the failed auction. When you move outside, someone sells. When you move outside, someone buys. So this is why when you look at the higher time frame volume profile, you can clearly see that when you look at the charts, let me draw it like this. When you look at the charts, and this is the volume profile, you won't see a profile like this, right? You will see different areas. You will see a low volume node, high volume node, then maybe slightly higher, but high volume node, and then market does this, then high volume node. So these are the areas where we have found acceptance. So what normally happens based on auction market, or not based on auction market, what actually happens is that, let's say buyers push the auction or the market higher, then sellers kick in. Then sellers push down, buyers kick in. Buyers goes higher, sellers kicking. And in the end, sellers win. And since there is nothing in price that can stop here, there was no other area where we had acceptance prior, we will drop to a previous price point or level in the chart where we had acceptance. And now we have to see if we accept this area or not. We can simply bounce from it and come up. And if you come up, we come to the previous area and show acceptance. Or if we start to accept it, we can just travel through all of it like this and go higher. Or we can accept this, spend volume, spend time and volume, show acceptance, and maybe sellers are strong and we'll drop to the next area. So different outcomes, but just know that the extremes, which is the value area high and low, are different standard deviation from the beginning, like from the median. So what we use on the volume profile is 70%. So I'm gonna show it to you really soon. And this is called value area high and low. So what is a bell curve? In auction market theory, the bell curve represents market balance. Most trading activity occurs near the mean or point of control, indicating buyers and sellers agree on prices, aka fair value. The tails right here, they represent imbalance and rejection, where price briefly explored before reverting back to value. So an easier way to explain this. So this is how I got that explained to myself from a very dear friend. So imagine like this is the value area high. This is the value area low. Here is the high volume node. Okay. So if this is the volume profile, as you see right here, these are the low volume nodes. So we have low volume nodes from here to here. Okay. And we have low volume nodes from here to here. Let's see if I can just adjust this chart right here. Okay. So how a bell curve, normal, like what we use with the volume profile with the value area high and low, we set the value area high and low to 70%. Okay. Why 70%? Because that is the one standard deviation from the middle. So what does that mean? Do we need to know math, or what does it mean? It simply means like this, think in terms of people heights. So at the most extreme, someone can be, let's say 2 meters and 20 centimeters, right? At the lowest end, maybe someone is 90 centimeters. Okay. So these are very odd people, right? They don't appear a lot when you look at our population. But in the middle, here is maybe someone that is, let's say 155 and maximum 185. Okay. So anything outside of this, this is a very large standard deviation from the mean. And the mean is the point of control. So the point of control right here should be maybe around, let's say 170. What the fuck is the mean of people names? But either way, it could be 175. Okay. So the normal height of people, I guess not 175, maybe. Okay. Let's say like this, 168. This is what the normal average height of all of the people in the whole world is. If you go outside, then you have standard deviations from the mean, and therefore it is very odd. So in terms of a market, like financial market, how this works. So if everybody's agreeing to transact here, if price starts to go outside, then in this case, the buyers think, oh, it's a very good buy. It is a very good price to buy. So they buy it up, price comes in the middle, and then sellers middle. So this is how a high volume node gets created. And you can clearly see on this example that we used to create our assignment in the last picture. You can clearly see it right here. So the volume profile is set to 70%. I think the correct term is like 68.5 or 68%, but we use 70% even on order flow softwares. So you can clearly see that this is the value area high and this is the value area low. Okay, so 70% of the volume inside of this leg of price from the leg in to the leg out was transacted here. So this is how you can spot value area high and low. So what I haven't found a really good edge in this, because I've previously said that I'm always looking for the most sharpest zone in the market. I don't like the market goes a little bit higher, maybe here, and then snaps back in. I want to know exactly where. So therefore, I don't use it a lot in my way of trading, but it is a very good tool that you can play around with, because like in this scenario, you can clearly see that the value is being built here. So if you start to go outside of value, you can look for confirmation short. If you go lower, you can look for confirmation buy. This thing is mostly useful certain time that I use it with high conviction and high probability is during if we have a larger multi-day balance phase. Then if we have this large day balance phase, I short the tops and buy the lows. Easy as that. So every time price pokes out, I short, and based on auction market theory, we should come to the mean, right? To the point of control. Sometimes we bounce from here and go higher. And there is a reason why we sometimes bounce from here and go higher, but let's leave it at that. And sometimes we've traveled like if we take this example, let's like this is M5 candles, but let's say that these are daily candles. Or you know, it can't be day. Let's say these are H4 candles, so it should be a multi-day consolidation period. So what you would want to do is to go on a lower time frame and look for shorts right here and buy trades right here, right? So what most of the time it will happen is that we will travel at least to the point of control. Either we reject and come down again, or we travel through the whole profile, maybe reject at the upper side. In the end, we won't reject like 100 times like this, right? In the end, one side is going to win. A news catalyst is going to come in. Sellers might be tired. Buyers are simply overpowering the sellers, and then we create this imbalance. So do you need to know all of this for our way of trading? No. Is it good to know? Yes. So why not, if we don't need to know all of this, let's keep it simple. Let's now you know the theory of it. If you want to play around with it, go ahead. I can even show you on TradingView how to enable the value area high and low, but it's super easy. Just double click on your indicator and go to the settings and enable value area high and low. And there you will see the 70% bell curve. So now the good stuff. Shelves. What is a shelf? In the volume profile, a shelf is a horizontal area where the volume tapers off sharply, okay? It is usually a steep drop-off or a step in the volume profile. A shelf is typically located outside or at the edge of a high volume node and marks a transition zone between a high volume node and a low volume node. Balance area versus imbalance area. So this isn't the perfect volume profile to take this in, but we're gonna explore some chart examples after this. So what is the function of a shelf? When price moves inside of a balance area and does not want to break out yet, shelves often act as a support and resistance zones. So you know that bell curve, right? So if we have this bell curve that we just discussed, if this is the value area high, so of course this value area high is going to be a shelf as well. So if price isn't ready to break out, it will drop in. So basically where the volume is tapering off is the shelf. So I'm gonna show chart examples on this again very soon. So let's take an example. When price moves to the upper shelf of a balance area, there is a higher probability for price to reverse. I know traders that only trade this way. They only trade auction market theory based on balance and imbalance and shelf and mean reversion and all of those strategies. But an easy way to think of it is simply that it is a failed auction to the upside. So if we tap the shelf to the upside, it is a failed auction by the buyers and we come back in. So very easy. So because a shelf is an area where high volume tapers off and transitions into low volume, it also means that prices are becoming increasingly unfair. Remember, at fair prices, much volume is traded. At unfair prices, less volume are traded. So at low volume node, less volume is traded. So let's take some chart examples and everything will become super clear. Now let's go through the same example that we discussed when we were talking about setting up the TradingView. So I just want to show you how to set up the value area high and low. So you just enable them or disable them. So if you want to play around with it, if you want to do your own backtesting, do so. But as I told you, I can clearly see where the volume is slightly darker on my volume profile. This is the value area high. That is how I set it up. And if you copy my settings, that is how your profile should look like also. So if you want the lines, you can enable them. If you don't want, just close it. So going back to that same example, we saw that price came to this area. Okay. It came to this area. So how should we read this? How should we read this? So if we look at this example perfectly, we can do like this. If you are just concentrating on this high volume node, we can find 3 different areas. So let me see if I can just make it to 100%. Nah, it's not. Yes, 100%. Okay. So this is without the value area highs and low. So now I clearly see where the most peaks and valleys are. So if we go with auction market theory, first off, we understood that this was a very unusual, or was it here? It was someplace there was a very unusual data that we shouldn't, yes, I think it was here. So if we mark this out, we talked about it in the setting up TradingView, right? This is a very unusual amount, and usually this is people closing their books before Christmas. So we have to skip this volume profile. This is not something that is very normal in the market. It's just because we just had New Year's price action and Christmas price action. These are a slightly more normal volume profiles. So let's look at it, right? We can even include this, but we just know that this isn't, we can't count this, okay? But we can even include this in our example. So what we are seeing right here, and we can also, no, let's not do that. So what we are seeing right here is that we have different areas of acceptance. We have acceptance here. We have acceptance here. Little to no acceptance here. Then here starts very large acceptance. And then if we drop from this high volume node, this is the next area. If we drop from this, this is the next area, and so on. Okay. So with that being said, there are 3 different levels in the volume profile that will give you super sharp sniper entries. And if you combine this with supply and demand and also big trades, this will become like very good. Either way, so if we have this profile, so what is the shelf and what is the high volume peaks? So as you know, if we are going to accept this high volume node, if we are going to accept these fair prices, we have to go in, like if you're coming from the upside, we have to go in and start to spend time. Time equals acceptance. If we spend time there, we're accepting that price, okay? But if we reject it quickly, the market is not accepting this price point. So therefore, we can use the shelf. It is exactly where the volume has tapered off to where the volume increases the most, okay? This is called the shelf. And therefore, the lower part is also called a shelf, okay? This is a very tiny volume profile, so we can't draw many zones in it, but we can use this one so I can show you how to mark different zones as well. So we have these 2 areas, right? So if we go to the right, we can clearly see market came to the first area. Market didn't accept these price point. Market didn't accept this high volume node. Market didn't want to transact here, or the buyers here was simply stronger than the sellers, so they swept the whole order book. And you can clearly see that we rallied from that area very quickly. So on the London session, without seeing the order flow, I wasn't trading this day. I'm 1 million short that I would have taken a buy trade here, because I'm seeing on the candlestick patterns alone that I have a playbook working out. Even if I took this buy and got break even, I'm 100% sure I would have taken this buy. And why do I want to take a buy from this level? It is because that we have a shelf. Okay, a shelf is exactly where the volume tapers off, both to the inside and outside. So what do I mean by that? This is where we go into the volume profile, right? And this is where we go out of the volume profile. So what you will find, sometimes market does this. Where is this tool? Here. So sometimes you can find that market does this. We can react to this volume profile in 3 different ways. So in order for us to understand this, let's use a larger volume profile. Let's use even a easier volume profile to read. Let's say, okay, this is just new. Let me see if I can find a good volume profile. Okay, let's use this one. We already have it plotted. So market can react differently to 3 different areas. So first up, we have the shelf, right? This is the shelf. And in this volume profile, you will see that the point of control is here. This is where the most volume was transacted. So what I personally do is I incorporate this as well. Okay. But since we have 3 different areas, so this is the first area, this is the shelf, this is the high volume node, this is the point of control. And I would also, to be honest, mark these areas because it is like poking out, right? So I would mark these areas as well. This maybe not as much, but the shelf 100%. Okay, so the bottom part of the shelf. So let's switch this to 100% as well. So we exclude the value area high. Oh, this just messed up the whole thingy. Let's draw it. I think I messed it up. Give me one sec, guys. Where did I draw that? Was it from the Asian low? Oh, yes, it was. Okay, so with that being said, look at this. We have a high volume node. We have the most amount of volume occurred here. You can clearly see that this is the point of control. We have the shelf down at this low. We have the shelf at this top. So what usually happens, what market usually does, it can react to 3 different areas. Either market drops, reacts sharply, or from this area. This means that the buyers here are very strong, or the market is not accepting to transact at these prices. But I'm gonna go away a little bit from auction market theory terminology because I really like how we explain buyers and sellers. Explain the market from the buyer and seller perspective. So if the market is coming down and the buyers are very strong at the area of demand, then if we react sharply, then that is a very good area to react from. But we can also drop to the point of control and react. If we drop to the point of control, and let's say we spend a little bit of time here, and this is showing acceptance, market is accepting this high volume node, then we will drop to the next area. Okay, let's say we start to accept this area and market just stalls here, and then some catalyst comes in, then this is the next area. Okay, so time equal acceptance. The more time you spend there, the likelihood of us rejecting that area is much lower. But that doesn't mean that we can't come here and we start to build a little bit of volume and then we have a failed auction to the downside and market skyrockets to the upside. So this is very usual as well. This is why I love to combine this with my way of reading supply and demand, because I can refine this even more. Either way, now in this volume profile that we talked about, let's zoom in a little bit. We reacted to both areas. Okay, first the volume rejected this high volume node, or market rejected this high volume node, pushed the price higher to where we had previously strong sellers, right into the point of control. So if the point of control is here, we tapped it on the tick and dropped. So what does this tell us? In between, there were no one willing to transact. No fair prices in the between, right? This is where the buyers were. This is where the sellers were. So buyers pushed the auction higher, sellers pushed it down. Next time we came into this volume profile, we started to build acceptance. Sellers pushed and pushed and pushed. But when we came to the outermost edge of this volume, because there was nothing in between, there was no acceptance in between, market rallied higher. So this was a failed attempt of the sellers. Market rallied higher and sellers took control. So why did we get this huge sell-off? Why? Because if you look to the left, there were nothing in price that couldn't stop it. So now you may be asking, okay, what was it that stopped it? Simply the shelf. Okay, if you mark this shelf, and now as you know, I would even mark this point of control because they are like attached to each other. So they are very close to each other. We don't need to mark two zones when they are so close to each other. So if I mark this, go to the right, this is exactly where market dropped. So are you seeing that I'm giving you the secrets of the market? I don't know if anybody, like if someone could explain it this easy to me while I was starting out, I would be super happy. When I was starting out, nobody could, like, they explained it, but they couldn't teach it this easy. So you get the idea. Strong buyers are present here, strong buyers are present here. Sellers are pushing. Here, buyers take control. Sellers pushed in again. Here, buyers took control, went higher, and then sellers took control, came here. Now we are rejecting. So depending on how the overall context looks, and this is how I develop my context framework. Every drop in a bearish market, in a bearish trending market, is likely a continuation, and every rejection or a pullback is just a short-term intermediate pullback. So as you see, we are trending lower. If you use market structure, we are simply breaking lows and respecting highs. So therefore, every pullback is to an area where we have strong sellers, and sellers will push until the sellers are not willing to sell anymore. And that is the point that buyers totally take over the market. And I have a pre-market video where I say to my students, this is most likely, after all of this downfall, this is the most likely, like this will be most likely the lows. And how could I know that? Because I'm combining the volume profile. Okay, let's say that the market even dropped from this high volume node to this. It could easily do so. But what I did, how I could be so confident that this would most likely be the low, is because of the institutional activity that happened here based on the big trades. Let me see if I can bring in the chart so you can actually see it. So unfortunately, I couldn't show ATAS itself, so I took a print screen. So let me tell you why I said that in my pre-market session videos to my students that this will likely be the lowest point of this range. It is because, like, you can clearly see that the market is dropping, and at these lows, there is a lot of institutional activity, a lot of selling. Look at all of this selling. Like, it's a very unusual amount, right? A lot of selling here, okay? And as a result of all of this selling, and you will understand it even more perfectly once we go through order flow, as the result of all of this selling, market was up here. While I was doing my pre-market analysis, it was right before the New York session open. Market was all the way up here. So with that being said, I'm not saying that I predict the market, but I can have a very good qualified guess. And it is not like always that my qualified guess will 100% work out. But when you use the right tools like order flow, volume profile, and you understand auction market theory, you can have a very good qualified guess, and that is the only thing that requires for you to have an edge in the market. A very sharp qualified guess. That is it. So with that being said, this was the lowest point, and lo and behold, we broke all-time high. So very good qualified guess, right? Not at a random area inside of the market, at a specific area inside of the market with the specific conditions where we see very large institutional buyers stepping in. So I don't know when you will watch this video, but if you watch this video, this is the 2nd of January 2026. It still feels weird to say that. Mark out this whole zone. And if price has come here in the future, if price has come here, you will see a reaction. most likely a very good reaction as well. So if price comes here, market will react this way. So how can you, like, if you forget to do this, how can you know that we will have a good reaction there? So you mark this whole ranges volume. So okay, so mark this whole range, or this is going to skew the picture a little bit because this is also during the, how can I say it, during the end of the year when people are closing the books, but still you have this high volume node right here. So you can mark it this way, right? So in the future, when market drops here, just tell me in the comments if we reacted to here or not. We can even react to this one, but this one, based on my market experience, is going to be a very, let me see if I can refine that to a good supply. It's demand, sorry. Go with this volume profile. It's gonna, I don't need to refine it right now. But yeah, go with the volume profile. Let's see. Yeah, I would mark this whole area as a very good demand area. So tell me if we reacted to this or not. So by that, you only need to pay attention to three different areas in the volume. So let's see if you can find a clean volume profile. You need to pay attention to the point of control right here. You need to pay attention to the shelves right here. And you need to pay attention to the low volume nodes, and not low volume node like here. Like this is not a good low volume node. Okay. You want areas in the market where we truly have lowest volume node. So I've seen traders explain low volume node on YouTube and in podcasts. What they actually miss to tell everyone, or I don't know if they're withholding this information, is that a low volume node that is going to work out perfectly, and this is going to be a very golden nugget right here. Our low volume node that is going to work out perfectly is going to be an area in the charts where we truly have a very low volume node. Let me see if I can find something for you. Give me 1 second, I will come back. Okay, so I think I found one. I haven't measured it yet, but this is what ICT traders would call a fair value gap, right? But as you see, there is a lot of fair value gaps in the market. How can you know which one is the strongest? So I'm going to give you a pro tip right now. This is worth a lot of money. This comes with years of backtesting and understanding which of the low volume profile has the highest probability of working out. In this leg of price, we have a fair value gap or a low volume node right here. You can clearly see it on the candlestick, and we reacted sharply to that. So let me draw this. If I measure leg low, so we have a very low volume node. This itself, okay, it is a quite good area. It is a area with like very tiny volume compared to everything else. Very tiny volume. But what makes a low volume node extremely good, let me see if I can bring 𝗧𝗛𝗏, and I hope that I will nail the point then if I just can bring in 𝗧𝗏𝗏. Just give me 1 sec, guys. All right, so we have some images right here. So inside of this area where we have the low volume node, okay, inside of that area, this is what you would want to see. And I don't know why I'm telling you this, because this will put you in the 1% league of people understanding fair value gaps or low volume nodes. When you have a low volume node right here, what you would want when the low volume node has a very high likelihood of working out is the big trades popping there. Is these big trades popping there? Okay. So when you have a big trade popping inside of a low volume node, that area will give you a very nice reaction. So what is a very nice reaction? If you see that this high went exactly into this low volume node and dropped, that very nice reaction is this. Look at the amount of sellers that came in once we tapped that area. Do you see it? Like huge amount of sellers stepping in, stepping in, stepping in. And since I was watching the book map and I was trading this live, I remember that there were a wall of bids, of buy limit orders below price all the way down here. Even though it was a huge amount of buy limits order present below price, these sellers that were inside of this low volume node melted the market. So this is how you can, I don't know why I'm telling you this, but this is how you can make your fair value gaps or low volume nodes incredibly strong. But just know, trades from low volume nodes is not something that will happen a lot. They can happen more than ever, like more so they are a short-term intermediate low. They are not usually like this high held for a while, at least until it got taken out. And this is also another thing. The highs that are created in the low volume node are most likely to be taken out in the near term future as well. It is very uncommon that I've seen highs like the sellers that step in from low volume node hold for long. Okay, so that's one thing. I'm not saying it won't happen, but game of probabilities, right? The probability of that high holding is much less. The probability of a supply, which we have right here, is much higher, that buyers drop to that supply. Because if you go with the ICT, yes, you have a fair value gap. Yes, you have a low volume node. Maybe you are missing the big trades and that's why we didn't react to it. But the supply, the probability of the supply reacting is much higher than the low volume node. All right. So I'm going to leave you with that. So don't go on the charts and mark all of the low volume node. Know that if you're going to take a trade from it, it won't happen. You won't have trades from them. Like you won't have major moves, like this in this case we had, but you won't have major moves from them on intraday basis, but they can actually work with the correct logic, right? So right here, you may say that, okay, market tap this low volume node, that this was a fair value gap. No, market literally taps the lowest point of where we had the most volume. Okay, so it is not the fair value gap that is working. It is price is rejecting this high volume node. That is why we are dropping. Price went out of acceptance. Buyers tried to push the market higher to create a failed auction, but sellers said, no, we are heading lower. And this is why price went lower. So now we have information overload. There is a lot of things to talk about, right? But to sum everything up, when you have a volume profile, 3 areas are the main areas that you should pay attention to. The peaks, the most, like the areas in the volume profile that is peaking out the most. Okay, let's draw this. The volume, the areas in the volume that is peaking out the most. So this is peaking out the most. This is peaking out the most. So if you mark out this area, go to the right, reaction. If you mark out this area, now I don't want to make it too big, but you can just take the area where we have the largest peaks. You can clearly see it is the largest peak is right here. Go to the right, reaction. Okay. And then where did the market drop into? The shelf, right? Reaction, didn't accept lower prices than this, went higher. Where did the market go into? Measure the volume, high volume node, and where did this high tap into? Where the shelf is starting. There we go. So it is very good, right? It is super good. So I hope that you're seeing the power of this. I hope that you're literally seeing the power of this. So I'm going to leave it there. It is information overload. In the course, we have, I think, 50 backtesting videos, and in many of those we use the volume profile. So this is a very powerful tool. You just have to understand how to use it. All right, now it is time for today's assignment, and please take this golden opportunity to do this assignment because I will personally correct what you have done. So what I want you to do is to mark a leg in to the leg out like you did in the TradingView example, but this time I want you to mark the interesting areas in the volume profile and tell me if price reacted to those areas or not. So like in this case, like the case that we drew before, let's take a new case so we can so we don't take the same thing that we have been studying over and over again. Let's go a little bit backward. Let's go backwards. Okay, let's measure the volume. Can we measure from this leg in all the way up here? Okay, so here we do have a shelf and then we have the point of control. So what I want you to do, like in this scenario, I would want you to just mark out this shelf right here, and then show me that how your market is giving a reaction. Okay, please show this to me, and also try to find out where the reaction went into. So in this case, your assignment will be to find where we have strong buyers and when we have strong sellers. Okay, so this would be your so as you see, like in this example, if I draw from the leg up to the leg down, yes, we do have a where the volume is like coming in. So this would be the shelf. As you see, this would be the shelf of this volume profile. This is where the volume is tapering off, right? And if you go to the right, we reacted to it perfectly. But what you can also do, like in the first assignment when you were drawing volume profile, instead of you drawing from the high to the low to see where this highs and this highs tapped into, try to draw it from the leg in to here and see if it makes it better and why it makes it better. So even if you draw it this way, you have a higher volume node. You have two very interesting levels. You have this area and then you have this area. So you have the point of control inside of this high volume. Although this is not the best high volume, but still it is where market had shown acceptance and transacted before. And then if you go to the right, you can clearly see that the first touch was on the shelf and the second touch was inside of the, like it went into the high volume node right here. So it went into this and rejected. That was the second trade. And once you find, like in the course, once you understand fully how to mark supply and demands, this is how you can sniper entry these zones, because then you're going to combine it with a supply and that is your sniper zone in the market. So with that being said, I'm going to leave the instructions on how you should do this assignment below and post your results in the community feed, and I will make sure to correct your assignments personally. So with that being said, I hope this lesson was super informative. I hope that you found the thing that you were after. So until the next video, talk to you then. Now let's speedrun order flow and make it as easy as possible, because I really don't know why people make it harder than it is. This is going to be my version of teaching you order flow simplified as much as possible. Of course, every tool you can go very deep into it, but in order for you to start using the tool, we have to make it simple and understandable. So what do I mean by that? The thing is, inside of the market, you can execute two different ways. You can either be aggressive, and with aggressive, I mean that you are a person that press market buy button. You just want into the market right now, okay? So that's why you are aggressive. Or you can be passive. When you are passive, you are just placing a limit order. So two different ways of entering the market: with an aggressive order, with market buy, or with a limit order, right? And that is a passive order. So with that being said, the passive orders, we call them offers, okay? Or ask. So when you look at the footprint, you have bid and ask, right? But a sell limit order is often called offer or ask. And this is the sell limit order. Then we have the buy limit order. This is simply just called bid. Doesn't have two names like this kid right here. So this is simply called a bid. So when someone is saying that we are bidding up the market today, it means that the buy limits are pushing the auction higher, so to say. And then we have the aggressive market participants. Keep in mind, the aggressive market participants are those that press market buy button, okay? And these are simply shown by the big trades. So when you see the bubbles, especially in the bookmap, we're going to walk through the bookmap example as well, you are seeing the aggressive market participants come into the market. So if it's red, you are seeing a red bubble, like it is a seller, sorry. If it's a seller, you are seeing a red bubble. If it's a buyer, you're seeing a green bubble. Easy as that. So what you are trying to do when you read order flow, you're trying to see interactions between the aggressive market participants and the passive market participants. And what do I mean by that? Let's look at this footprint example, bookmap example together. So imagine this. If you are coming into the market with a 350 lots of sell orders, we can say that this is 350. And now you can clearly see why the big trades in 𝗧𝗛𝗓 has a slightly higher advantage than bookmap, because you don't see how many orders are inside of this. Of course, there are indicators on bookmap that you can enable for this, but they are not that accurate as 𝗧𝗓𝗓. Either way, if you are a seller here, if you are selling, imagine this. If you enter market sell button, what do you want the market to do? Go down, right? Okay. So this is what we mean by if someone is selling, we have to see if they are getting follow through. Also, there is other words for it. If someone is selling, we want to see if they are getting rewarded. So what do I mean by rewarded? If you are selling with your big bubble, you want to see that your sell order is getting rewarded, which means it's pushing the market lower. Okay? And why is this important? This is the only thing that you need to know. If you see a large order coming to the market, you want to see if they're getting follow through, that market is going in the direction of that order, or if market is going against that order. So why is this so important? Look at this. Here at this low, we had a huge seller. A large amount of selling went on at the lows possible. But simply, there was a buy limit order waiting there. Why did it draw this way? There was a buy limit order waiting there. In order for this buy limit order to be executed, someone has to sell into him, right? So big institutions, they don't usually, I'm not saying always, they place limit orders. They can be an iceberg order as well, but let's not dive into that. They place a limit order, and we can look at the bookmap example right here. So in order for that limit order to be hit, you need an aggressive market participant to come down and say, okay, I'm selling, but this guy, of course, when he's selling, he wants the market to go lower, but this buy limit order is absorbing all of this selling pressure. So this is how absorption look. Market is selling, 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 selling. At some point, sellers do not think it's worth selling. People will stop selling, and also the buy limit orders are more than aggressive sellers. So imagine this. If we have 1,000 lots of buy limit orders and sellers come into him, 350 sellers sells, and then maybe the high frequency bots and everyone, like there's a lot of algos in the market as well, notices, oh crap, no one is selling anymore. There is a buy limit order absorbing all of our selling pressure. So therefore, market goes up and people start to buy again. It's super easy. You just want to see if someone is selling, if price is going with them. If it's going against them, they are getting absorbed. Okay? Same goes with the buys. If someone is buying here, you want price to go higher. Okay? We are coming to a large sell limit order. We want to see that, okay, is this sell limit order strong to hold these buyers down, or will the buyer outpower these sell limit orders? And one of the most important thing about order flow, you don't open a random chart. Oh no, you don't open a chart and go to a random place and look for the order flow there. This is why you have to have pinpoint razor sharp zones to see if you can look for order flow confirmation. So with that being said, look at the bookmap right here. So what do we see? We see a lot of buying up top right here. Let me zoom in. Let's remove this as well. Okay. We are seeing a lot of buying here. Okay, market goes up. A seller tries to sell, but into who? A strong buyer that is happily glad to buy again. The market goes up, and at the top, we get the most amount of buying, but market doesn't go up anymore. And also these lines, these faded lines, these are just sell limit orders. So buying here, market doesn't go up. A lot of buying here, market doesn't go up. A lot of buying here, market doesn't go up. So this means that there is a sell limit order, also called the offer or ask, resting here, absorbing all of this buying pressure. So Buyers give up, sellers step in. Right here, sellers step in. So when you see this, as if this was your level, this was your resistance, this was your supply, this was your volume profile level. If you see this, absorption, so two steps. You have absorption, ab, plus ag. Two steps, right? Absorption up top and aggression. So buyers getting absorbed and sellers stepping in. Two steps. It's very important that you don't take a trade based on simply absorption. In the full academy, I literally have like I think 5 to 6, 7 different confirmation models using order flow. But the simplest one that you can take right now and start to trade with is absorption, aggression. That's the only thing that you need. Like this will put you ahead of so many traders. Like you will be in the top 1% of the 1%. I promise you. Mark your level, high, like shelf, VPOC, low volume node. Market comes up. You see this, you wait. You see this, okay, maybe you wait a little bit more, but when you see prices starting to respect these sellers, you go into the market. Also, very important note. Here we see a lot of bits, aka buy limit orders. We see buy limit orders here, buy limit orders here, here, a lot of buy limit orders. Are you seeing this? But basically, how the auction works is that sellers are willing to sell right there. So these buy limits orders are not managing to hold up the pressure of the sellers. So sellers sell, like they think it's good to sell. So they sell. All the way. Let's see, all the way to where? All the way. And fun fact, I actually caught this trade. So let's backtest this trade as well, I think. I actually took this trade down at this low right here. Took the market higher. Either way, not going to rant about that. So sellers are selling. Okay, they're going lower. They just ate up this buy limit order. Sellers are selling, going lower. Okay, buyers tried here. Small pullback, but look at this. Once we get the small pullback, there is a sell limit order. Okay, so a failed auction, a failed attempt by the buyers. Sellers come in, boom, 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 boom. In the end, the most amount of selling, you see the darkest red spot is here. This was you can clearly see like how bookmap works. If your buy limit order is here, it will show it. But this came in like 1 millisecond before the sellers came here. So how can I describe this? There is someone knowing what they are doing inside of the market. So they are just waiting for price to come to a certain price point. And at that millisecond, they place their buy limit orders. So once I saw this, accompanied with the zone that I was taking the trade, of course, supply and demand, volume profile, and all of that. Once I saw this huge absorption, aggression, market long. And this was a 6-7 hour trade. So important note here. Just because you see a buy limit order resting, like huge amount of buy limits order, it's very dark spots. It doesn't mean that necessarily the market will go and bounce here and go up. I see traders do this mistake a lot. You have to see what happens when market comes to that buy limit order. You have to see if sellers come to this buy limit order, are they managing to push below, or the sellers stall here and buying come in, and then you go take the buy trade. Easy as that. Order flow is so freaking easy. You have to only know one single thing. You don't need to even see the buy limit orders. It's on like how I trade with M1 and big trades. I don't even see the buy limit orders. I only see if I have a red bubble. Okay, let's say 700 lots of trade. Let's say, I think it was the example that we took in the ATAS setting up video. There was 700 lots of sellers, but I saw that market went up. Okay, this means that sellers are not selling anymore. They're not pushing the auction. They are not managing. There's a buy limit order absorbing them. So that is why I went long on that trade. I showed you in the setting up ATAS video. So just to recap, this is very important. If someone is selling, you want to see if they are getting rewarded for their effort. in simple terms, if someone is selling, you see a big seller coming, you want to see if the market goes lower. Okay, this is what a seller wants. But if someone is selling, but market goes higher, then you want to buy. Of course, wait for, let's say you have your level here. Wait for price to come. You see a lot of selling, okay? Nothing happens, but it doesn't mean that you should take the trade. But literally, like in the next 1 second, someone more can start to sell. Wait for all of this absorption. Wait and see what happens after the fact. If all of these sellers comes in, and then you see buyers also comes in, step number 2 met, step number 1 met, and step number 2 also met. Absorption plus aggression. Now take the market long, take the trade, super easy. Need to overcomplicate it. Of course, let's look at the M1 big trades. So here you see like bookmap, you can see the limit orders. But for me, seeing the limit orders doesn't, yeah, of course it can give you an edge, but it can also make you overthink. Because if I'm seeing all of these limit orders, I would say to myself, I wouldn't sell from here because I'm seeing a lot of limit orders. But look and behold, sellers ate up all of these limit orders. So it has happened to me actually that I've missed trades based on basing my decision on the resting orders in the market. Resting orders in the market mean shit. I promise you, resting orders in the market literally means shit. Because we do have something called the iceberg order. So how these big hedge funds or let's say Warren Buffett or whoever, like a huge institution are doing, they are not showing like this their limit orders. What they are doing, they have high frequency bots that when price comes to an area, you don't see any lines like this. You don't see the liquidity. But what they are doing is that they are fractioning in the orders. What do I mean by that? They have high frequency bots, like they go in with 10 lots, 10 lots, 10 lots, 10 lots. So very quickly. So you won't see that there is a limit order, but you will see that price is not going higher. Everybody is buying, a lot of buying, there is no limit order, but price isn't going higher. So these are the tactics of institutions as well. So this is why not important to, like, I know that a lot of traders hype that it's very good to see the limit orders, but how can I trade how can I trade by using just this? I don't see limit orders. So let's go through M1 big trades. Let's actually follow what happened through this whole price action. This was actually yesterday. And I actually had a zone here that I wanted to take a sell trade from. So let's follow along with price action and see what happened. So here we see that market is going higher, going higher. Okay, what do we get? We get a large buyer coming into the market. Okay, right before that, we get 100 lots of, I can't make it smaller, 100 lots of sellers and buyers, and market went higher. So who is this price rewarding? Who is getting follow through for their effort? Buyers, right? Buyers push the market higher, and then market pull back, wicked this buyer 2 times, but still the buyer wants to buy more. He's buying, and it's very visible by looking at this. The buyer is still buying. Look at this. 93 lots came into the market. So with that said, the buyer has moved to here. Market comes down. A lot of selling going on. Look at this. 594, 529, 198, 100 plus 82 into the same buyer. Where is this pen? Okay, into the same buyer. He held up price again. See, I don't even need sell limit orders to tell me this. I can clearly see a huge effort by the sellers, but they imagine all of these contracts just managed to move markets 2 M1 candles. Like, I would be super mad, right? And the funny part about trading, how can I say it? Trading order flow or trading futures was the correct term, is that if these sellers are selling, if there are actually true sellers inside of the market, because this can if there are actually true sellers inside of the market, let's say that they have their stop loss above this week, their stop loss is a buy market order. Let me explain that again. If I sell here, my stop loss is here. I enter the market with a sell market order. My stop loss is a buy market order. So if you put one and one together, you will understand how powerful it is. If you go above a high that there should be stop losses in, their stop loss is a buy market order. And what does a buy market order do? It fuels the price to go higher. Are you seeing how powerful this strategy is? So if you're like, why do you think this book map? Look at all of these sellers, You would imagine that their stop loss is here, here, right? So when you buy here, this trade literally took me, 10 minutes. It mooned after this, like 6-7 hours, because it got fueled by these sellers' stop loss. Okay, so a little bit different to stop hunt thingy from ICT, right? Either way, let's not go there. Look at this. Pushed higher. So we know if 700 lots of sellers comes in, we have even more sellers, but price isn't going lower. How can that be? We have a bid, aka buy limit order here. Okay, in this general area, it doesn't need to be to the tick every time. It doesn't need to be to the tick. So in this general area, we have a demand for buying. The demand for this asset is high, right? So in this general area, and I was looking to short here, and when I saw this, my short started to look worse, because I know that there is a strong market participant willing to buy this high up in the auction. So if I'm gonna short here, this guy is a major roadblock for me. So market came to my level. I'm ready to short. I see a lot of selling coming into this area. Very unusual. A lot of selling coming into this area. So did I press sell? No. I waited to see what happened with these sellers. Market literally like so much selling. Market is trying to go lower, but not managing. So what does this mean? Again, buy limit orders all the way up here. Maybe the book map is not showing me, but me understanding the relationship between a limit order and limit order and a market order is showing me that these sellers are trying, but they're not getting rewarded for their effort, aka buy limit order, bidding up the auction higher. So me personally, I think I took a buy trade here. Yes. So I was in a sell mode. This is why it's so good to use order flow as well. I was literally in a sell mode. This had a potential to come lower. We had a huge imbalance in the market. We were bullish. So this was just a pullback to a higher time frame demand. And I was expecting a continuation. But when I saw this, like this is why it's so important to read the information the market is presenting to you right now. Not what you think, not what you have planned, the information that's being presented to you right now. So if you trade candlesticks and you're planning a trade from a zone and price comes to that zone and trade fails, yes, you followed your strategy, but you didn't follow the data. This is why order flow is so powerful. Okay, nobody talks about this. Okay, so what happened? I'm seeing all of this selling. Literally 5 minutes ago, I wanted to sell, but now I'm seeing that sellers are weak. Let me bring up the Discord as well. Okay, look at this. Sellers do not look strong today. Yeah, there's a lot of big sells came in, but no reward. Okay, yeah, no trade yet. So I wait like a sniper, like a lion, like someone trying to catch his prey, and I see what happens. I'm seeing, let me move this, all of this selling pressure. Market is not going lower. Market tried to auction lower. If you watch the auction market theory course, this is a failed auction. See, dipped below. A lot of selling immediately went higher. Failed auction. And as I told you, what happens right before an imbalance in the market, we get a failed auction. The last attempt from the sellers. This is the last attempt. They got absorbed. They gave up. Market went higher. Unfortunately, this trade was at the all-time high. And yes, market went higher, but came back here and stalled a lot and then went higher. So I'm not in the business of holding trades for those amount of pairs. So let me actually show you the charts. Oh, never mind. I have to open Atlas again and I don't want to wait. Either way, So now you're understanding the relationships between the aggressive market participant, aka market buyers, market takers as well. And you're seeing the relationship between the passive market participants, aka limit orders. So what do you see on the depth of market? On the depth of market, you see bids, aka buy limits. So here I can see all of the current buy limits. Here I can see the current sell limits, ask, sell. And here, buys into ask, I can see the completed transactions. Okay, sells into bid. Easy as that. Do I use this? No. Is it good to know? Yes. Also, what is the delta? It's very important because we use the delta in the footprint as well. Delta is literally, let's say we transact 30 cells, okay? 30 sell contracts, but on the other hand, we have 42 buy contracts, okay? Like this, buy contracts. So the difference between this, how much is it? It's 12, right? So the delta should be green because we have 12 more buyers than sellers. Easy. So briefly, I'm not going to show you all of my footprint execution and confirmation playbooks, but briefly look at this low. And is this from now? Because I was telling my students, I don't want to start at us. I was telling my students in the Discord that we have a level. I think I took it from now. I'm not trading, but if it's from now, my trade idea is working out. Why is my trade idea working out? Because let me see if I can bring TradingView. TradingView is quick to start. Okay, here is TradingView. So I had this high volume node marked out. Nothing special. A high volume node, something that is poking out. Also, combine it with how I read supply and demand. You won't even see it. But this low, you see market is up here, is the footprint that we are going to look at right now. So market is going higher. So basically bounce on this high volume node and going higher. So okay, my trade idea is working out. I just missed it because I was building this course. Either way, doesn't matter. Look at this. Market came to that area and I told you it need to be at your specific area. What are you seeing at this low? I know you won't see the numbers, but on the left side, it says 88. On the right side, it says 10. Okay? So we have 78, like deduct 10 from 88. We have 78 more sellers than buyers. So if you are in your level, you come to that level, everybody is selling, but market goes higher. What is that? A buy limit order at your level. So absorption, and here you see buying coming in. You see buying coming in, boom, market long. That is, ladies and gentlemen, order flow. Of course, there is a lot of playbooks. Me personally, like I told you, I have like 5 to 6. I haven't counted all of the order flow confirmations. Sorry, not playbook, confirmations. I have 5 to 6 different order flow confirmations, all ranging from a very, how can I say, very high win rate to a very sharp entries. Okay. So combining this order flow confirmation with the playbooks from that specific areas that I'm showing you right here, I hope that you're seeing the power of how powerful this type of trading can be. You're literally taking the best zone in the market and you're reading the best data available possible that you can get your hands on, and you are seeing the true interactions between buyers and sellers. Literally, there is no other tool that is better than this. I don't know. I'm hyping this up, but if you are here in the course, if you watch all of the video, if you understand how auction works, this is how you trade the auction successfully. So, with that being said, I really like to hear your thoughts about this. This is order flow simplified. Literally, Buy limit order, sell limit order. Someone sells, you want to see if price goes with them. If not, then someone is absorbing. Very easy. Simplified a lot. We don't need to go deep. We don't need to show 100 different playbooks. We don't need to show different confirmation models. We don't need you to put fine terminology into it. Buy limit, sell limit, aggressive market participant. Is he winning or no? Okay, finished. Easy as that. So let's go with that. I really want to hear your thoughts. Do you think this is amazing? Do you think this is bullshit? Do you think maybe this is too complicated? Believe me, like looking at this price action for 1 week and studying it, like journaling it, going back each day and like I didn't study this price action right now. Okay, right before I came into this, I just took a random because I saw this on Atas and I took a print screen because my mission was to explain that we had a lot of selling, but market didn't go lower. But I started to look from here and analyze and explain step by step to you, right? Didn't practice it. I'm just reading the data that the market provided me. Okay. And what do I mean? Like, what's my end goal with this? My end goal is that if you took a sell right here, you took a loss. Don't be mad, Habibi. Go back the next day, journal, and understand your mistake. But this time, you will understand your mistake. There is, not 100%, but there is 80% a reason why you took that loss. With that being said, when I'm about to take a loss, around 70 to 80%, I know it. So this is why I can cut the trade, maybe 0.5% loss, 0.75% loss. Or maybe I feel like the world is behind me, or maybe I have a lot of winning streak, then I let that go to stop loss, okay? So with that being said, if I was in a short here and I saw this failed auction to the lower side, let's say I entered here. I see let's walk through this again. So if we have a consolidation box right here, this is the fair value. Let's mark it 100% correct. So this is the fair value. Failed auction to the upside. Okay, seller step in. Okay, I sell. Let's say I didn't understand this relationship. I sell. But if we get a failed auction to the lower side and I see a lot of trapped participants, market comes up, maybe this is a sign that I shouldn't be a seller. But let's say I'm a slow learner. But when the sellers step in again to this exact area of demand, buying stops in and become inside of this again, this time higher. So if I was shorting here, maybe I'm not saying that I'm 100% certain in every trade that I take and everything like that. But if I'm shorting here, maybe because I didn't understand this relationship that I was explaining to you here. But if I'm shorting this, I see this. Maybe right here, I'm thinking about exiting the trade. If my stop loss is here or my limit order, or I entered here, this is 0.2% of my trade is a loss. Okay? Like, you can even understand when to get out of the trades. This is what I want to tell you. You will see the order flow shift against you. This is what I want to tell you. And I will show you in the backtesting session and explain how I can see the order flow shifting from the sell side to the buy side. Power of analyzing data and not candlesticks. So with that being said, go to the community tab. In the school community, if you're watching this from YouTube, comment below. But if you're watching it from the school community, and I highly recommend that you join the school community, because there we have the templates, we have the resources, we have the community, all of that. Comment in the community section what you think about this information. Is this eye-opening? Is this bullshit? Or is this just complicating your indicator strategy that is super easy? So comment below, and next video is actually backtesting, I guess. So let's see how we combine all of this together into a very high quality strategy. So see you in the next, guys. All right, guys, the time has finally come. It is time for an in-depth backtesting session. And I specifically chose this day of price action because it has a lot of technical factors to it. It can be an insight into how professional trading actually looks, but just know that you don't need to know all of this in one go. So this is an accumulation of years of experience into one big backtesting session. So I'm gonna show you an in-depth backtesting session, this one, and the next one I'm gonna show you a very easy trade. So these are also easy trades, but since I want to show you the power of using order flow and understanding auction market theory and 𝗧𝗛𝗏 volume profile, this is a very good day to show you how I can combine all of the confluences to actually know exactly at any given time what is happening inside of the market. So just to go over this day, so I had three trades, two of which was a win and one of was a half loss. And I actually missed one trade, and this was due to that I was restarting my computer. It was acting up, and I actually missed a trade which was super clean, and I will actually show it to you in the backtesting session. So with that being said, these were the trades, and we're gonna talk deeply about them. So we're gonna backtest them, we're gonna replay them, and show it to you so you can clearly see. Like the first trade was a 5.3 hour trade. So I'm not gonna be able to replicate them on the tick when we are backtesting, but the first trade was a 5.3 hour trade with a 3.25 stop loss. All right. So I'm gonna try to replicate it perfectly, but always when I'm replaying the charts, I can even show you. So this is the replay thing on Atlas. So you choose the speed here, right? So if you're gonna replay, you choose the speed. So if we are going to replay, of course, we want to replay with a faster speed so we can get over with the backtesting quick. And when we are replaying with a faster speed, I'm not that quick to execute, right? So it won't be like in the backtesting session, we won't get that perfect 5.31 hour stop loss or take profit, I mean, but I'm gonna do my best. You will see what I mean when we start the backtesting. And now, the second trade was literally a pullback to the area where I sold the first time. And I'm gonna show you how we can actually find areas that we know that the order flow is changing. Like, okay, if I'm in a sell, I've come to an area where I can see that the buyers are pushing, like coming in, and I should exit my trade, okay? So I can even show that to you. But the second trade was simply a pullback to the area where I first sold, and I sold again. So I sold from my area, okay? That area created a supply, and then price pulled back to that supply, and I sold again. So it was like 5.3 hour here, 3.4 hour here. So let's say around 7 to 8 hour of profits, because I took a half loss as well because of de-risking. So all of this is explained in depth in my Discord. Like I do this type of pictures sometimes and explain them in depth. But for this backtesting session, I will show you exactly how I executed, and I will actually execute in the replay markets as well. So with that being said, let's actually do some context analysis with TradingView. So this was the 22nd of October, and I think we were at the all-time high territory. Yes, this area was the all-time high, okay? So coming into this day, I was looking at this profile. So what I simply did was to mark from the leg in all the way down from this low to this. So I want to see all of the volume that was transacted inside of this, right? So I hope you guys understand it by now. It's not something very hard. So I can clearly see three peaks here, right? So I'm gonna mark out this peak, and we can even refine this peak because this is the major peak. Like you can clearly see that the volume is peaking out right here. So coming into this day, I was seeing that buyers are pushing up the auction higher, and they are failing to break above this, right? And this was actually a very area of very good supply. And just not to get super deep into this, this was an area that was, let's say, a price manipulation in the market, because when I was trading this, I was actually shorting this. Right here, we had 5K of trapped buyers, like a very unusual huge amount. This was 10 minutes before Trump tweeted and melted the market. He tweeted something about China tariff, and like this was insider trading, right? So 10 minutes before his tweet, some big sellers stepped into the market. So this was that area. So I had this in mind, that seller was very strong. He knows more than us, right? To start selling 10 minutes before Trump tweets. So with that being said, we have come to an area where sellers are strong. And here we can clearly see that buyers are pushing, but they're failing to break above this area. Also, by looking at this, so we're going to do a quick context analysis. We know, or we can even do this. We can even, instead of drawing from the leg, we can even draw, let's say we can draw from here all the way up here. So we know that we are building some kind of a volume here up top. So let me just mark this out. So we are building a lot of volume here, but if we start to break below this area, then there is nothing in price that can stop us until this area. Okay, I would say until even here, because we have a high volume node. So until even here. So this is the area of demand as well. So this was my final target for that day as well. So what actually happened, and I will go very deep into this. So let me remove all of this. So what actually happened is that during the day, right before the session, as you guys know, I've told you before, I think, I've developed a very good way of reading context based on how price reacts to supply and demand. So that was my first sign that sellers are winning this battle. So to me, this is let's say a balanced profile. It is like buyers and sellers are fighting or transacting. And we have to, in order for us to trade this, we have to get a hint on which side is going to break out. So the first hint for me was that, based on how I read the context, is that we are going to break to the lower side. Okay, so that was the first hint. And I can't really explain it here because I have like 10 different videos in the academy on how to read the context based on how I develop it. So I can't like explain it easily and quickly here. It will just confuse you. So based on that was the first hint. And then we're going to jump on to the Atlas software and I will show you what other hints we could have used to know that we were breaking to the downside. So what happened was, let me just mark out this profile again so you can clearly see. So what happened is that we had a very strong area of buyers right here. And then we had the area of sellers up top. Okay. You can even take this one, take it down. So you have the shelf up top. So strong sellers, strong buyers. So I'm leaning more towards the sell side based on how the sellers are pushing the market. And at the session open, market dropped to where we had the strong buyers. Tried to go higher. Went to this high volume node, all right, rejected the high volume node. So if you're going to mark out the peak of the high volume node, it should be here, right? Should be here. So if we zoom in where we went exactly into that, okay? So this another confluence that we're gonna, the sellers are pushing the market, right? So one more confluence. And also keep in mind that based on my higher time frame context analysis, I actually know where we are coming from. So that is a very good, let's say, a hint, a contextual bit, a contextual puzzle as well. So with that being said, I'm already bearish in my head. And I already know if we're gonna drop heavily, okay? So with that being said, market dropped. Inside of here, there was one trade that I missed. Okay, this was due to I was restarting my computer because it was acting up. But no harm feelings because I got like 7 to 8 R that trade that day on the next 2 trades. But this was a very beautiful trade. Like I think I told you guys, I have a playbook called Path of Least Resistance, and this was that playbook. So all of my trades have specific playbooks. If the playbooks doesn't happen, I don't take those. And these playbooks is, these playbooks enable me to take very good, high conviction, high quality trades. And also if it is a loss, it is according to my playbook. So I don't even care because I know that these playbooks are super good. So let's see, market dropped. So there was a sell here. So what I did is I waited for a pullback to the area of supply. So this would be the area of supply. Okay. But if you, since I haven't taught you, do I say teach you or taught you? Taught you supply and demand. You don't need to care about this, but just know, like I told you previously, I combine advanced supply and demand with volume profile, but you will still get the same result, right? So the pullback, look at this. So if you're pulling, like if you're building a lot of volume here, okay, the auction is transacting at a specific level. Then we decide that sellers are stronger and sellers are pushing down, and we know that the next area is around this area, right? I don't want to mark the volume profile to give you a sharp exact area, but we know that if we are transacting at a specific price, the next area that we can find acceptance is here, right? So if price drops and we create a pullback, if I draw this volume profile again, and if I mark out the shelf again, once again, or let's not mark, let's do it a sniper zone, because as I told you, I combine it with supply and demand. Let's mark it here. Okay, so this is a very good zone to look for a sell trade, right? Because I don't want to keep selling in a, like if the market has gone all the way down here, I want a slight relief bounce, I want a slight pullback, and then I want to sell. And also by using order flow, I could actually catch the long from here, to be honest, but I didn't do that. But I can show it to you, but I don't want you guys to try catch longs in a bearish market. Like in this case, we know that price will eventually drop here. You can absolutely catch longs, but during these certain periods, I don't want you to go and try to catch longs when you're new into this type of trading. It is much better to wait for a pullback and take the sell to be aligned with the market. In my day-to-day trading, I take all of the trades I see. So I don't overthink this, but I don't want to show it to you, but I can explain the logic behind it. So look at this, high volume node, pull back to that. And this is where I sold my first trade for a 5.3 hour trade, drop, took out the low, then I marked, and the second area wasn't based on volume profile, it was simply based on supply and demand. Then I marked my supply, market pulled back to that, confirmed, and then I targeted this low. And then this was some kind of news that came into the market, and market just plummeted. So let's look at where the market went. I haven't, I got two trades in the span of, let's see, in the span of 1.5 hours for 8 hours. So I just closed the charts and I didn't even check what happened later on, but let's measure the volume. Okay, so this dropped, as you can clearly see, to this higher volume peak and bounced. So of course we could have dropped to this high volume and bounced, but there was some catalyst, some news factor, which dropped the market. If you mark with the shelf right here, which dropped the market, let me zoom in, which dropped the market to the shelf, and market went higher, came down, higher low, and this is also a playbook in my arsenal, and market went higher. So with that being said, let's start backtesting. I know it is a lot. I specifically chose this day of price action because I want to show you the higher time frame context by using different profiles. I'm not slapping on, look, if I slap on the the daily one, like it is not as good. Like you won't see those things that I was telling you. So this is why I'm giving you a little bit more insight into how I trade day to day. And yes, let's go to Atlas and I will show you everything. I will show you all of the trades, and I will actually show you exactly how you can know that these lows has reached an intermediate, like a very short-term pullback is about to happen as well. So if we jump into Atlas, of course I was using a lot of footprint chart, but since I haven't teach you this yet in this course. I can't really go very in depth into it, but I can show you and explain what is happening. So I will also bring out my tool so I can mark the charts. Okay, there we go. So this is that area. First, since I know like this is now hindsight, but that specific day, I was measuring this leg. Let me show you this. Let's go on M5 because it's the price action is much cleaner. So I was looking at this leg. Okay, so if we drop, we have to get some kind of a relief bounce at somewhere, right? So what I saw inside of this leg of price is that we have, I don't know if you guys can see it, but 543 lots of aggressive buyer here. And then we have a 274 lots of aggressive buyer here. And also this is a low volume node in ICT terms called the fair value gap, but using the volume profile. Let's go to the volume profile. You can clearly see that this is an area where the lowest volume actually occurred, like in this leg. Look at this here. So with that being said, I didn't spend a lot of time on the volume profile. I just want to show you what I did instead. So now I have a delta profile. I can clearly see inside of this leg of price where the strongest buyers are that are untested. So what I see right here is that I see 1K of buy executions right here. So I will mark this area and mark it with a DPOC, delta POC, okay? And next up, the next area of strong buyers is here. So green line called DPOC. And the third strongest area is here at the fair value gap or low volume node. So now we have 3 areas that are a potential candidate of where market could give us a relief bounce if we start to drop. And of course, we know that we started to drop. So we have to keep a close eye on these areas. Just know that it is not like we should tap this to the point and go higher. It is a general area. So we can go like this and go higher. By general area, I don't mean that we should go all the way here and go higher. I mean that we can go here, we can go here, we can go here, or we can go here. Like this general area, not much higher, okay? Because we still have to be precise. So let's say 2 to 3 points of our area. So the way I trade, it's very precise. This is why I don't use value area high and low, because they are not as precise. So combining volume profile with supply and demand, that is like, it's super good. Either way, also during this price action, I told you I have a contextual way of reading the market. That was my first hint that we were going to drop. But the second hint that we were going to drop is that I drew the delta profile right here again to see what was happening inside of this price action. Let's mark it like this. Okay, so now it might get sloppy, but I'm going to explain it to you. Look at all of the amount of buying at the tops. Okay, a huge sum of buying, like a lot of buying at the top, right? But market isn't going higher. And with the contextual bit that we were coming from the area which created the manipulation before that Trump tweet, this is a very good contextual part to it as well. So huge amount of passive sellers at the tops. That is a good one. That is hint number 2. So it's not like we just need passive sellers. We need aggression to come into the market as well. But I was seeing at the low, we don't have a lot of selling going on. Yes, we have some, but if you compare the selling to the buying, we have more buying. People trying to push the auction higher and higher, more than sellers are pushing lower. So it means that a squeeze is coming soon, right? If all of the buyers aren't managing to bring the auction higher, if we start to go lower, it means that we should like squeeze. All of those stop losses will get hit and the market will plummet, which it actually did. So let's remove this. And the third hint that we were breaking lower, this is something, it is also something that I haven't taught here. It was the CVD. let's see if you can actually catch this, but it was the CVD, and CVD is cumulative volume delta. It is showing the delta over a cumulative like over a period of a time. So I don't need to overthink this right now. It's not something that will make or break your trading, but it is just a contextual hint as well. There is certain periods I use it, and this was a very good period to use it. So okay, so I know based on the volume profile, what is this? Yes, this is this one. Based on the volume profile, the strongest buyers are here and the strongest sellers are inside of this area. So let's play this price action. So one other thing, guys, when I'm replaying, like I can increase the speed even to 1000x. So this is why I can't sniper entry all of the trades in the backtesting session. Just know that in live markets, you do have a lot of time to execute, right? And think and execute. So the market isn't as fast as in the replay mode. So 20 minutes has gone into this recording, and I hope it you get a lot of value until now, but now it is time to show you all of the magic. So market opened with this M5 candle. Yes, sir. So there we go. So we are coming lower. Let's go. Let's replay a little bit. Okay, we're coming lower. We are pushing. The sellers are pushing. And let's draw the volume profile just so you can see the same thing that I showed you on TradingView. So here is that high volume node. Okay. So look where the market pulled back. I think it will pull back to this high volume node because we have an area of supply as well. So I'm going to silence this. Okay. Pushing past the VPOC up to this high volume node, which is our area of supply as well. And here is where the sellers totally took control. So with this, since I've done my contextual bit on M5, we're going to switch to M1, which is what we're going to use for our confirmation model and how we're going to enter. And I'm going to have the footprint chart right here. And that's that. So also, I want to know when we start to break below this area. Let's see, I have a doctor's appointment soon, so let's finish up this. I'm going to be slightly quick with this. So let's mark this out as supply and demand. Okay, let's watch the CVD as well. I'm going to explain what is happening. Okay, look at the CVD just broke a high right here. So you can clearly see price went higher. But the price action didn't go higher. So it means that all of this is showing aggressive buy orders. So we have a lot of aggressive buy orders, but price isn't going higher. It means that there is a passive seller. I don't want to get too deep, but yeah, let's wait. So I'm replaying this on 1000x speed. And it was inside of this price action. I took a half loss. I took a buy from this area when I saw the buyers came in. It was an area where buyers were present. But when we went into that high volume node and we started to, I was seeing that buyers are not managing to lift the auction higher. I closed the trade with a half loss. So are you seeing that the CVD is trying to break higher, but price action is actually creating lower highs? So this is a hint. Now we just want the sellers to step in as well. Okay. So now we are getting an absorption, but now we want the aggression as well. Sellers coming in. Sellers coming in. There we go. Look at the CVD just broke. So this shows me we have three contextual parts, right? How I read the context, I know that probably we will break bearish. The delta profile that was showing that all of the aggressive buyers are getting absorbed at the top, or we have four contextual bits. We have the area where that Trump manipulation was happening, And now we have the CVD that's showing us that the sellers are coming in. Look at this. How, like, you won't be able to see this kind of stuff if you just look at the candlestick patterns and mark fair value gap and sweep of liquidity, right? And this was the most eye-opening thing when I was starting to trade like this. Like I can put different contextual clues into my trading and get a very good picture of where the market wants to go next. And this is, if you don't see value in this, I don't know what you're doing in this course, right? It is super powerful. Look at this. This is telling me, basically, at these highs, buyers are getting trapped. Step number 1. Step number 2, sellers are coming in. So we have these 2 steps met. So it is clear as day that we are going to break this area of high volume. Sellers has now come into the market and we should sell. And this is the area, or this is the time I think my computer actually blue screen, then I had to restart it. So I will show you the trade that I missed. So not yet. Currently we have a lot of selling going on, but market isn't going lower. Okay. So not yet. Nothing is confirmed. So we pulled back to this area. Look at the sellers coming in right here. Boom. So what I would do, I would mark this area for a lot of different reasons as a very good area to short. Okay, market pulls back to that area. So now the weakness is confirmed. The weakness for me is confirmed. We are starting to break areas of demands. Look at all of the lower lows all the time. Strong selling is coming in. Selling is getting rewarded. Now I'm looking for entry. And I think this was the area of the first entry. So let's have it right there. And target for this, what I'm going to do, I'm not going to set the target for this. I'm going to show you how you can exit without, you don't need to properly understand exactly where you should exit. But of course, if you do your analysis, you can see, like, just give me a second. Why isn't these lines showing? Did I remove those? Okay, let's mark out this again. I just want, did I actually remove those? Why? This was very odd. So 𝗧𝗛𝗃, I'm just marking out the areas in this leg of price where we had the strongest buyers. Okay, so probably if I would have wanted a fixed take profit, this would be my fixed take profit, 1 tick above. So let's go with that. Let's go with that. We don't need to, I'm going to show you this. So, okay, so so sell here. Okay. And this is based off one of my M1 confirmation models. So market is dropping. This is looking very, very good. Very, very good, actually. There we go. That's the first take profit, right? So see, you could have held it a little bit longer, but okay. Here's the thing. When do we know if the buyers are coming in? I will tell you. You can clearly see that there was this strong buyer to the left, right? Let's see. This very strong buyer to the left, right? He is now resisting the sellers a little bit, okay? So he's fighting a little bit. Now we have to see if he succeeds or not. So if you go to the left, we see a lot of selling going on, but market isn't pushing lower, right? So we still have to wait. Now we are seeing an absorption of the sellers. So sellers are pushing, not going lower. So we still have to wait. Remember, order flow is 1 absorption and then aggression. So 2 parts. So now we have the absorption. Let's see if we get our aggression. Also, yeah, let's see what will happen. So I will explain that bit if it happens as well. So now we're seeing more selling. So we're seeing buyers regain a little bit. So if I would be in the sell trade, still I would hold my sell trade. If we start to break above this area, I would close my sell trade. And why? Because this is where the sellers were very strong as well. Just imagine this. If buyers breaks above this area, this is the next area where we have strong sellers. So if I'm taking a buy, I don't want to buy into a very strong seller, right? So I know also if buyers push the, let's say if I was in a short trade still, if I still was in a short trade, I would only close the short trade once the buyers manage to break above this area. But yeah, that wouldn't be a very good risk to reward. For this first trade that we took, actually, it was a huge, maybe we should take this. I don't want to hype this way of trading. Let's say a 3R. I think we got a huge amount of profits on this. I think it was a 3R, okay? We don't need to, I don't want to give you false expectation that all of the trades are like 10R. I'm not that type of guy. Let's say we took 3R on this first one. Let's say you only executed this trade once the strong seller also came in. So let's say 3R, okay? I don't want to give you false expectation that all of the trades that we take is like 7, 8, 10R. So, okay, so market is dropping right here. So we are seeing that the sellers are getting a follow through. So this is very good, right? Sellers are pushing and they're getting a follow through, like they're getting rewarded for their effort. So now we are coming to the next area where the buyer is strong. So the first buyer failed to hold price. So now we're starting to see sellers are getting absorbed again. Let's see if the buyers step in. Okay, now we're seeing some kind of a buy aggression. We see that the buyers actually, first we get the absorption, then the buyers start to go higher. Now we want to see how higher they are going. Are they managing to break this area? Are they managing to break this area? Then we know that, okay, buyers are truly meaning business, right? If they start to break above multiple areas where the sellers previously were very strong. Just always have to think in terms of the strength of the buyer and a seller. So if the sellers are pushing, here sellers are like there's two areas. First, they stop to get rewarded here, but then to control again. Now we come to an area and are getting absorbed and market is stopping to reward them, which means that we have a buy limit order right here. So with that being said, we want the buyers to also step in. Okay, so we have absorption, we want the aggression as well. Always have to think in terms who is the strongest participant in the market. If I'm gonna go with a buy idea right now, I want the buyer to show me that they mean that they truly want to lift the auction a little bit higher, right? So now buyer stepping in. So if you, let's say if I was in that short trade and if we start to show strength right now, start to break above this area, look at this, every time sellers comes lower, sellers get trapped right here. Let's see if the buyers comes in. So this would be, if I would be in this short trade and I was just holding it, very good area to exit that. So now sellers are showing weakness, buyers are showing strength. Sellers got trapped, buyers coming in and starting to close above areas where sellers previously were strong. Okay, so pushing. So let's see. I also want to mark an area where I should take the sell trade, which I actually took in the live markets, and that area would be this area for multiple reasons. And I even showed you that it was the shelf of the this higher time frame volume profile. But yeah, that multiple reason, one of the reasons is that we have huge amount of sellers that are probably going to protect their position if we pull back to that area. Second reason, it is a very good area of supply. Third reason, it is the shelf of the profile that we just broke out of. I hope you guys are following along. It's a lot of information in one very short video. It's years of experience in a very short video, so don't get overwhelmed, but I'm explaining everything step by step, deeply, so you know that if you proceed this career of trading and you can actually understand all of these aspects yourself, that this is like, you can't get more precise, you can't get better trading than this. So next backtesting session, it won't be this in-depth. I will show you a easy trade or a easy explanation of a trade. So now we are pulling back. So keep in mind, me personally, when I was trading this live, I missed one trade and I've taken half a loss, but I'm still confident. I'm still chilling. I still know if we break below that high volume node, how auction market theory works is that we should drop to the next level of high volume node, where we can find acceptance. Now look at this. This is very interesting, right? So these buyers are really pushing it. And why do they have to push so much exactly here? Because if you look to the left, this is where the sellers previously were very strong. All right? This is where they were very strong. So in order to hit their stop losses, and this is, I don't want to set a percentage, but let's say 70% of these buy orders are these guys' stop losses, because in order for a sell order, like if your stop loss, okay, let's explain it this way. If you're selling, your stop loss is a buy market order, okay? So this is showing buy market orders. So probably once price is pushing higher, this is these guys' stop losses. Not all of it, but a huge chunk of it. So we can clearly see the stop losses of these guys getting triggered. And buyers are also coming in. Okay, now we're coming to that area of interest where I want to short. So I want absorption and aggression. But I don't just want to take, let me explain. Now we're getting absorption, right? So look at this. Let's look at the footprint as well. Let's see if I can use this. You can clearly see, oh, you can't. Look at this. I will draw it right here because my webcam was there. You can clearly see we have a lot of sellers at these price points right here. And this is a delta profile of the current day. So we're coming back to the area where we had a lot of sellers. Now we're seeing a lot of absorption. Look at this. How beautiful is this? How beautiful is this? Absorption, aggression, right? What is most important about this is that these sellers are managing to break below the area where the buyers previously were strong. So they are showing force. They are showing strength. And this is the beauty of looking at the order flow. Because let's take another scenario. Let's say that these buyers were actually here, okay? Then it would be very risky for me to short into these strong buyers. I would want the sellers to show strength and start to break below these guys, right? But in this case, buyers were all the way up here and sellers has actually showed strength. And we see a lot of trapped, not a lot of trapped buyers, but we see some selling coming in and a little bit of trapped buyers. So with that being said, the first trade that I took, let's flip this in. Let's flip this in on and see right here. First trade, this one. Was it the first trade? Right here. Okay. Let's go and see if we can execute on this. Now I'm ready to take a trade, but I think it was here, right? Let's start to break. I have to reduce the speed so it's not super quick. Let me see if this was the first or if I took the second pullback. Yeah, I think I took this. I didn't take this one. This was actually a very good. Now, like when price starts to break below, if I would have traded this, wait. Let's see the footprint, okay. If I would have, wait, not yet. When price starts to go lower, I would have entered this short, stop below here, stop above here. But I think I waited for even one more confirmation on this. Wait. Now I would have shorted this, but the way, let's see if where I entered on the next pullback. Okay. So the way I entered, I saw that we have a absorption, aggression. Now I wanted a small little pullback and see if the pullback was holding as well. Okay. So I think I did something like this. Sell limit. This was a few months ago. So I sell limit the area where the, how can I say, the sellers were strong. Let me see if I can catch this perfectly. Sell limit and my stop loss was, oh, I entered actually, I had a better entry. I entered here. This is where I entered. and my stop loss was here. Okay, so I'm not able to replicate that trade perfectly, but this was my target. Yes, this low was my target. So I might, like, I had a worst entry, sorry, I had a worst entry, so my stop loss was a little bit, like I had more points to my stop loss. So this was an even better entry than my original one. But my original one netted me 5.3 R, so it's not a small amount of profits. So why did I actually limit this area? You can clearly see, right? I'm not limiting here, I'm not limiting here. I'm limiting the area where the sellers are strong, because if you're gonna get a pullback or relief bounce, then I want an area where I can clearly see where we're gonna, like, if this is pulling back, I want to know exactly where the pullback is going to go, and it is here. Like, when I'm explaining it, I hope it makes sense. Like, trading can't get more clearer than this. I know it's a lot to take in, because I'm combining everything, and based on, like, if you're gonna trade this way, you might need 6 months, 8 months, 1 year, 4 months, depends on how much you study, to fully understand all of it, to fully be able to execute like I do in the live markets. This isn't a get rich quick scheme, right? You need to put in the effort, but if you do, all of this clarity is becoming available to you, so you can trade with clarity. You don't need to second guess, like, okay, if I was trading the candlesticks, I would say, okay, we should pull back to this high. No, I know exactly where we should pull back to. And this is the difference of a professional trader or a candlestick trader. Dropping. Taking out lows, perfect. These sell orders, probably the stop losses of the buyers that stepped in here. It's like a squeeze, like every time we break a low, poof, we go lower. Now we are coming to an area where the next strong buyer is. Okay, we marked this out with the delta profile previously on the M5 charts. So here we will see what will happen as well. If I'm going to take the next short, I'm going to take it from this area. Why this area? Because it is an area of supply. Also, it is aligning with that strong seller again. So we're coming to this area. And this is that area. Look at this, 911 of positive delta, 911 of buy market orders. So if we come to this area and we start to see absorption of sellers, we know that this buyer is in the market trying to protect his position or loading up on more. It's okay, dropping. Absorption. Let's see. More absorption, a lot of selling going on in this area, but market isn't going lower. Let's see if aggressive buyers comes in. Now buyers coming in, pushing higher. Let's see. Sellers, a lot of selling here, but market isn't going lower. So it doesn't look good for the sellers right now. So this is a higher time frame intermediate relief bounce, right? It's very visible. Look at this. Market came all the way down here. Market came all the way down here. A lot of trapped sellers at this low. But now we're getting a small relief bounce. So if we're going to get a small relief bounce in a bearish market, contextually, we know that we should drop to the next area where we have, where we can find acceptance. If I'm getting a relief bounce, of course, I can take a buy trade from here up to here, but let's take the sell trade instead. That is a better idea in a bearish market, right? Let's say if I would have taken a buy trade, I wouldn't take a buy trade on this one because I don't like, no, not this one. If I would have taken a buy trade here, it's not a very good area to take a buy. Like, it's not a high conviction. Let's see. Okay, so we have 1K of sellers here, then buying steps in. Let's look at the FP. Now, it's better to stay away from the buys. Like the sells, super clean. Look at this, absorption, aggression, pullback, holding. This, not as clean. You can 100% formulate trading ideas based on this. And now I'm seeing that the sun is coming in. Just give me 1 sec. Let me take this down as well. Now I'm back. Okay, so let's see where I took the next seller. I just want to replicate that same trade because I don't want to show you stuff that I didn't take in the market. Coming to my area of supply that I marked out, a lot of buying going on here. And now I want the sellers to break below this area. A lot of buying. Okay, sellers coming in. And I think I used the footprint for this. Let's see. Sellers coming in. I already sold in the markets. Yes, I have already sold here once the sellers came in. Let's see. I sold on the picture. I sold here. Let's see if market pulls back. No, let me just rewind this and let's take it from the beginning. And this is the con of replaying it on 500 times the speed. So I started to sell. Let me look at that print screen. I can even show it to you right here as well. So I started to sell once market went below this low, stop above here, 5 points, target this low for a 3.45 hour trade. So let's replicate that. And I will explain. So limit, there we go. So why I sold here, let's see. I want to see if I can show you something on the footprint. On the footprint, you can clearly see at this top, we are getting a lot of trapped buyers, right? But you can also see it on the M1 trades. So we are getting an absorption. And then we are getting like with a little bit of effort, like sellers aren't pushing a lot, but like with 100 lots, 100 lots, 78 lots, they are managing to break like all of these areas where the buyers previously were strong. So it's showing me that sellers are truly like they're showing strength, right? Also, let's look at this. If you can see confluence on CVD as well. Also, no, nothing on CVD that is screaming, but this is also showing like you can clearly see that sellers are in control of this market. We're just huge amount of selling. So probably every pullback is just a relief bounce, right? So this is where I sold, and my stop loss, I use the footprint for this. I placed my stop loss above this area because if price is going to pull back, I think it was this area. But I would, like if I would have taken this trade right now, I would have placed it right here because this is the area where buyers previously got absorbed, which means that we have a sell limit order or offer resting there. So I want to place my stop loss above that. So somewhere around here, right? Somewhere around here, I don't know. Either way, target was slightly below this low into this area of demand yes. So, okay, I'll remove this and let's see what happened here. And as soon as I entered, that strong selling came in. So I think like when you're seeing like when I'm analyzing and showing you all of this in real time, and it's not, of course, it's not live trading, it is back testing, but still, these are the trades that I've personally taken. And like, look at this, when we start to pull back, you just pull back to where the sellers are strong. So in a bearish market, the sellers are the strongest participants, right? So every time we pull back, the sellers here, this is why I love the big trades, are protecting. They're not letting market go higher. Now break below this and we will get the squeeze again, I think. Like, you see, strong selling comes in as soon as we start to break below that. There we go. That's that. So that was my, how many hour? 8-hour trading day. So with everything I showed you and told you and all the tips and tricks I gave you, literally what I used was supply and demand. And I know that I haven't, like the supply and like I have a module inside of the academy course with 10 hours of supply and demand training, because I don't trade the normal supply and demand that you will find on YouTube, right? So I can't put 10 hours in a free course. Either way, supply and demand, volume profile, delta profile, big trades, or order flow. So 4 tools to give me high precision, high risk to reward, high conviction trade. And also I understand when we are getting relief bounces. And this is a good thing as well. Imagine if you knew which area market was going from to where, pulling back to, going to the next area, pulling back to, going to the next area. Like, how much of an edge is that? So when I told you in the introduction video that most of the traders will fail because they don't have a true edge, like, bro, are you seeing this? Can you actually see this on the candlesticks? No, you have to, like, this is why I hype my way of trading so much, because the clarity is insane. Like, if you can clearly see where certain stuffs are happening, like the clarity is insane if you can read the market the way I do. So it is very, like, I don't want to brag, but it's very uncommon that I don't understand what happened during price action. Maybe I don't understand it in real time sometimes, but that the more experience you have with the markets, the more things you will understand in real time. So when you're a beginner, maybe you won't understand all of the things that I showed you here. But when you're starting to become a little bit more advanced, you will actually understand more and more things in real time. And that is the thing, right? If you're practicing a skill, your goal is to understand that more and more in real time. So let's say that you're playing soccer, like you're playing football. You wouldn't go to the world finals and start to compete against Brazil, right? You want to have practice. You want to understand like how Brazil plays, what their playbooks are, how it behaves. So that is exactly what we do with order flow. We use order flow, volume profile. We trade one type of indice, we trade one instrument, we understand the characteristics of it, and then we go to the world finals and compete against it. So this is what we do as a trader. Of course, this is not an easy way of, like, you need to put in the hours, you need to put in the works. And once you do so, you can clearly see how we can tackle and we can dribble the market like I did this day. So I hope it is eye-opening, right? It is truly eye-opening to see this. I'm showing you sniper areas in the chart where we should react. And I'm showing you sniper entries and explaining them perfectly. And this is exactly how auction works. This is exactly how the market works. You just have to align with it. You have to be in tune with it. And this is what we are doing when we are trading order flow. Like, I didn't take the buy trade here, right? Because that wasn't I weren't in tune with that. But the sell trade, 100%. So with that being said, I don't think there is a lot more to backtest in this, because me personally, when I took this 7 to 8 hour, I closed the charts actually. I didn't want more profits, but to be honest, I was waiting for this first trade. So it was like when price was here and I saw this large sell-off, of course, it didn't feel good to miss a trade based on a technical, those stuff shouldn't happen, right? If you are a professional trader, you should make sure that your computer is on pair. But I was very mad here. Like, of course, I'm a human being, emotions comes in, But when you pull back, but when you have patience and you understand what and how the market should react and where we should bounce from, where we should pull back into, and you take your next trade based on your perfect playbooks, of course it's gonna feel good. And to be honest, I was actually done after this, after a 5-hour trade. But since I marked this area, I placed the alert, I went away from the computer. When the market came there, gave me another confirmation, beautiful confirmation as well. Why shouldn't I take it, right? Everything is based on my playbook. The contextual bit is locked in, and we know like you can never be 100% sure about anything in the market, but with the tools that I'm teaching you right here, you can be pretty sure at least. Like, it's not like 100% of the days I know exactly what is going to happen. No, I can't predict the market, but I can at least have a qualified guess. And the only thing that differs a professional trader from a retail trader is that their qualified guesses are better. I remember when I was trading that ICT bullshit strategy and I was in a mentorship, that guy, my mentor, was marking out key levels every single freaking day. Every single freaking day, the market disrespected his key levels. And when they actually respected his key levels, he was like hammering on his Telegram channel, look at this key level, it reacted to his 3 days. Like, there is better ways of reading the market. You shouldn't just mark random lines on your chart and say that it is your key levels. I'm swimming away with thoughts right now. I'm just having a rant, but don't mind that. All right, beautiful people. It is time for today's assignment, because I am genuinely interested in hearing your thoughts. All right, so we had a deep backtesting session, and I want to know what you're thinking right now. So create a post in the community feed titled "My Thoughts on the First Backtesting Session." All right, take a moment to reflect on what you observed. Then head to the community and share your thoughts on how order flow and auction market theory played out during this backtesting session. So really, I'm genuinely interested in what you're thinking about trading this way. Does this bring clarity or more confusion? Is this a nice way of trading, or is it a hard way of earning money from the market? So I'm genuinely interested in what you think about this. But as you see, this type of trading, it requires some skill and finesse, and that skill and finesse is something that you have to practice and fine tune over a period of time. So it's not a get quick rich scheme, right? So with that being said, please do today's assignment, because this is your, how can I say it? This is your present from you to me, because I'm genuinely interested in hearing your thoughts. So please do this assignment, and I hope this was very informative for you. I hope you can finally get some clarity in how to trade the markets. I hope you understand why this tools that I'm teaching you is so powerful. And I hope that you are going to be an order flow trader in the future as well. So thank you for this video, and see you in the next backtesting session. All right, ladies and gents, now it is time for the second backtesting session. The previous one was kind of deep, but this one, we're gonna make it a little bit easier, a little bit more straightforward. So if you felt a little bit overwhelmed, it was information overload, this is going to be the opposite, right? So we are going to make it much easier. So today, actually, it was my first day back trading after a 20-day pause. So it was actually my first day trading. One of the reasons why I paused my trading was due to the New Year price action. And I've explained that the liquidity dries up, but also due to building this course, right? So I've spent significant time on building and refining this course, so it is easy for you to understand, right? Because the subjects that we are talking about is actually, now I think that I should have held this trade, but either way, the subject that we are talking about is like, it's not an easy game, right? As if you remember from the first video, like people have financial degrees for this shit. So we are outsmarting them, right? If we are catching the wave in this market, catching the wave like you understand, like catch a wave up with price to make profit. So, all right, so today what actually happened? So I'm gonna actually play a snippet. So what I did, first trade back, I got a 4-hour trade right here. And this was the analysis, and I was sharing it with my Discord community. The thing is, I also got a 1-hour win, and this 1-hour win was actually a very good example to highlight how powerful order flow is. So I'm going to show you that as well, because there is lessons attached to that. Also, I'm going to play a snippet from the pre-market analysis I did to my community, so you can see how everything was predicted, but still, like, you can predict, you can plan, but it's not always a guarantee that that will happen. But today it happened, so I'm going to play that snippet as well. Also, the thing is that when you're using the volume profile, it never lies, and you will see exactly how I took the trade today and how it never lies. After we are done with this current day, and unfortunately I can't replay this or backtest this like we did in the previous session, because the day is ongoing, and how ATAs work, we need to go to the next trading day, and then you can start to replay it. So I can't replay it, but I'm going to show it on the charts. So with that being said, let me show you a snippet from today's pre-market session that I sent in my Discord community. And if we measure the volume of this leg, you can clearly see that sellers tried to move the market lower than this point, but then buyers stepped in and pushed the market higher. So it looks like we have gone bullish both on the higher time frames and the intraday time frame. Our demand area is aligning with the shelf of this volume profile, so this is very good. And yes, this is a very good buy area. So this would be the intraday demand. And if the buyers actually, or let's say like this, if the sellers actually succeed to break below this area of demand, then we have the next area of demand, which is aligned with this VPOC. And inside of this, we have refined the VPOC to different areas of demand. So with that being said, my plan today, something like this, something like this. So this video is actually 12 minutes long, so let's not waste time on watching the complete video. But basically, what I was trying to show you is that you can 100% plan on how price should react to different areas. So instead of watching the complete video, so let me explain it a little bit quicker right here. So I'm gonna show you very easy. Very, very easy, my friend. Look at this. First off, I'm going to show you how I exited for 1 hour as well, instead of taking a loss. And that this is a very important note as well. So as you see, I had this area of supply marked out. So this was the area of supply. So this was H1 or H2 supply. Either way, you don't even need to know the supply and demand concept. You can clearly see that we have the VPOC right here. So if I just mark out the VPOC with this blue box, and you can clearly see that pre-session, let me see if I can make this screen a little bit bigger. So, okay, I'm gonna draw it right here, and I'm gonna bring out the pen so I can annotate. So just to recap, this was the VPOC of this area. Market pushed higher with the NFP news, okay? So this is our area of supply where we have strong sellers. We tapped into that, okay, and we dropped. But since on my contextual analysis, like context analysis, we were bullish, this would just be an intermediate, like an intraday pullback. So we pulled back right on the session open. I found a confirmation to long here, with the knowledge of if we fail to break above this high, this long will not likely work out, and this pullback will be deeper to our area where we have even stronger buyers. So let me explain. If we go to M1, so now I use the footprint chart to enter on this one, on this confirmation, but I decided to enter long here. So once the market was going higher, if you can clearly see here, market was going higher. Let me just fix one thing, okay? So why is it like that? Okay, so market was going higher, higher, higher. I was in profits. I think my entry looked something like this. I have a screenshot. Maybe I will edit it and send it, paste it in the video, or I won't. You just have to believe me, I took this trade. So market was going higher. My target was this high, okay? But with the knowledge of if we fail to break above this high and I see some sign of a strong seller coming in, since we were coming from a very strong area, of supply, if we fail to break this high and sellers step in, this trade won't work. We will likely drop even more, okay? So what happened? Exactly that happened, to be honest. So we dropped to this area. Once we drop to this area, you can clearly see like we have 500, let's see, 2,624 lots of aggressive buyers coming into the market. Okay, let's look at it. We see some absorption, not a lot, but the thing is that we are seeing a huge amount of buyers kicking into the market. And this is unusual data, right? But where is all of this happening? Like, if we take a random place in the market and we see 2.6K of lots coming into the market, is that good? No, it has to be at a specific area, right? We only execute like a sniper. And what is that specific area? So we switch to M5 and then we go full screen. And then we draw the profile. Okay, so I'm gonna remove all of this because this was the analysis I did for trading. So I bought it at this low, right? For with a 6-point stop loss. I actually was kind of slow executing. I'm gonna say it's my first day back, so that's why I was a little bit slow. But okay, I bought at this low. I actually was thinking more than I should to buy here, because once you see what I saw, you will be amazed. So I am seeing like this whole general area is an area where we have a lot of candles, a lot of volume, a lot of transaction being done. Okay, so if I just mark the volume profile of this whole area, and keep in mind, I'm not gonna mark with today's low. I'm just gonna mark until today's low. It is very important. So I mark this whole area, draw the volume profile. Do you see the VPOC? I'm not making this shit up, right? So if someone is saying market is very algorithmic, or if that volume profile is the perfect tool to find perfect entries, now you have evidence of it. So what we have right here, so we have the shelf from this area, and we can also mark the VPOC. So this is like in all of this price action, bro. Like, look at this. Just in all of this price action. Imagine how many points this is. I refined this whole area to a specific sniper area. And how can I do this? I can't do this by looking at all of the candlestick patterns, right? I can't do this by waiting for sweep of Asia's liquidity, right? I can't do this by drawing EMAs on the charts, right? I use one tool. It shows directly where the most transactions were done inside of this range. I mark that level, and then I use order flow to see what will happen when we come to this level. Are the buyers still present? And you can clearly see, exactly like I was explaining in the pre-market session, that I will either look for a buy from this area, which I actually took, but I understood that this buy won't work out because of the seller stepped in, or I will look for a buy from this lower part area. So we got a buy from both areas, and I took both buys. But one of the buys, by using order flow and not candlesticks, I saw that huge seller came in from a very good area of supply. Like I told you, if a huge seller comes in from a huge like a very good area of supply. Look at this. If this is a very good area of supply, okay, and the seller, look at this. If the seller, oh shit, this is, Told you, order flow softwares are not intuitive. If the sellers comes in here, right? This is pure auction market theory. Strong buyer, strong seller, finding acceptance and all of that. So you just have to understand what you're doing. So I'm noticing that a very strong seller are coming into the market. The only participant in the market that can stop him, or the only area where price can search for, let's say, acceptance, or in this case, we rejected this area quickly, is this low. I really like to use the terminology of strong sellers and buyers, because this to me is much better than the terms that auction market theory gives us. In this case, like we see clearly, like huge amount of sellers. If you switch it to delta profile, you can clearly see 6K of selling here. 6K. Like this, I don't want to say it, but this delta profile has a boner. So 6K of selling. Market went to this area, dropped. At the session open, if I just mark out this 6K, market went up to the point. Look at this. Isn't this to the point? And then huge selling came in. So this is why, like using order flow software, that you can see the volume and the delta and everything, it gives you so much more edge than watching candlesticks. I can't make it even clearer than this. So of course, like trading this way, you need to have certain rules. You need to have certain playbooks. I've given you the overview on how to trade it. I've given you the basics, but there is always more to it. I have, like, in my way of trading, I have, I don't know how many playbooks, but 6-7 playbooks that are very high conviction playbooks. Like, you will love them if you join the academy, but it's not necessary that you do so. With everything that I provided here, you can actually go out and be better than 99% of the retail traders. It's no, like, this is not a sales pitch for you to join the academy. Of course, I would like you to do so. But look at this. The point of control of today is here. We came to this area and it's now rejecting. Isn't that beautiful? And we see trapped sellers at this low. So most likely, and we're bouncing on a VWAP as well, most likely we will take out this high. And this is actually the all-time high, I think. Yeah. The unback adjusted all-time high. We will actually hit all-time high very soon, I guess. Let's see TradingView. Okay, never mind. So this is not a sales pitch. Just know that the academy is like 80 videos. Every video is like 1 to 2 hours. Okay, so I can't teach all of that in a free course, right? And also everything that I'm giving you is not just surface level information. I hope that you see that. If you want to become better at trading this way, of course, you have to join the academy. But with the information I already provided, this is more than enough for you to be better than 99% of every retail trader, every YouTube channel that shows you trading, right? You can go and search for it. I don't need to. I hope you understand. Like, if you're here in the course, like this is going to be the last video of the course. If you are here, I think you understand the power of using volume profile and order flow, and when you slap on supply and demand into it, the way I read supply and demand, not like everybody else, then you will see like how perfect it is. How can I know, like inside of this price action, how can I mark a specific area of demand and say that it's going to react from there both times? How? So there is a specific technique for that as well. And also, how can I know that we will get a relief bounce from this area of supply? How? Like, there is a finesse to it, right? So this is it for today. I couldn't backtest, unfortunately, but I explained every move perfectly. And this actually gave me, what was it again? First day back, let's go. I only took this on the prop account because I'm warming up to go to my private account. So 3.93 are trade, right on the VPOC, entry, nothing to think about. Straightforward, right? And if you are very conservative, what you can do, if you finally understand how to draw all of the volume profiles, you can just mark levels, set alerts, go away from the computer. Once price reaches Once price comes 3 points, like when it's approaching of 3 points to that level, then what can you do? Go to the charts, look at the order flow, take the entry if the confirmation is there. Look at this. Didn't I tell you that we dropped to the V? This is the volume session volume profile of the day. Look at it. We dropped into it. A lot of selling, but market went higher. And I told you, most likely market will go up to this high. So this is not hindsight. I'm showing you it live. All right. So with that said, let's do a backtesting session of a beautiful trade. So I'm literally going to look at one of these trades because I don't want to show you a trade that I like never took. So I'm literally going to show you one of the previous trades that I took, so you can clearly see like how everything is working out. So I'm not just going to take a random price action and show you that. So I'm literally just looking on which trade that can give you the most value, and I will choose it. And yeah, let's go. So this looks pretty good. It looks like it dropped heavily. So we also had students taking this trade. This guy made 1.2K on this. So this looks pretty good. Or maybe I will take a trade that raises your dopamine. What do I mean by that? A trade that you would never take if you were trading candlesticks, right? So let's see if I can find one of those. This one we can take, 6.7R trade. Perfect entry, perfect exit. Yes, we can take this one. 6.7R, 6 point stop loss, 6.7R, yes, and 6.2.5 points stop loss. Perfect entry, perfect exit, perfect location, perfect confirmation. Let's go with this one. So it's the 25th of November. So I will just replay the charts and see you very soon. All right, now it is loading up the full day. So this is the M5 chart. So let's remove the footprint. So I'm showing you that you don't even need the footprint, but it is a very powerful tool to understand. So combining the M1 big trades with the footprint, it's so good. It's so freaking good. So with that said, so the session is starting. Okay. So what I did, I took a buy trade from somewhere around here. Let me explain. Let's go. See the leg in from the low to the high. And of course I have the way I read context, we were actually bullish. And the way I read context, I not knew, but a very high likelihood that we should react from two specific areas inside of this price action. Two very specific areas. And this was the most high probability area. You can clearly see why. We do have institutional activity right here, right? 576 lots of sells. Let me see if I can zoom in more. 576 lots of sell, 571 lots of sell buys. Just give me 1 second. I'm just gonna change one setting, or I can just change the setting while you're watching, because this is also good for you to know. So if you go to the settings, because I don't want to, when I zoom in, I don't want the clusters or the footprint to show, because it is drawing a lot of data and I don't look at M5 footprint either way. And also, I don't look at M5 footprint. Where is this setting? Okay, I will pause and come back when I find this setting. Okay, so auto transform candles to clusters. So I'm going to move this. So now when I zoom in, it stays as a candlestick pattern. So I don't know why I have it in my template, but I don't know why it was enabled again. Either way, market was rallying. I know, like the way I read context, there was a very high likelihood that we should bounce from here. But just because of I have a feeling, a high likelihood, I can do a quick analysis. It doesn't mean that I should just go with it, right? We have tools that we can use. One of them is the delta profile. So if I measure the leg in to leg out, this is showing me not very much, right? Let's go like this. It's not showing me very much, but when we zoom in, we can actually see like we have the highest amount is 681, okay? and the highest amount, the next highest amount is 625. So if you don't see the numbers, you just have to believe me. Mark this out as an area. Okay. And then I know that this whole area is an area of demand. And then on top of that, I know that we have institutional activity. And on top of that, let's see what I can show you. On top of that, this way. On top of that, we have this shelf right here, as you can clearly see. So here, the shelf. I'm not going to mark all of it because it's going to be quite messy. So we have this shelf right here. And if you just look at the chart objectively, you can clearly see that there is a lot of volume transacted here. So you can even draw it this way. Doesn't matter. Like, this is a very high time frame view of it. But if you draw it this way, you can clearly see that you have a shelf here as well. So there is multiple confluences into that zone. Okay. But what I like the most is the institutional activity is a demand area. And based on how I read context, this should be a very high quality zone. You can clearly see there is a lot of volume being transacted here as well. So it is a very high quality zone. And as I showed you, it is aligning with two shelves. So I'm not going to mark everything because we don't need to mark everything that we see. I have an area that I'm interested in taking a buy. Now look at what happened to the market when we are dropping. So yes, that is the speed. That is the M1. We have our zone. Let's go. Maybe I will pause the video because I think it took quite a while before we came into that zone. And keep in mind, like if you see my trade here, I even refined it to the shelf. Okay. In this one, I haven't done so. So if you think the zone is big, just know that when I was trading this live, I don't want to spend a lot of time right now. I even refined it to the shelf. So if you see this golden area, that is the shelf. And let's see, I'm going to show you something right here. When it says, I don't know if you see it, CS, that is contract shelf A+. Like it's an A+ zone. So it's not hindsight if I show it to you right here. So I will pause the video until the market drops and you will see how heavily it will drop. Okay, it's coming. Look at all of this selling coming lower. I will pause. Okay, we are coming in very, very hot. We are coming in very, very hot. I think you guys missed it, but we haven't missed the trade, but you missed how much the big trades was popping. So if you look at the M5 chart, you can clearly see huge bearish candles. Huge bearish candles. All right. Would you be like, how can I show it to you? Look at this. Would you be the first buyer inside of this? No, right? But in my way of reading context, we were bullish. There was a very strong seller here. You can clearly see. Look at this seller. This seller, if you go to the right, is resisting price. Market dropped to where we have the next strong buyer. Auction market theory 101, right? So with that being said, market is dropping, everybody is selling. But me, since I know how auction market theory works and how to mark supply and demand zones and understand what zones we should trade in, I'm in a buy mode. Okay. So I'm in that catching the falling knife mode. But of course, I'm not going to catch the falling knife if the confirmation is not good. I'm not going to take it on a shallow footprint confirmation. And just to show you another thing, since we were talking about, if you look at this, I told you, market will bounce at this low. We saw that 450 lots of sellers getting trapped and we will break new highs. That is exactly what we did. And it was based on the session volume profile. You can clearly see market dropped down to this VPOC and went higher. So in real time, guys, not hindsight. Okay, dropping. So currently I'm seeing huge amount of sell aggression. We are coming down to where we have the largest amount of buying inside of this leg of price. into an area of demand, which I also had refined to a shelf. So if the market is dropping now, I want to see what happens. Okay, let's reduce the speed, compadre. Okay, coming in very hot. Not yet. Okay, look at this. Now I went long. Look at this when I went long. And I think you will. I can't replay this too quickly. And I will show you how I exited as well. Coming down to the strong buyer. Look at how much selling going on. Look at the next M1 candle coming in. I think it's gonna be the next. Yes. Look at this. Start to go above this. No, not yet. So waiting. Waiting. 2x speed. Okay, okay. How can you see how much selling it is like inside of this price action? Let me bring in my Discord so you see. I enter somewhere here. Look at this. Can you see how much selling it is going on here? Do you see it? How much selling it is going on? So once all of this selling into a very specific sniper zone, but the candle is becoming green. How is that possible? If you have, let's count, 515, 102, 187, 582, 202, 152, and a lot more inside of that. I can't see it. 592, 161 of selling, but the candle is going higher. What do you do?
Order filled.
What I do is market enter.
Order placed.
That is what I do. That is also what I did. I'm going to show you where I exited. To be honest, like exactly, I was targeting, I don't remember, this area of supply or this area, but I'm going to look at this, even better, much better. A lot of selling going on, but market goes higher. Like 1K lots of sellers, but we have a green candle. How is that possible? I'm going to show you where I exited, and you will see it like it is so visible where I exited. A lot of buy orders will pop, but market won't go higher. Not yet. Patience. Okay. I'm going to see if I have time to exit this trade. Okay, now, do you see all of this buying going on? Now you want to see what happens with this buying. A lot of buying came in right now. Okay, red candle. So, with that being said, here is where I exited. I think I even waited a little bit more to exit, to be honest, but it was a perfect exit. So with that being said, now we didn't get the same exact entry that I got when I was trading this live, because this is replay price action and it's fast forwarded. But let's see. Yes, that is where I exited. Now we can clearly see why I exited up there.
Order cancelled.
So that in itself, ladies and gents, can clearly see entry at this low, exit at this high, exactly here. I didn't have a standard take profit. I exited once I saw a lot of buy trades popping in an area of supply, but the next candle became red. So one other reason why I exited right here is that I was up like 6R, so I don't need more. For my way of trading, if I get 2 to 3R even in a day, let me mute this sound, 2 to 3R in a day, I'm very happy. So I don't need 6R. But when the trade goes, it goes, right? And even today's trade, yeah, I think I got like 1 or more than I was anticipating. Because what I like to do, like, let's say that you're targeting this area of supply or this area of sellers. This wasn't a supply, to be honest. This area of sellers. You could either take profit here directly, or you could see what happens on the order flow once market comes there. Sometimes you get few more points of a push before selling steps in. And it is very visible on the order flow. But the con of it is actually that most of the time, since our areas in the chart are so precise, is that market will exactly go there and react. So it will pull back on you and you will lose a little bit of profits. But today, like in today's trade, let me bring in this TradingView instead. When I took the long from here, my target was this high. That's the first high. But I had a very good optimistic feeling that we should take out this high, which market actually did as well. If you go to M1, you can clearly see that was one straight bullish candle, and this wick took my take profit at this high. So instead of me taking profit here, let me show you. I think I had a 6-point stop loss today. So this is another way that you can do it. I was targeting this. I think I had 6.5 point then. Targeting this, but market gave me all of way to here. So instead of me going out at 3.4R, I got 4.2R, let's say. I'm not able to replicate that specific trade perfectly. I think I didn't have my stop loss. I have my stop loss here. Either way, never mind. It is very hard to replicate everything on the tick. So it's not like I'm making this off, right? But once you start to backtest everything, you will understand that this kind of things you can't put, like when you, like you can't be like, it doesn't matter if I got 3.5 or 3.8, right? So I can't replicate it perfectly when I'm trying to do this. Either way, I think we're done with the course. And I hope that you guys have finally enjoyed everything. I might do even one more video and explain what we have to offer in the academy, because it is actually the natural and logical step for you to take if you want to truly become a professional trader and understand what is happening around different areas inside of the market. Because I think that you understand how powerful combining all of these tools is. Now, what you have to do is to see if you click with my way of explaining everything. And also, the way I read context is very unique to me, because this is something I developed myself. But maybe, like I have done myself mentorships, and I didn't like their way of, first off, explaining, and second off, reading the markets. But if you like my way of reading the markets, I think the next natural way is joining the academy, or you do your own trading and see how it works and how perfectly it works, and do your own backtesting. Because that way, the way I did it was I learned information from people, and then I went to practice and backtest and understood stuff by myself. That is a very logical way of doing it as well, but with correct guidance and mentorship with correct, and that is a big correct, because if you remember from the first video, I spent 40 to 50K on mentorships, and maybe 2K of those, I can say with confidence, was a good amount of money to spend. So if you think the way I explain everything is logical, go with it. But I highly recommend that you go and practice a little bit by yourself to get a feel for it, right? Don't just sit here for someone else to give you everything. So with that being said, this was the second backtesting session. I showed you a live trade that I took today, 2 live trades actually. I showed you why I exited the first one, which was a great lesson. And I showed you why I entered the second one, which was also a great lesson. And then I showed you a very high quality, high conviction buy trade in an extremely bearish market. Like when not bearish, market was overall bullish, but extremely bearish 2 candles, right? So with that being said, thank you for this video, and hopefully I will make one more video, but if I don't, okay, so before I let you go, just do me one small favor, because congratulations, you just finished the full course, and this is a big step. And also, if you want me to personally review 2 of your trades, you have to do today's assignment. And today's assignment is that I want to know what your biggest struggle was before joining this course. And this is very valuable information to me. Okay, so in one post, tell me what was your biggest struggle before this course. Also, what was the one sentence or one moment in this course where everything finally clicked for you? You can either quote it or describe it in a new post. Also look for everybody else course completion posts. If someone else's light bulb moment was the same as yours, give their post a like. So as always, we have to drive more engagement into the communities that we are invested in, right? And this is a very good exercise, and this is a very good exercise for everybody else to see what their fellow traders are actually struggling with, and also what the aha moment was, because someone has maybe has a very hard time risk managing his trade, but someone else maybe had the aha moment because of auction market theory or order flow, or they now finally understand how the market works. So with that said, I only ask for one more thing, and this would mean the world to me. That is, if you go to the school community and then you post a testimonial on what you thought about the course, if the course was good, and no pressure, like there is no pressure about anything. Just if you want, write something. It doesn't have to be nice. I happily take critical feedback. Just write honestly what you like. If you want to do so, just go to the school community. Let me actually show you how you can do so. So here in the community, you can go to write something. You can add it a title. You can add your own title, and you can add your own text. So there is no pressure that you should write something positive. If it was positive, I happily accept your feedback. But if you find something negative, implement that as well. So failure and criticism are good. So with that being said, write something, please, if you like. And then when you're going to post it, you can just choose the testimonial tab and then post it. So with that being said, I hope you enjoyed this course and hope to see you in the academy so we can conquer the markets together.